We'll start off by turning on my microphone. Good morning, everyone, and welcome to the Traders Conference. I guess I should say good morning, good afternoon, good evening, wherever you're tuning in from. We are so glad to have you here for day 2 of the Traders Conference. My name is Kelly Clement. I will be your starting host this morning. Jeff Gibby will be joining us here in just a little bit. But I'm going to be kicking off the conference today with Martha Stokes here in just a few minutes. But before we get started, I just have a few things to just cover really quickly to kind of kick us off. And always the first and most exciting thing of anything when you attend a financial seminar is the disclaimer. So we're going to start off with just by reading a disclaimer really quick, and then we'll get right into the conference. So this demonstration is designed to instruct you on using MetaStock and accompanying software plugins, and is not a recommendation to buy or sell, but they're rather guidelines to interpreting and using the specific indicators and features within the software. The information, software techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock shall have no liability for any investment decisions based on the use of their software, any trading strategies, or any information provided in connection with the company. MetaStock and its employees do not endorse the purchase of any security, nor are they paid for the promotion of any security. No information contained in this presentation should be construed as investment advice or a solicitation to buy any security. Now, that disclaimer is going to hold true throughout the whole day. So, we're not here to tell you what to buy or sell. We are here to provide instruction that you can take and use to help you further your trading. But trading does involve risk. I hope everyone's aware of that. And this disclaimer is just to cover that there is risk in trading, and you should be making decisions based on your own and not anything that is presented here at the conference. So first of all, before we get to Martha here in just a moment, what I'd like to do is just thank our sponsors for this conference. Putting this conference together does take quite a bit of effort. Jeff Gibby does most of the coordination, putting everything together, and he does an amazing job, and we're thankful for the job that Jeff does here at MetaStock as one of the sponsors. But our other sponsors, traders.com or Stocks and Commodities Magazine, has been a sponsor of the conference since the beginning. We'd like to thank them so much for everything that they do to help the conference and help it come together. If you go to traders.com, you can see their site. You can learn more about stocks and commodities and what they offer. It's a great magazine that covers a lot of different technical aspects about trading, technical analysis, fundamentals, and you can learn so much from that magazine and that website, so recommend that you check that out. Our other sponsor besides MetaStock is the Traders Forum. The Traders Forum is a great community for traders. There's live market chat with other traders, there's learning about the markets, and a community of traders helping traders. You can just go to thetradersforum.com. It's free to join, so just join us over there, or you can scan the QR code right there on your screen. So with that, we are going to go ahead and jump over to our first presenter. I've already talked about MetaStock as a sponsor, but sorry, Martha, before I jump over. So MetaStock, we are MetaStock here. We are the main hosts of this conference. And what we provide is a technical analysis software that allows you to better analyze the market. We do that by letting you scan the market, backtest your strategies, get forecasts based off of technical events. You can do options analysis, just about anything you want to be able to do as far as technicals go. And we also offer an amazing platform called MetaStock Zenith that gets you real-time news and data from Reuters, and then data from London Stock Exchange Group. So it is a very powerful platform in what MetaStock can do. And you'll be seeing some of MetaStock here in about 2 or 3 sessions with Jeff Gibby a little bit later on. So let's go ahead and jump to our first presenter. Our first presenter of the morning is Martha Stokes. If you're not familiar with Martha, you are in for a treat. And if you know Martha, you're in for a treat, because Martha really understands the markets, has been studying the markets for decades, and really has a unique understanding of the underlying fundamentals of the market and what's really happening. Every time I listen to Martha, I just learn something really incredible, because she really understands how the market moves because she studies it so much. So Martha, let's go ahead and jump over to you.
Alrighty.
If you are ready.
Yes, can you see my screen?
No, let me actually switch the presentation over to you so you
Okay.
can share your screen.
All right.
Okay, so stop sharing. Okay, let me get my glasses on here so we can share this over to you. Martha, make you the presenter. Yes. Okay, so now you should be able to share your screen. You should have a pop-up on your screen.
Oops, nope, that's not the right one. Yeah, it's coming up on the wrong one.
Oh, it's
Okay.
a cool background though.
Yeah, it's AI. Let's see. Let's go back. I need it to be on this screen. I don't know how to change that. Let's see.
Okay, let's see. Let me take it back.
Okay.
And then what I'll do is I'll make you the presenter again, and then you can
Yeah,
select
share
which
it
one
again.
you want.
Yeah.
Make
Okay. I just clicked the wrong button.
Oh, it happens all the time. Don't worry about it.
Yeah, well, I don't want it to happen on my watch.
All right, there you go. You should be able to do it again.
Okay, there we go. All right.
Got it.
Sorry about that, folks. All right. Are you ready for, I'm called the fire hose of information. I have a lot of, I've been studying the market since the age of 12. It's my passion, and this is my legacy, teaching people what's not available on the internet. So we're going to talk about dark pools, how they shape price, the hidden market forces behind every trend. Just like Kelly, I'm just an educational company, and we've been in business for 28 years with an A+ Better Business rating. We just are just into our 28th year. I retired very, very early because I was tired of dealing with people who thought they knew, who wanted me to run their funds, but then argued with me when I selected the best for them. Anyways, but Howard convinced me to educate, and that's what I do. I am a chartered market technician. I've been a long-term member of the CMT Association. I am the CEO and co-founder of TechniTrader with Howard Johnson, who convinced me that I was a great educator and I should do this, and I love it. It's become my passion. It's important to know that I have a Series 86. That is a technical analysis approval by the SEC. I won that with my CMT, cycle evolutionary theory, how to identify evolutionary cycle deviations. I don't know, but I am told that I'm one of the top cycle theorists in the country and perhaps overseas as well. Because what I did is, instead of saying, oh, I want to prove this cycle it works, I want to prove this cycle exists. I already knew cycles existed. I've been studying them since I was very young. What I wanted to do is say, hey, we're only looking at one part of the cycle. We need to understand how the cycle is changing. Is there an extreme deviated peak, an extreme deviated trough? Is the cycle regular and consistent, or is it breaking down? Has it totally collapsed and isn't functioning at all anymore? Reverberations, all kinds of things. And I presented this, and I was told the SEC, the CMT would take months to approve my thesis. And it came back in less than a week. They were so excited about it. My other analysis that I presented to CMT is relational technical analysis, which everything you've learned is useful, but I'm going to show you how relational analysis, understanding the dynamics behind the scenes, makes it work and really makes it. And please stay, because we have a really great bonus today for those of you who are attending and some other surprises. Reality check. Currently, the economy and the financial markets of the US and the entire world are undergoing massive changes that are happening more rapidly now than ever before. There are 20 new technologies emerging. In 1990s to 2000, only 6 were emerging. Only 5 were emerging in the 1920s. Those were the 3 great bull markets. We're in this new great bull market. It's really cool. Most of these changes are invisible to the average person who invests or trades in the stock or other financial markets. These changes will impact your life in more ways than you realize, not just your trading, but everything about society, everything about everything. The purpose of this webinar is to provide you with insights and facts that are not available to you via the internet, social media, and news feeds. You get a lot of information every morning. I'm going and looking at that, and I'm going, what the heck are they talking about? NVIDIA is doomed. We need to sell it. Are you out of your mind? Consistent success trading stocks requires the ability to adjust and adapt to change. Are you willing to adapt and change what you're doing to go along with this flow? Because this cycle is changing everything. Change starts first with an understanding of what is going on behind the scenes in the inner market structure. You do not have access to it. I know people say, oh, I found the whales, I found the dark pools. You can't find them, folks. There is no market limit order book. There's nothing. It's totally dark. It's peer-to-peer or direct purchases from the company. It also requires your ability to disseminate the difference between fact and fiction, as the financial news has become weaponized by certain entities recently. Recently, I've noticed that there's weaponization. They start attacking a stock or a company, and then everybody panics and starts reacting to that. They're making a lot of money. So ask yourself, why is this person telling me to buy or sell this stock? What do they get out of it? What do they get out of it? Because I can tell you, there's nothing free in the stock market. You just think there is. So dark pools do control price. So can you see where they are? Can you see what's going on in this? This is where that buy zone is. Now, the stock went down. Oh my gosh, the stock went down. Do they care? No, because they are long-term investors. They see that this stock fundamentals are right in here, and that's what I teach, is showing you where the dark pools are. And MetaStock is magnificent. I love doing their webinars. They're fantastic. They're organized. They're structured. They have their act together. They're the best of the best. And their stock charts, MetaStock charts are just fantastic. And I have created indicators for MetaStock exclusively for MetaStock. Many years ago, I wrote and designed them, and then I have a programmer program them into the MetaStock because that's not something I can do. But it goes down. So you're thinking, oh, this was a downtrend, so I'm going to start selling short. And then all of a sudden, it starts moving up like a rocket. Because the dark pools say, okay, this is a bargain. This stock price should be here. Okay, this is a bargain. And then pro traders nudge. And then there's another push up, and then pro traders nudge again, and then HFTs gap it, and then it runs up and up. You have to understand that the dark pools are the dynamic force behind uptrends and downtrends. And there's another little dark pool. They make the bottoms. Write it down on a sticky notepad or something. Dark pools make all the bottoms. Okay, the global stock market is underway. We're becoming this global marketplace, and the U.S. stock market is the largest in the world. We have 1,000 Fortune 1,000 companies. We have 6,500 or so stocks right now. I've seen it as high as 10,000 stocks in the 90s, okay? So it can grow, and we can have more IPOs and things. We have the largest stock market. So we will be the center of the global stock market. We have the largest commodities markets. Currency markets, we control it. The dollar is the value of everything. We have big credit markets. We have huge bond markets. We have a derivatives market that is ginormous, futures and swaps and all kinds of things. And non-fungible tokens are coming, and ETFs and ETTs and all those. Options market is huge, massive. A real estate market may not be as big as China, but China's cities are empty. So it doesn't work to build a whole bunch of infrastructure and have nothing there. We started crypto markets, and it's now no longer a fringe market. It is a mainstream, and it is very important. So we are the center of this new universe, and you're circling on the outside of this, okay? All these little tiny dots are you way out on the outside, so you don't know what's going on the inside, and this is what it's all about. The dark pools. By now, most of you who are trading stocks have heard the term dark pools. However, most of what you hear, read, or watch on the internet, videos, and retail news and commentaries is totally false. Totally false. Guarantee it, because I'm a buy-side retired. The actual name for the market participant group that is referred to as the dark pools is the giant buy-side institutions. This is a small group of 20 or 25 private corporations that control hundreds of trillions of assets worldwide. It's somewhere between 350 and 400 trillion assets globally. That is big. Do you think they're worried about all this other stuff that's going on? No, they could care less. They are invisible to most traders. The footprint on MetaStock charts looks insignificant. However, Their impact on the future trend of a stock is massive in scope and depth. So they're out here on their little dark pools all by themselves doing their thing. And here's the massive quantities of things that are going on. This is actually an AI example of what the inner connections between the inner market and the outer market looks like. I thought it was really cool. I like the AI. Okay, find the dark pool price activity. Can you identify it? I don't have outlines for this. So we have our MetaStock quiet accumulation, and quiet accumulation tells me a lot of information. This is a very complex indicator but it exposes dark pool. So just looking at price, dark pool, dark pool. It looks insignificant. And then all of a sudden it starts to sell down, then this huge white candle. Why did that happen? Because the dark pool saw that that was a bargain. They know the prices of value is here. So if it drops down, they're going to push up. You're thinking, oh, it's going to go down. I'm going to sell short or whatever. Then it moves up with pro trader nudges. Then it goes sideways again, drops down again, another push up. So they know that the value is starting to increase. And over time, this stock is moving up and up. And look how much longer the candles get as the dark pools pause their orders and just ride the wave up. This can be a day, this can be a week. This is just an example of what's going on. So this is important to understand. And the volatility and the velocity, the momentum, the speculation, the gambling is you. And if you see rounding shapes or flat top like this, that means that the dark pools have decided to lower some inventory. They always hold 4,000 to 5,000 companies in their portfolio, but they can lower and raise the amount of inventory they have. Who and what are the dark pools? What are they? The buy-side giant institutions are the most dominant and influential market participant group. They control vast inventories of stock in 4,000 to 5,000 stocks. That's what their average hold is. So each of the dark pools, each of the buy-side institutions holds 4,000 to 5,000 U.S. companies out of the 6,500 U.S. listed stocks right now. They do not invest in foreign corporations for U.S. investors. U.S. investors currently are not allowed to trade any other foreign country's stock market unless they actually have a residence or something like that. So the buy side is all about the U.S. It's all about U.S. corporations. It's all about the 401ks and the IRAs that they're fiduciarily responsible for. When they accumulate, the price is predetermined and is in a very narrow penny strike price range I call buy zones. I am told that people mimicking me is an honor or something like that. And I'm going, it's still my word. It takes weeks to months for dark pool to complete their accumulation. It takes weeks to months or longer for the dark pools to complete a 5 million, 10 million, 20 million, 50 million share lot accumulation. Okay, that's what we're talking about. More importantly, buy-side giants also use support the market. Write it down. Whenever there is a geopolitical event or risk to maintain the integrity of the current market condition and trend. So this is a very important thing. Support the market activity from these buy-side giants that got together and agreed, hey, we've got a problem here. We need to fix it. Not like the banks who let everything crash. It started in 2019. So dark pool price and indicators are very important. We have a lot of activity that is going on and it's moving up slowly, and the comparison, relational analysis kicks in with price. Indicators, there's 5 indicators that I have in MetaStock, and the comparisons tell you what's going on as well. But right today, since I have only an hour to do this, I'm really focusing on price and how they move price. They always create the bottoms. You can rely on it. If there's a bottom formation, you should be paying attention to that because the pro traders are going to start nudging it and off it'll go. And we have a lot of stocks in bottom formations. The bull cycle of market participants, I've shown this many, many times, but I had to change this. This is my thesis and my theories. And I know that there's a cycle that goes on with the market participants. The buy-side institutions and pro-floor traders start everything. This can be intraday, day, weekly, monthly, yearly, many, many years. It's always the same. Now, this bottom formation can be at a bottom, but it can also be somewhere up along the trend where they start accumulating again, as I showed you in some of the charts. Their floor traders manage the everyday activity of keeping the trust accounts in line with the stock prices. So that's what they do. Wealthy private investors are people like Jeff Bezos and Bill Gates who've retired. They know everything about business, and the market is the business of businesses. It's not a gambling. It's not a casino. So wipe that out of your head because it doesn't work. And they know what they're doing. So they also are buying low, but they're not a real factor, but I put them in there. Corporations are a real factor. Right now, 486 of the 500 S&P 500 companies have buybacks, and who knows how many are in the Fortune 1000. I didn't get that information. Everybody's doing buybacks, so they're driving price up. Global asset management public companies are different than buy-side institutions. I had to break this out. We have State Street, we have BlackRock, huge global asset managements globally. A public corporation has to please its investors. A private company has to make the people, the fiduciary responsible people they're responsible for, the 401ks and IRAs, happy. Huge difference, huge. The global asset management public companies are more worried about their revenues and earnings statements. The buy-side institutions are trying to make sure that the return on investment for 401ks and IRAs is always going up or always stable. So no matter what happens, we don't have panicking people that have mutual funds or ETFs, and they sell those ETFs like they're stocks, and then the market crashes. That's the focus. These two are diametrically opposed right now. So I had to break out the derivatives developers, BlackRock and State Street, because they're no longer considering the fiduciary responsibilities. They're only worried about making their investors happy. Funny thing is, the buy-side institutions own a lot of the State Street and BlackRock stocks, so they can control and manipulate that company. Sell-side institutions are what's left of the banking industry. There's only 5 big banks left, and they are all in terrible shape. Pro floor traders are the best in the world, bar none. However, when JP Morgan Bank tells their floor traders that they have to come back to work and they've been trading at home and doing a great job, they're going, why would I go back to work? I have to drive a long distance. It's just a mess. So they have become the professional traders independently, and that's a growing group. And now the newest of the new is professional trading companies of professional traders, floor traders who created a company, and the buy-side institution says, I need to boost my ROI right now. I will pay you to trade these stocks. I'm a long-term investor. I can't trade the stocks. I'm going to hire you to trade the stocks. So why aren't you following these traders with their nudges? Because you don't know that they're the ones that are nudging price up. High-frequency trading and hedge funds are on the professional side, but they trade the retail. Hedge funds, they trade the retail side. Also, sell-side institutions will trade the retail side. These trade in dark pools. These trade independently. They can do anything they want. 80% of all the market activity, some 350 to 400 billion dollars a day, is transacted in the U.S. markets. Okay, so all these others are the 20% retail side, and they rely on retail news. They rely on recommendation services. They rely on analysts, the retail analysts. It's not professional analysts. I can guarantee that. It's like, what are you talking about today? So these are the ones that drive the speculation and also create the over speculation or the void of buyers. Impact of dark pool activity for financial markets. Alternative trading system venues, also known as dark pools of liquidity, have been around now for 23 years. It's nothing new. The dark pools manage the vast wealth of the middle class. ATS are peer-to-peer over-the-counter transactions that eliminate front-running of giant lot orders that was common in the 90s. This is 2026, guys. This isn't 1990, 1999, 2000. You can't trade and scalp. It's not possible anymore. After the legislation of the US ordered the stock market to change from fractions to decimals, because the poor average guy that's trading stocks, he doesn't know how to use fractions. It's like, are you kidding me? And of course, politics, they bought it. And so the giant buy side went to the SEC and were approved to have all of their transactions off the public exchanges. The banks asked for it to be changed from fractions to decimals because they wanted to squeeze out the So's bandits, their independent floor traders who were scalping, okay, in the 90s. And oops, it changed everything. Now the market is too efficient. This was how alternative trading system venues were created. ATS are virtual. They're not a floor and physical floor anywhere other than in the buy-side institution's own entities. So they've controlled dark pool indicator patterns. We have a stock that's been running down, going sideways, and then all of a sudden we have, I don't have this indicator today, but we have an indicator that signals buy sides. They're buying, they're slowing the price down, And then everybody thinks, oh, sell on the dip or sell short. Oh, we'll sell short. And you're running smack dab into their bargain hunting. And so they're bargain hunting, and then they set up this beautiful little nudge right here. Pro traders move it up. There's this beautiful velocity run. A velocity run does not has candles that are not overlapping. And then it goes sideways for a little, and then everybody thinks, oh, it's going to sell short. We got to sell short. And then up it goes, and it'll go up even higher. So I have indicators that show you that it's slowing. They're slowing down the bottom because the fundamental value for the stock is way up here. And they will keep driving that price up. Meanwhile, it suddenly becomes something that's a darling. And it's like, if you'd gotten in here with these nudges, and then you ran that up and you sold when the pro traders were selling, this is the pro traders taking profits, then you would have made a nice tidy profit off of Microsoft. So now it's all the news is going to gap up, and then you're going to be chasing it. Functionality of the market since AI introduction. AI is massive. If trade wars, real wars, inflation are bad for the stock market, which everybody claims, why has the stock market been moving up since April of this year? What drives the stock market upward? New technology, AI technology. So we need to stop worrying about the world is coming to an end and realize that no matter what, the stock market is going to go up. And it is not over speculated. There's no AI bubble. There never was an AI bubble. AI integration is not what you have been told. So let me explain how AI works. I asked my own AI, how do you work? And of course, he compliments me for being brilliant about asking such a question. There's a main AI, and it's in the cloud. Without cloud technology, we'd not have AI. With the cloud technology, Amazon, Google, and Microsoft fighting for dominance on the cloud technologies. Amazon won, of course, Microsoft, and then Google. And I told students there's 3 big companies in every new technology that will dominate. You don't have to worry. Just pick one of them because you'll make a ton of money on your long-term investments, and you can trade them all because they'll just keep going up. And forget P/E ratios because that will go off the charts. So the big AI is here, and I go, okay, give me information how this works. And he says, okay, in seconds he comes back. All these little units, every single one is an AI, sub-AI, all sub-AI. They each have a library. In that library, they have all this information that they've gathered from the internet and everywhere they can get it. And some is like, give me all the retail news, or give me all the information about a certain company, or give me information about this or that, or ancient history of the stock market, or whatever. So, and he gathered whatever the question is that you posed to him. If you pose it properly, or then it pulls from the vast numbers of libraries and comes out. Now, the only problem is the AI has no understanding of what's fact and fiction. I complained to Google Gemini this is not truthful information. So now Gemini does this little icon that shows you where it got the information. Now I do enough studies and research that I know that certain companies like Gartner, Forrester, Statistica are very reliable. Thomson Reuters are extremely reliable information. But others like JP Morgan spouting off, it's like, oh my gosh, no way. Sorry, I pick on that bank, but I don't like misinformation and weaponization going on. So it can't tell you that something is being weaponized. It can't tell you. So you have to be careful with the information. So it's not one AI, it's thousands of AIs, each with their own different library of information. And I think that's really important that you understand that, because then it's going to have you alter in how you ask your AI for information. Like if I'm using my professional trading journal and I say, analyze all of the data from my market condition analysis scans for the month and give me some information, it can do that very, very accurately. The biggest problem with AI is language. It has very difficult time with language. Microsoft worked on it since 2014, and it's still a problem with language. It doesn't understand language. And what is this? This is a language. This is a language. Where is the dark pool buy zone in this chart? This is an island gap. Can you see where it is? The stock has been gapping up and gapping up. It's still, of course, it started over here. But where is the dark pool that's most important for you? Right here. Right here. And then, of course, the stock runs in gaps. You want to be in before these gaps. You don't want to be chasing the stock because the pros are going to be taking profits. The power of the buy side. It only takes 4 of the top buy-side institutions to have sufficient voting rights to vote out a corporation's CEO or board of directors. That is power. The voting rights are not exploited, but used to influence the board with regards to CEOs, how they're performing, dividends, stock splits, acquisitions, and mergers. So what are the buy-side doing right now? What are they telling the CEOs and all of that? They feel that a lot of stocks need to be stock splits rather than buybacks. The buy-side priority is to protect the wealth of the middle class of the US because that's how they make their money. The buy-side giants send analysts to each and every corporation they hold. The analyst physically evaluates the company, CEO, and future growth potential from new technologies. Buy-side institutions are all about new technology. Why? Because that's what creates great bull markets. There's great bull markets, there's moderate bull markets, and there are minor bull markets. This is the first great bull market we've had since 1990 to 2000. The new technologies emerging at this time are the most profound and far-reaching change to the stock market in over 100 years. Buy zones and sell zones and stock charts. That's what I call them, the buy zones or the sell zones. Dark pools use quantitative analysis. And yes, they have incorporated a minimal amount of AI into that because quantitative analysis is perfect for an AI. It's not language. It's pure data, numerical data. AI quantitative analysis is executed with a highly skilled quant, a human being, who oversees every analysis of each company the buy side holds stock inventory in their trust accounts. The stock that they buy goes into a trust account, and that trust account has to be managed and balanced constantly. So at the end of the month, on Fridays, you can see all these huge changes going on in the stock prices, and it's saying so volatile and whipsaw. Well, the trust accounts are being adjusted. They have to be adjusted all the time. They have to match. The ETFs have to, the ETF, the inventory of trust in the trust account has to match the ETF value. Human quants determine and set a specific, very narrow price range for the accumulation of the stock over a long period of time. TWAP orders are used, not VWAP. I know everybody's all in love with VWAP, but it's the most dangerous order in the market. Time weighted at price is, okay, you're going to ping every so often, over a long period of time at a specific price range. If the price goes above that, it stops pinging. If it goes below it, it stops pinging and waits to see how low it will go. And then it pings at a lower level. They're very sophisticated order types. VWAP is the more volume that's pumped through, the faster the stock moves. That's what causes all the flash crashes. We've had quite a few flash crashes lately, and we'll probably have more because small funds managers are in love with VWAP orders, and they think that, oh, well, if volume's going down, then I'll just do my VWAP order and it'll automatically get me out. And of course, it goes so fast, it gets them out really bad at a bad lot or buys them in at a bad high. TWAP are automated and trigger within predetermined narrow price range, and I'm talking narrow. This creates a pattern within the stock chart that can be identified using relational technical analysis. So we're taking technical analysis and we're embodying all this new information that we have that we can streamline into this and say, okay, this is what we need. This is what we need to look for on the charts, in the indicators, and in the overall understanding of what's going on in the market. I just told you that the buy-side institutions are letting their corporations know that have really expensive stocks that they feel that buybacks are not as useful, and that they should consider splitting their stocks so that more people can buy the stock, so the stock price can go up, so the dark pools can ride the wave up. You know how this works. RTA includes study of the price action trend behavior using hybrid leading indicators with an understanding of dark pool activity in the MetaStock charting software, and it is awesome. And one of the great things is that no matter where you are in the world, MetaStock charting software is there for you. So this is a very analytical thing that goes on. Our dark pools in this chart we see that they started way over here, and then kind of they're not here because of the size of the candles. So they're right in the center of this group right here. Okay, and there are not very many of them. And we have smaller funds trying to sell this down. Boom, 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 sell, 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 sell. And as they sell, the dark pools are buying. And if you can learn to read this in the charts, and it takes time, I'm very dedicated to my students. I mean, this is my legacy. This is what I leave behind, is that I proven, because a lot of my peers go, why are you teaching these people? They can't learn this stuff. And I'm going, okay, you just set down the gauntlet, and I'm going to prove to you that I can teach retail traders how to identify this stuff. And my students do, and I'm just so proud of them. And then it goes down a little bit, and then boom, it goes up and shoots up. This is these are the kinds of analysis you need to be prepared for. And if you see a buy zone like this and it's starting to trend down, it's not a time to sell short. It's a time to prepare for a nice pro trader's nudge pattern, be in with the pros, and then ride the run up. And not be afraid if there's one small dark day, that's not the problem. They will show you when they're going to get out. And that's very important. Cryptocurrencies. Dark pools started buying huge quantities of the most popular cryptocurrencies years ago. Meanwhile, the banks were trying to make the blockchain work within a structure that was structured, centralized currency, and it didn't work. And they spent billions of dollars trying to get blockchain to work. And of course, the dark pools are going, that's never going to work. That's not too bright. They are creating the new instrument called non-fungible tokens as we speak. They are starting to go there. That will be available on the stock chart, on the stock market. Real world assets such as cargo on ships, at sea, corporations' inventories of products, and so on and so forth. There's tons of non-fungible tokens being developed right now. Nobody's talking about it yet because the dark pools haven't started releasing what they have. And it's a real world asset. And this is going to be huge, huge. Dark pools will be accumulating stable coins, which are what most countries are developing, as well as all, as well as other governments, are going to be sponsored cryptocurrencies that will replace hard currency globally. We are evolving and we're changing. At some point in time, there will be no dollar bills or coins. So if you have children or grandchildren, you might want to take and set aside a dollar bill and a $5 bill and $10 bill and some change so that they can see what it used to be like, because currency, real currency, hard currency is going to be gone. So we won't have any more of that, and everything's going to be all on the phone or other ways of doing it globally. So every government's going to have a stable coin, and the dark pools are investing in those because they know that's where there's going to be big money. They will also be in swaps that are considered securities. So there's this huge growth of swaps, and there are all kinds of swaps, just tons of swaps. And if they consider those security, they will also be in those. So that's where they're going. Ongoing changes to the buy-side institutions. In 2018, the giant buy-side institutions realized as ETFs became more and more popular, this relatively new instrument had become a systemic risk for a major market crash. They agreed to a loosely structured, coordinated action to avoid an ETF meltdown. It was called Support the Market. Giant Buy-Side agreed to support the market whenever there was a major crisis or a risk of a sudden run on ETFs by panicked investors or traders. That's what they were afraid of. You can sell an ETF like you sell a stock. 1 minute and it's done. You've sold it. So if we have all these ETFs in 401ks and IRAs and other long-term investments, and these investors panic and think the world is coming to an end, there will be an ETF run. The giant buy-sides are going to be buying those ETFs to support the market. They have successfully used to support the market for ETF panic selling during the year 2022, a war panic, 2025, a tariff panic, and 2026 oil prices and inflation panic. They know what they're doing. They're supporting the market. If you think you're going to be selling short, you're going to be selling in to support the market if you don't understand what's going on. They will continue to employ this strategy in the future because that protects their 401ks and IRAs and what they're fiduciarily responsible for. This is dark pool. Goes up above their penny price strike and it stops and it goes back down. If it falls below, they may wait a while before they start buying. These are the professional traders and the professional company traders. These are your hedge funds and your HFTs. And this is you. All the retail traders, investors, highly volatile, highly emotional. You create all the volatility, you create all the velocity, you create all the momentum. You create this. Dark pools do not create that. And I just like to show this. This is a millisecond trade transaction. Professional traders trade on the millisecond. That is 60,000 transactions in 1 second, or 320,000 transactions in 1 minute. You're on the minute scale. Sure, you're typing in your order. Your broker lights it while you're typing it in, and it sends it to the PFOF market makers, and it's filled. It seems like it happens really fast. Your orders are not filled by your broker anymore. They can't afford it. They're saying, oh, you can have free trading. Well, they're a company. If everything they give you is free, how are they going to pay their bills? How are they going to pay their employees? It's stupid to think that it's free. It's not free. You're paying for it. First, your order is lit by your broker as required by SEC rules and regulations. So it lights it really fast. Everybody sees what you're buying. Everybody can see what you're buying. So if you're in a chat group of 10,000 or 100,000 people and you're all buying the same stock, everybody's going, oh, front run. Then the order is routed to the payment for order flow market makers within milliseconds. So the market maker pays your broker for your orders, and they fill the orders, making a lot of money within milliseconds. So the milliseconds are going on all of this, and this is all just happening, and periodically there's a little bump up and a little bump up, and then a little more of a bump up and some filling. And this is all milliseconds. This is happening just as the market opens, milliseconds. And all of a sudden, boom, whew, gap up. And you see it, and you go, oh, maybe you have orders out there that are open, and you get filled in here. And then all of a sudden, it reverses because A void of buyers occurs and it just falls like a rocket. Propulsion upward is necessary to keep price moving up. It doesn't take any propulsion. There could be not a single sell short going on other than the sell side banks holding a sell side, which they can cancel in a millisecond. And if it's just sitting there waiting, and of course, if it starts crashing, then they're going to have their buy to cover way down here. Yeah, I'm sure some of you have experienced that painful situation. Market condition. Each market condition has a specific location for the buy or sell zone. Bottoming, they control it. Trading range, they don't get involved in trading ranges because that's the turning at a top of a very wide volatile price action. Mostly happens on stocks, not too much on indexes. Platform, that's the buy side institutions dominate that. Moderately trending up or down, they're riding the wave up or down. Pro traders are taking control of that. Velocity up or down, that's you. And it's very short. And topping markets, the buy side are rotating and slowly reducing their inventory, so they create the tops, and it's a rounding shape. We no longer have head and shoulders. Some people skew the data and make it look like it, but that's not it. We have flat tops and we have rounding tops. The dark pools are bargain hunters during moderately downtrending market and thus create bottom formations. Conversely, they are selling in slow, steady rotation as the stock goes over speculated in price, contributing to the top formation if the company has reached market saturation phase of its product or service cycle. Okay, and there will be companies that are reaching their cycle. There are 130 different industries in the stock market. The economy counts 30. I always think that's funny that after all these years, the economists haven't figured it out. Dark pools are fundamentalists. So when price goes too far beyond fundamentals, rotation can commence at any time. The dark pools create the hidden liquidity draw professional traders can identify. These are floor traders. They're super skilled. The independent traders are super skilled. And I have quite a few professionals in my student body base. So it's always fun for my new traders to listen to how they trade and everything. It's very important to them. So it's a good deal. Relational market condition analysis is not predicting anything. Relational market condition analysis is not a method of trying to predict the market weeks or months or years ahead. VIX tries to predict the volatility of the market or which direction the market's going 30 days ahead. Are you kidding me? Impossible. The VIX is invalid to 75 to 80% of the time. It's wrong. So why is everybody using the VIX? I have no idea. This is impossible and it's worthless. You cannot predict anything. Anytime the future is predicted, you immediately alter that future. Everybody knows this in cycle theory. What you are learning is how to forecast the weather conditions of the stock market. This is not predicting. So we can be accurately forecasting 1 to 5 days out, maybe a little longer forecasting, but that is about the dynamics that most professionals will do. Sometimes the forecast will go 10 days, but not that often. It is a very short-term analysis that is capable of accepting quickly to day over day and week over week changes to the market news, events, black swan events, flash crashes, voids of buyers, ETF panic selling, and so on. Okay, so this analysis is embodied in my relational analysis that I teach my students. Decades ago, I created 7 market condition analysis scans for our trading floor because I saw that futures tell you how the market's going to go open, but what happens the rest of the day? And that's what I needed to know, and that's what my scans do. So these are my scans created specifically for MetaStock charting software, and they are magnificent. I ask for, give me all the stocks moving with momentum to the upside. I'm asking for all 6,500 or 10,000 stocks, every single one. How many are moving with momentum to the upside? How many are moving with momentum to the downside? Then I compare the number of going ups versus the number of going downs. Then I know how many small funds and retail traders are really active or whether they're not active at all. Right now, they're coming in way below their average. So this idea that retail traders are doing this or retail investors are doing that, no, they're all sidelined. They're sitting on the sides. They're sitting on the sides. Then I ask for institutional activity. Give me all the stocks that have institutional activity based on my MetaStock indicators that I wrote. And it gives me a list of all of the ones that are in quiet accumulation or hidden accumulation. Then I ask for all the stocks and bottoms. Why? Because dark pools are the ones that always create the bottoms. So we have long-term bottoms and intermediate-term bottoms and short-term bottoms and very short-term bottoms, V-shapes and things. And so I can study them. I can look at them. I can see which stocks. I can see which industries are being accumulated and all of this in these market condition scans. They're amazing. And my students say that they have a huge 95% accuracy rate. And I said, well, I don't know about that. I don't worry about that because I know that they work. So we have the consolidation scan. Now, why would I ask for consolidations? Because pro traders nudges. They're little tight price points that go along in a nice horizontal stair-step pattern. And then there's a springboard that happens after that. Those are my candlestick patterns. So then I ask for all the stocks that are overbought or turning in trading ranges. And this has been very low for a long period of time. The overbought and the momentum sell can tell me if the retail traders are panicking and at a point of going to start selling in panic. These indicators are telling me that the retail traders and the small funds managers are not actively trading right now, and they're not in panic. But if it did, I would know a day ahead of time or 2 or 3 days ahead of time to warn my students on my market condition analysis report I do every day. Then I say, how many stocks gained price strength over the last month? And my month average is a 25-day. That's what most of the months are for trading days, just the trading days. And I see that right now, strength is not improving. Price improvement is not improving. So what does that tell me? That tells me that retail traders and small funds managers are not trading the market. It's a confirmation again. They're sitting sidelined because small price gains are the footprint of dark pools and pro traders. Then we have all the scans that you can look at for trading stocks and everything else. It is fantastic. MetaStock just has a gazillion different ways that you can trade. It's awesome. Trading tools and resources. You need a professional style trading journal which provides written evidence of your activity trading as a business, which all of you should be looking at, and also historical data to consider of the company over time. You need to have this data for you because you want to be a semi-professional to a professional. Your personal trade management planner, Howard created this, that provides a monthly plan on your monthly trading goals, number of trades based on capital, stock, price, range you should be trading, risk assessment, profit potential, and overall process. This is amazing. When I saw what he was doing, I said, our students need this. And he says, really? I was just doing it for me. And the students come back and say, Martha, the number of trades I need to make for this month to reach my goals for income, monthly income, is a lot less than I thought it would be. I said, duh, because less is more. Because when you know you don't have to trade so much, you trade too much. Less is more in the market because you become very selective on what you're going to choose. Then you're more consistent. You make more profits. Your confidence goes up. Then you make more money. It's a building block of confidence and financial security. Trade calculators and other tools that streamline accuracy and execution. So Howard creates these trade calculators because he finds out that most of our students' mistakes are mathematical. So he made all these trade calculators that are just super cool. You plug in a few numbers and it spits out all the things you need to know to trade that particular stock. Scans, sorts, layouts, and parameters for your trading style and market condition are mine. I share my professional scans, my professional sorts, layouts, and parameters embedded in MetaStock. It's part of the program. You can't buy them separately. Trading simulator. You must have a real simulator, not a game simulator. Why? Because the game simulators will give you, $500,000 to trade. Well, you don't have $500,000 to trade, or maybe you do. And also it's a game. It's not, the stock market isn't a game. It's the business of businesses. It is the foundation of our future economy. And you should be trading all the time. I traded on my simulator for a year because I suddenly saw nudges coming up. Pro trader nudges. I tested and tested and tested and tested before I gave it to my students in the definitive guide to candlestick courses that I built for them that year. Market condition analysis scans, I just showed you that. Controlled bracketed order type, I've told this many times. Howard had a special controlled bracketed order he wanted to give to our students. He called the market maker on New York Stock Exchange. The New York Stock market maker was so impressed with the bracketed order, he asked permission to use Howard's bracketed order. And of course, Howard said yes. And to this day, the controlled bracketed order is used on many professional levels. They have tweaked it, of course, to their own, but this is what you learn, and this saves you. Oh, I'll use a limited order. And then all of a sudden, you're in a stock that you thought was going up, and it's going down. Oh, I'll use a limit order. And then all of a sudden, you're going to a stock that's going up, and you thought it was going to be selling short. Or you do an at market, and then, oh, well, payment for order flow, market makers got to make their money so they can pay the brokers. Morning market open reports and market condition reports I write every day. I write the market condition report based on my analysis of my market condition scans, and then I write this in the morning about 3 o'clock in the morning, my time. Daily market educator discussion groups and communities within the TechnoTrader students only campus online. AI goes out and gathers all the information everywhere that it can find about what you're talking about in chat groups and all this. That's open forum. Well, I don't want mine open forum, so I have a student only campus that is locked down. AI can't get into my campus. They can't find out what anybody's doing. And I think that's the best way to handle the AI, because otherwise it's going to front run you. Tutoring and coaching for new students and answers to all your questions. I should not answer questions on Sundays, but I do. And I'm very dedicated. I have an extremely dedicated staff, a fantastic assistants, and just people that just really care and are very proud to be part of TechnoTrader. We've been in business for 28 years. I'm inviting you to learn more at technotrader.com. And you're going, oh, I have to sign up for something. Well, yeah, you do. But here's the difference. I'm retired. This is my legacy. Most of my sales come from student referrals. You can come here and you can sign up, and we're not going to bug you. I have a small staff. I don't need a big staff because most of my sales come from referrals of students. You can start learning here. This will take you to the huge, vast library of information that you can have access to, and you should come. Just be comfortable with it. Pick a free lesson to get started on your path to professional level results. So if you're just starting out and you have less than 2 years of experience and you've just started to learn technical analysis and some other things, I would ask you to start here. This is a mini course. It is free. You watch this and then you say, oh, well, no, this isn't for me. Oh, well, this is good information. I think I can do it myself. Or, wow, this is what I've been looking for. This is the help I need. This person, this company is going to give me the confidence, the consistency, the reliability so that I can become a strong trader. Professional trading plan, you want to know more about that. I talked about it, touched a little bit about it. If you've been trading for 2 to 5 or 10 years and you want to know more, this is just an introduction course. It's free. You can just watch it. There's no requirements other than registering. And then relational technical analysis, should start here. This is a more advanced 7-day preview of our most valuable course. And it's very, very, when I have people that come to me and say, Martha, I wish I'd paid attention. I came and saw you 10 years ago, but I decided I could figure it out on myself. And if I have wasted 10 years and $50,000 on other courses, I was like, oh, well, yeah, it's very hard for me to explain what's different between me and my company and everybody else. Because yes, we teach technical analysis, but we teach relational technical analysis. We teach candlesticks, but we teach springboards, pole vaults, hurdles, nesting candles, nudges, totally different because the market is different. All the candlesticks you've learned are fine. But if you want to follow the dark pools and the pro traders, you need to learn my candlesticks. I have different kinds of indicators that actually track the dark pools and say where they're going, what they're doing in pro traders. MACD is fine, but it's going to get you in a day or two late. If you use the new leading indicators, the hybrid indicators that tell you that dark pools are accumulating, you're going to get in with the pro traders, and then you're going to have so much more money from each profit that you make. The difference is hard to explain, but it's massively different. I really should have taken this 10 years ago. I have heard this so often over the past 28 years. It's not even funny. And I can't do anything about somebody who puts money elsewhere, tries to figure it out, other than fix all of their bad habits and get them going on it. Results have shown it's a bargain. It definitely is a bargain. And you need to think about that. Paid for the course in my first trade using your scans. That's very common. Just all very common. Gains exceed costs. That's true. And everybody says that. Changed my family's lives. Many people say that, and and that makes my skin just tingle, because I've changed a family's life, and if I can change one family at a time and make them financially secure, especially in this situation, then I leave a legacy behind that lasts forever, beyond what I was expecting. Everybody says that. So this is our offering for today. And I'm running late. Sorry about that. It's a free 1-hour starter course. You have 7 days to access it. You can use the QR code, or you can have Jeff or Kelly type it into the chat area. And you can get instant access today. This is something you should try. We're not going to hound you. I don't need to. If I'm the right teacher for you, you will know it instantly, and you will become a student. So I don't have to do any high pressure sales, or you got to buy it today, or whatever. And what I teach is very, very different. Everything you've learned is a good foundation, but you need more to move forward in this market. So I am done. Thank you. Do we have any of the guys there to talk?
Yeah, sorry, Martha. Yeah, I was typing in your links there, so I apologize. Yeah,
no, that's okay. That's okay.
I did have a couple of questions that came in for you, if you have a moment or two.
Oh yes, certainly. I've just gone over it, so.
Okay, let's see. So one question from Don was, how do you identify dark pools with candles? What is there a method to that you use?
Yes, there's a method to that. It's a certain pinging, and it's a combination of the indicators. You will have a very narrow price range, and then the indicators will confirm with gray bars, they're low gray bars, that there's accumulation going on, because it'll be intermittent. It'll be intermittent. Then I have a volume oscillator. Volume oscillators are far more useful in this market than price oscillators, and I created a special volume oscillator just for MetaStock. And it will be floating along the center line oscillation as they're quietly accumulating, pinging up and down. And before that, there'll be this huge spike down and spike up. You can see that if you come and take this course or look at some of the other things I presented, you will see that spike down. That spike down on the volume oscillator is incredibly important, because it says that's the end of the downtrend, and it will reverse very quickly. All these indicators lead price because they're based on all of the information plus some tweaking of different areas, and that's important.
Okay, great, thank you. See, the next question was, at the beginning of the session, you talked about there were 20 new technologies that were emerging. I mean, obviously AI is a big one. We all talk about that one, I think, on a daily basis now. I think that's become part of our language. But of those other 20 technologies, what do you kind of see as being the most disruptive?
The most disruptive is the robots and robotics. It's the AI integration. It is it's going to be autonomous cars, vehicles. We have gas prices that are absurd. Right now, I'm spending $7 a gallon, and all that, and it's just driving things. The database centers are growing. They're already established. There's something out now that's saying that databases are the huge database for AI is bad, but actually that is a huge growth factor. We're going to be seeing a lot more alternative energy systems. Corporations are going to alternative energy anyway. Biotechnology, buy-side institutions over the last couple of years, they've been buying biotech. There's 10 different biotech sub industries, and they're buying that like crazy. There's also hyper automation of corporations for their IT. They can reduce their IT department from hundreds of people to just a few. There's data scientists, because there's this super analysis of data scientists for that. And all kinds, just I'm trying to remember all of them. There are just a huge, vast number of them going on. Metaverse, of course, is going on, but not from Meta. It's going on underneath this foundation. So there's all these new technologies that are just quantum technologies going really fast. Solid state batteries are already here. That's going to change everything. So it's just massive.
Perfect. Thank you so much, Martha. I appreciate that. If you have not, go up to the https://trader.im/darkpools. You can click on the link in either YouTube or GoToWebinar, wherever you are, or just scan that QR code to take advantage of this course. It's an awesome deal to get that free 1-hour starter course with Martha. Again, she is a fantastic educator. Her clients love her. As she said, she just deals with referrals now. So let's go ahead and go on to the next presenter. Thank you so much, Martha. I really appreciate your time today. I'll go ahead and dismiss you out of the room, and I'll take over control here. So
thank you. It was
Martha.
great fun. Thank you. Bye-bye.
All right, let me do this. Okay, all right, let me make myself the presenter here. We'll get to Greg here in just a second, but let me share my screen. Okay. All right, so thank you again to Martha for her wonderful presentation. It's always great education to have her as part of the conference. Let's go ahead and just quickly thank our sponsors again. Stocks and Commodities Magazine, traders.com, great resource for technical analysis, learning about the markets, what the markets do, how different technical indicators work, and new and emerging thoughts in the technical analysis arena. Stocks and Commodities Magazine, traders.com. Thank you for being a sponsor. Again, MetaStock. We'll be talking more about MetaStock in the next session, but MetaStock is the host and the main sponsor of today's event. MetaStock software provides market scanning, back testing ability, forecasting, options analysis, news, top tier data, and it's won the Stocks and Commodities Reader's Choice Award for the last 32 years. Very, very proud of that. So let's go ahead and move on to our next presenter. Greg, are you there?
I am.
Fantastic. All right. Well, let me welcome you, Greg. Greg is has just released a new add-on for MetaStock. We're really excited to have him here. We've been partners with Greg Greg, how far back do we go? That's a couple of
more than 25 years.
Yeah, more than 25 years. So we have been fantastic partners with Greg over the years. We're really excited to have him in as part of the conference. Greg, let's go ahead and make you the presenter here. Let me see here if I can find you and make you the presenter. So you should have that showing up on your screen right now to share your screen.
It's loading. Give it a second.
Sure. Yeah. Take your time there. I got you. Yep, I can see it just fine. You sound good. Presentation looks good. I'll turn it over to you.
All right. Thank you again. Well, thank you for having me. Welcome, everyone. I'm going to tell you a little bit about myself, and then I'm going to lay out a trading plan for you and how to interpret putting together multiple time frames. My goal is simplicity, not being complicated, something that you can do with the software you have right now, and what's between your ears, right? Thinking. Right? So a little bit about myself. We've been doing this a long time. So with MetaStock, I actually first started with MetaStock with their first DOS-based program back in the late 1980s. Yeah, going back that far. And this was before there was an internet. We used to download data over a phone line. It was time consuming. You type DOS commands to move data back and forth. So it was really the dark ages. So things have come a long way for sure. That's why I say back in the 80s, I thought, how do you trade stocks? Right? What's the difference between a stock and a bond? Really, really basic stuff. Then after going through a process of self-learning, trial and error, I met up with an individual at a trading. It wasn't a conference. They didn't have conferences back then, but I met him through a group with specialists and market makers and hedge fund managers through Alexander Elder, who wrote a very popular book back in those days, Trading for a Living. I think it's still popular today. A very good book. So back in 1994, we decided, you know what? All of this information, which was expensive back then for trading and getting data feeds and so on, let's send out a newsletter and generate a little bit of attention, income to pay for these things that supported us. And we're in the right place at the right time. We didn't have the foresight to really see what was going to happen with the internet back in 1994. So we had a fax letter service, and it just took off. And hotlines and chats. You couldn't speak in chat rooms back then. We actually had the first chat room ever. You could just type, and then eventually there was voice, and we had offices, and then eventually the internet really took care of the need for offices, as you would imagine, and we didn't need them anymore and closed those all down. But we used to do seminars. I used to do seminars in hotels. Master Trader used to be a brokerage firm. And back in 2015, I basically was offered, let me buy all your old stuff from the 90s. And I was like, okay, you can have it. I bought and sold it, and restarted Master Trader from the brokerage firm to what I'm doing now. It was probably Master Trader didn't reopen Master Trader as just a primarily educator, I think, until 2018 or something like that. But at these trader expos, which I'm going to show you a picture of back in 1999, I used to do a lot of trading challenges, these live challenges that were great. People used to love to watch them. But as it says, I used to educate, not so much today, but in the time, hedge fund managers, because at those times, like I said, people would come to my office, and hedge fund managers and market makers and specialists, and then taught prop traders, and then the retail environment got more and more involved, and now they're a force out there, trading. And as you see, many well-known companies are my past students. You could check that out if you would like to on my website about me. You could see who some of those students are and companies that I educated. Some of them were employees in my old company, by the way. You could check that out. So there I am. That's me in the middle. 1999, the first Trader Expo. And you can see the booth back there was training, trading, and technology, what we call the 3 T's back then. And this was a major event, as you would imagine, the first Trader Expo where individuals could get together and talk about active trading, and that was the name of the company, the Pristine Day Trader. You can still find information out on the internet about the Pristine Day Trader today. So it's a very, very long history. And through that history, while markets have changed in a significant way, based on technology advancements, the foundational concepts that I taught back in 1999 are the same today. Now, there are nuances to them as markets change, but you can't change what is. You can't change the facts of what moves markets. You have many intelligent extremely bright individuals reinventing the wheel with very complex algorithms and software that try to approach it in a different way. But the simplest way, for me, is the best way. There were still complicated things back when I first started out. And my whole goal was consistency and simplification. And that's what I'm going to explain to you today. So this is how I approach things. Let me check if I get a little drawing thing out here. That works for me. Turn that on. Laser pointer is on. I always have difficulty with this software. Eventually I figure it out, but let's see here. All right, there we go. Turn it on. So this is the essence of putting everything together. And there are subsections below this, as you would imagine, because when you get into candlestick analysis, everybody, will focus on names of candlesticks. I'm going to simplify that for you. I say price is king. Everything else is secondary. You have to change price. Everything is based on price. Go to the source. Bar by bar analysis, I'll explain that to you. Take individual bars, put them in the context of a group of bars. Trend analysis, there we go. Trend lines, Gann lines, speed lines, Elliott wave. So many complicated things trying to figure out our prices going up, down, or sideways. Now, this is our main topic today, multiple time frame analysis, where I'm going to incorporate some of this and explain it to you in a very simple way. Support and resistance. Oh my goodness. Elliott waves, Gann lines, Fibonacci retracements, and a vast of other things to try and find out where support and resistance is. And any of you that are familiar with any of my speeches, you'll hear me say it time and time again, just look to the left and see where there was a turning point or some consolidation. That's what these algorithms are looking at, or any other kind of software. Where was their activity before? Whether it's a VWAP or some other type of analytical tool that tries to figure out where the buyers and sellers are, that's all it's doing. But all you need to do is look at your chart without all the squiggly lines. Relative strength and weakness is something weaker or stronger than the other. I think it'll continue. I'm going to explain about moving averages, volume. I say volume is secondary. Many make a big deal about it, but after many, many years and hearing, oh, markets have to go up on higher volume or down on lower volume and pull back on lower volume. Well, sure, I get that. But you know what? I've also been around so long to read opinions where things like, oh, this is still a secular bear market, or because it's not going up on big volume. And it's like, okay, it just went up 30%. Is it still a secular bear market? Maybe, but what about grabbing some of that 30%? So what are the broader markets doing? Market internals and intermarket analysis. This was a big part of my education, because if we all start out with the technical analysis part, however you're going to approach it, but after studying many, many of my trades that did not work and trying to figure out why, when the patterns, the technicals look similar to the ones that worked, it's about the broader markets, right, that are leading. And how do you measure that? The market internals. And then into market analysis, which is a big thing right now, right? All of you are looking at and hearing about every day the price of oil, the direction of interest rates that are influencing the markets in a big way now. Position and money management. If you don't have this part down, there's no way you can make it. Impossible. And that's directly connected to your trader psychology. Drawing. Let's go on. All right. All of these individual concepts, we have to put them together to create a strategy or a thought process. Right? We're thinking here. Well, why are traders and investors losing? As we're all told, most of them are losing, not winning. Well, it's not because they're lacking indicators. Not at all. Right? There's more indicators than you know what to do with. And then you think about changing the settings. It's endless. You're scratching your head. You're that guy with the questions. Which ones? Which settings? Maybe I'm doing it wrong. It must be me. It can't be the mythology. Well, it is the mythology. I'm not saying that it's impossible to do a winning trade with indicators, but there's so many variations. It's confusing. Which ones? Why doesn't this one work with that particular instrument? Why was it working before and not working now? Well, most of them, they're making decisions from the wrong time frame. They're mixing time frames, or they don't know which ones to put together, or they're taking trades with a larger picture. What's the picture? The larger time frame is not aligned with your entry. So do I need two time frames? Well, basic technical analysis is that longer time frames have a greater influence than smaller time frames. They're more meaningful. Uh, Longer time frame trends, that does make sense to create a bias and look at those higher time frames to gain a bias. But do I need to look at all of the time frames? We have a tendency, it's human nature, to want to feel secure, not to make mistakes, not to lose money. Those are all good goals. But with trading, it doesn't happen all the time. But we have to create something that's workable, that we can digest ourselves, right, by looking at a limited amount of information intelligently to make intelligent decisions. So how do we do that? Right, we start putting together this thought process. Well, as we do that, right, for longs, larger time frame. Well, what is that larger time frame? It depends on your objective, your goal, right? Are you a swing trader or are you a day trader? So we use different time frames, which I'm going to show you. So what is it in an uptrend or at support? We have to define those. Let it pull back to that support. Why? Because that's where the buyers are. And in a smaller time frame, we're going to look for some kind of a base or reversal, some price pattern that tells us that buyers are taking control. And we're going to enter near that support. Stop losses will be under that pattern. So I am simplifying here, but that's how we start. And for shorts, I look at a higher time frame, a longer time frame. Is it in down? I want it in a downtrend. Want it at resistance. What this means is this is where the sellers are going to be, and the force is lower. Right? I look for retracements into resistance or an inability to get up there, which would show me relative weakness. In a smaller time frame, I'm looking for it to move in alignment with the higher time frame. Look for my entry near resistance because that's where the sellers are, and I place a stop pattern above that area. So multiple time frame alignment. Right? As I said, longs, higher time frame should support a bullish bias, and the smaller time frame gives me my entry point. Vice versa for shorts, and we stay focused on the big picture, and then we look for our entries on our time frame choice. So this little picture here is to say these are in alignment with each other. And the more of these that are in aligned, the greater the potential for prices to trend. Pretty simple. Now, let's go back here. And okay, there we go. So why do we use multiple time frames? I've already explained that in part to you. We create a bias and we look for entries. It's not about looking at more charts. It's always about simplification. And these are our questions. This is where are prices going? So however anyone approaches the market, whether it's in a very complicated way or fancy software or indicators, they're trying to determine what is the direction of prices and where are they going to go? This way I can place a trade. Meaning if they're going up, I want to bet that they're going to continue to go up. Well, where are the buyers and sellers going to be? We need to figure that out. What is the larger time frame bias? Well, we have to decide what time frame we're going to look at to create our bias. Am I a swing trader? Am I an investor? Am I a day trader? We don't want to mix those things up. Where are support and resistance areas? Simplify that. Where's the smaller time frame entry pattern? This is our questions and what we're looking to answer by looking at our charts. So from a swing trader, I'm looking at weekly and daily charts. I'll take a peek at the monthly chart just to see what the big picture is, but this is my primary 2 time frames as a swing trader. As a day trader, there are choices. I will look at the daily to see what's happening, but my intraday time frames are the 65-minute. Why instead of a 60? Because it breaks it up into equal parts. There's no magic. If you can't make money with a 60 or get a bias or don't know how to interpret, you're not going to change that much with a 65. It's just equal bars instead of the first one being a half hour or the last one being a half hour. It's that simple. Now, 15-minute charts, this is my intermediate term one. I'm typically going to use those when the 5-minute becomes erratic. Erratic price patterns mean that there's uncertainty. So often in the morning, traders are fresh, right? They come with their biases in the morning. They see what's going on from the prior day, and they tend to be more aggressive. And as that plays out, usually maybe lunchtime, things begin to become a little more erratic. Traders are going to lunch, of course, and maybe coming back in the afternoon. So when we compress data, one of the reasons we use multiple time frames, when I compress the data, it takes away some of the noise, meaning some bars that may not be moving in a fluid manner. So this is depicting the light blue line. My macro time frame is up and my smaller time frame is ebbing and flowing or going sideways, and I'm looking for alignment of those 2 time frames when to take action. So what we're doing, again, continue to simplify, monthly time frames. And these E's on this software is just telling me that there was an earnings report, nothing proprietary there. Just earnings were coming out, and that's when they were. And as I look at that, okay, my big picture, and I can easily see that it was going up, and then it started getting rejected, and it started going down. Okay, there's some significant support down here. Pretty basic stuff. That's all I need to know. Looking at the weekly time frame, intermediate term trend is confirming what's happening here. It's happening here. They're in alignment. And then the daily, as I expand the data, you see this concept of expanding and contracting. So on the monthly, you don't see all of this. I want to see this because this is where my entry point is going to be. This is going down. It should go down to here. This is going down. Right? It's trending. Right? Support, resistance, lower highs, lower lows. And now a little bit more detail where I can see those candle patterns that'll give me guidance as to where my entry point is going to be. So I can see this stock is under selling pressure. And so the daily is showing me that intermediate term decline. And it confirms what's happening. And I can now look for my entry points. So I'm not making decisions based on a single chart, but we're going to move to that without it. But I want to understand what's happening in the larger picture. I'm going to show you it's not necessary to be looking at these. We'll take a glance and then we can just focus on where we want to trade, our entry point. So this one is going up. We didn't need any indicators to determine that it was going up. That was pretty easy to do. And daily, right? Now we're talking day trader. Daily is going up. 65 is going up, and this 5-minute is kind of not aligned. I mean, over here it was, but now it's starting to roll over and moving down. Okay, and what does my focus need to be here? This is going up, that's going up, this is starting to move down. My position as a day trader is to sit on my hands and wait for this to align with the big picture. Now, when is that going to happen? I can't tell you exactly. Right? All I know is that the power of these trends suggest that this is going to happen at some time in the future. So this is not what I'm interested in. I have to wait, and I'm going to explain to you why these moving averages shortly. So it says down here, right? The daily and 65-minute are bullish. The 5-minute chart, we use it for low. Well, this is low risk entry points. That is true, but how do I define low risk? This really should say high probability entry points. My risk is going to be controlled by my money management, but the higher probability entry points are going to be near support. And so as this maybe comes down into this area here, where prices went up from previously, right? Or areas like this, right? That's in the past. We can't go back to here, but with areas like this, I then shift here. I've got my bias up, up, some kind of consolidation or some kind of pullback. I shift over here and I look for a picture aligned with that bias. Pretty simple. It didn't require any proprietary software or indicators. Nothing proprietary. So now swing trading. I'm going to put a few moving averages on here, and I like to call them visual aids. They help me to know what's happening in different time frames by looking at one time frame. So this is what we're talking about here. Weekly time frame at 10 MA is equal to the 50 on the daily. Pretty simple. All you do is 5 bars times 10. It gives me that moving average. You could use any moving averages you want. I use simple moving averages, not exponential, not weighted, or any other. With equities, I found that works the best. I've looked at exponential, and there's nothing perfect. It's about being consistent. And so you could the monthly 10 MA is equal roughly to the 200. So by looking at one chart, I can see what's happening in multiple time frames. It's a way of saying they're smart moving averages, or rather it's a smart way to use them. So if the 20 is above the 50 and they're rising and they're above the 200, that means that all 3 time frames, daily, weekly, monthly, are in agreement with each other. It should going up. There should be buyers on pullbacks towards support, right? And once it does that, I look for a candle pattern, which I'm going to explain to you. In other words, I'm looking for buyers to take control, right? Like this, a bottoming tail bar. And this can happen in different ways. I'm looking for buyers to take control, to get on board, where the majority of traders are looking for prices to continue in that particular instrument. And it doesn't matter whether it could be the S&P 500, it could be IBM, it could be a currency pair in Forex, it could be equity futures. It doesn't matter. All instruments are the same, meaning supply, demand, buyers and sellers. Now on a 5-minute chart, I'm going to do it a little differently. I showed you the time frames that we're interested in. 65-minute, 15-minute, 5-minute is our entry time frame. So nothing magical about moving averages, nothing proprietary. It's just that the calculation relates to other time frames. So a 60-minute simple moving average is equal to the 20 on the 15-minute time frame. And roughly, right, the 200 or the 260 is equal to the 20 on a 65-minute. So now when I look at my 5-minute chart, I can see that multiple time frames are in alignment, and that means that you have all of those time frames, all of those traders are working together. Right? They don't know each other, of course, but they all have similar beliefs from different time frames. Is that XYZ is going up. I want to be a buyer because I believe it's going to continue to go up. Now, how am I going to get on board? Right? Right. We're forming a bias with a high probability that prices are either going to go up or down. That's what we're after. In a very, very simplistic way. It's like those time frames are all going up or they're all going down. It should keep happening until something changes. So, big point here. When you start looking at charts, stop thinking about it's a MACD. Stop thinking about it's an Ichikumi cloud or an engulfing pattern. I know these are all terminologies that are better used, but when I started thinking about charts as being pictures of what other people believed and their expectations that they created with money, it took on a much deeper meaning as to what the charts meant. Right? We're price pattern traders. Patterns reflect the beliefs of others. What are their expectations? Well, if I have 3 time frames that are pointing up or pointing down, the majority believe that it's either going to go up or going down. From that point, I have to begin to put together where are they going to act together? Right? Support, resistance, trends. Right? What are their beliefs? What are their expectations? And that gives me that on an ongoing basis. I like to say, I call it candle language. It speaks to me continuously. So these candles, once you start putting them in the context of the big picture, I get a much deeper understanding of what's happening there. And the patterns are going to tell me where traders are going to act. And if, again, multiple time frames are aligned, they're going to act together at the same time. And once, well, I shouldn't say that they're not all going to act together at the same time, because as prices begin to pull back within an uptrend, there's a level of uncertainty about will this trend really continue? And some are just going to buy at support, which will form these things we call candlesticks, and we will be able to determine how aggressive they are, and some will wait for some type of confirmation that those buyers are stepping in, or in a downtrend sellers are stepping in. And then others that are waiting will say, oh, there was a reversal. It's starting to go up. Or however they approach the market, their fancy software package or their algorithm will tell me that demand is overcoming supply, and in some way they'll make a decision to buy. And as more and more traders become confident about the turn and that the trend is continuing, trends begin to accelerate. And so we can continue to monitor what's happening. Now, with this slide here is, again, simplification without getting into candlestick names and starting to explain to you that this is a piercing pattern or a dark cloud cover or all of that. Red bars are going down. If the green was going up, they're going up. So these are simple patterns. There's a pullback pattern. You put this in the context of an uptrend. A lot of times it happens like that. Sometimes you get a retest and reversal pattern. There's maybe for whatever reason, there's a little bit more uncertainty, and there's a retest and it reverses. And this is a larger green candle next to that one, which was green. And it's in an uptrend. Buyers are taking control. It should go up. If there's more uncertainty, this could be a bottoming pattern, or it could be, as a day trader, this could be lunchtime, where prices had come down, and you saw they went down and they dipped back up again. And so as we look at these individual candles, I thought, well, these are smaller ones. That's a big one. So a lot more activity there, a much more powerful candle. And so as we look at candles, we determine, well, it's a big one, there's a tail, and we start putting them together in what I call bar by bar analysis, and it simplifies. We don't need names. It's just about, this was going down and it came back up. That gap down, it came back up. Put it in the context of multiple time frames. The majority are looking for prices to go up. That's a pattern that says more are participating, it's going to go up. A larger bottom, for whatever reason that happened, doesn't matter to me. Right? It is. This is what it is. It wasn't a pullback pattern where they're more aggressive. Right? This one was a little less aggressive, and this one, there was more uncertainty that created a bigger bottom. All of them have to be put in the context of where we started, multiple time frame alignment. Okay, what's next? Support and resistance. Location. Location is the key. Right? Once we determine multiple time frame alignment, I'm looking for where the buyers were, right, at prior support. We start inserting those candlestick patterns in areas of support or in areas of resistance. So determine trends, determine where buyers and sellers are going to be. Then you can start inserting the different candlesticks bar by bar that will communicate to you that buyers are taking control. It's going up, it's pulling back. Now it's beginning to go sideways. Now it's going down. And we'd apply our multiple time frame alignment with our moving averages. And I'm going to show you examples of that, of course. First thing we do is put together these individual concepts to build the thought process. And here we go. Right? We're putting it together. Price patterns, which I've pullback pattern, could be a retest pattern, could be a bigger pattern. Is it making higher highs and higher lows? Multiple time frame alignment, trends are up. Location, where is it happening? Patterns, trend alignment, location. One of these is not a strategy. What we're doing is putting together a strategy. And now we're going to look at a few charts. And when we're done with this, sure, if you put in front of your charts this afternoon, you're going to apply this, and you're going to start to apply this thought process in a systematic, objective way. Now, of course, look at this chart. Think about, what do we have going on here? Didn't I just show you this pattern when we looked at the candlesticks? Sideways, down, up, sideways. That is that larger bottoming pattern. But wait a minute. There was another part of this mythology. Is the pattern aligned with multiple time frames? This is a 5-minute chart. The 20 MA is declining. It's flattened out. It has to have flattened out because prices started going sideways. No indicator can lead what prices do. You cannot. It's impossible. There's no such thing as leading indicators because they all going to follow price. Common sense. 60 MA. That means that the 20 MA on the 15-minute is declining. 200 MA is declining. That means the 60 period or 65-minute time frame is declining. Do I want to trade this on a breakout? I don't. The power is to the downside. My expectation is sit on your hands, Greg. Everyone else is thinking lower. and waiting for their pitch, so to speak. Well, some money bought this down here. You might think, well, why did they buy it down there? Well, this often is the algorithms, because you'll find that breakdowns often get bought by these algorithms, especially when it's been declining for a while. That's just how they make a little money and they push it back up again. So yes, this pattern is supportive of a bias or thought that buyers took control. But in the higher time frame, the sellers are in control. So I'm not interested in this picture. Remember, you got to put the picture in the context of the trends and support and resistance. This starting to make sense, guys, ladies? I hope so. You got to think about these individual parts, these multiple time frames, the way I've explained it to you. And you know what the most difficult part of this is? All of us. Meaning, when things aren't aligned the way we want it, we deviate from our plan. Now, I get into trader psychology in courses and explaining all that from these patterns and such, and the discipline part and how we deal with all of this. But the most difficult part is waiting for the alignment of your methodology and your trading plan in the time frames that you're trading in. So trade against the trend. Don't go long in this picture. Professionals are waiting for the alignment to get on board because the odds are in your favor. It's common sense. Greed and fear play havoc with common sense. That's the truth, undeniable truth. All right, so let's look at a few examples. What do we have here? This is a daily chart. 20, 50, 200. It was going down. It was under the moving averages. What the hell happened here? Well, there's not enough information on this chart to explain what the hell happened, but I see a big green candle. Call it a bullish engulfing pattern or whatever it might be. In the context of this trend, it's going down, it's below the 200. The moving averages were flattening out, so it was consolidating. But why did it do that? I don't have enough information to tell you why it did that. But all I know is in this time frame, this isn't my money. As we look at charts, you start thinking, how could I have taken advantage of that? Well, unless you have a plan for that, no, you can't. But look at here, it's going sideways. What does that mean? It didn't create a pullback pattern. Right? Think about what do pullback patterns mean. Everything's about trader psychology. What are they thinking? Well, here they thought, get on board. Why is it this thing's going up? There could have been news. Okay, pullback pattern. Pullback pattern means, okay, it went up a lot. Let me get out of the way. Take my money. Others are thinking, how am I going to get on board? Pullback pattern. It's not pulling back. It's going sideways. It's forming a base. And this is where bar by bar analysis comes into play. And I don't need to be able to put a name on this. Bottoming tail bar. Could it break out? That would be a trade. Well, pull back. Now, money management becomes key. If you bought that breakout, these candles here, you put them in the context of trends. Sometimes red bars are ignored. And now look at right here. There's probably some candlestick names for that. I don't care. What this communicates is, call it what you want, it's going to go up. Multiple time frame alignment. It went sideways, bullish price action. It didn't give me a pullback pattern. And a 3-bar reversal, it's going to go up. Get on board, buy it, put a stop down here, share size it accordingly. Now, some traders might say, or individuals might say, pullbacks to the 50 MA are viable. Well, that's a general concept, but this went sideways and it broke down and it moved down pretty aggressively and it broke through that support. Yeah, it's consolidating there, but all the trends are not in alignment anymore. I need more information. I'll pass on this. I'll pass. So as you learn to read individual bars and putting them in alignment with multiple time frames. There are great ones, and there are ones that are maybe not so great. Now, here we have a chart that was in transition. So it was pretty messy on the left side. Yeah, you can see the moving averages. 1 second. Stop trying. Here we go. All right. Look, moving averages were pointing down, and the red one, the longer term one, is facing up. They're out of alignment. This is a picture that says, you know what? It's better to just sit on your hands. They're not aligned together. And so it moves up above the moving averages. They're not pointing up yet, but they're improving. Right? It's starting to get some attention here. Right? The 50 is above the 20 is above the 50 is above the 200, but it's kind of messy. Well, what happened there? What happened there? And on volume, could have been it is an earnings report. See the E? That means there was an earnings report. So now this is a power bar. The moving averages start coming into alignment. Don't forget, we're looking to take action where the sellers are when something's in a downtrend. Where are the sellers? You've heard this before. What was support becomes resistance. Look to the left. It's simple. Now, let me add something to this. As you hear me explaining this to you, you might be thinking, I would say rightly so, Greg, that's a lot of stuff for me to remember. But you know what? The latest, greatest indicator is going to do that for me. And I say, okay, good luck with that. But you know what? If you practice this thought process, it becomes second nature. Just the same way it became second nature with any other industry you are in that you went to school for. It starts becoming second nature, and your brain just works that way at light speed. The moving averages, I said, are a visual aid. Resistance is over here. The moving averages are pointing down. It's moving up. Right? This is not providing me any entry points. I know we haven't talked about entry points, but it's always under a prior bar's low. But when you see a candle like this, and what's so great about this candle is that we look for failed bars, some type of failed pattern. This was going sideways. To someone else that's not paying attention to trends, they're saying this is going to be a breakout pattern. Well, we don't trade breakout patterns when multiple time frames are in downtrends. I'm looking for an individual candle like this that communicates to me that sellers took control in a big way, and it was a breakout failure. That tells me get on board, short it, share size it up here. When I say stop, that means share size accordingly to your account. And then manage it. Manage it bar by bar. As it's moving down, you'll start trail stopping. It's trending down. As it keeps going down, at some point there's going to be a reaction. That doesn't mean it's going to be a trend change. But remember, support, resistance, look to the left. When you see something going down like this, you should be thinking, look over there. Is that near some support, or does it have room to keep going till it gets there? So we got to have a whole conversation about position and money management. Let's let's do the same thing on a intraday time frame. It's everything's the same. We're just changing time frames. Here's my 65-minute. Now, I didn't give you the calculation for that, but you can email me. It's not a problem. You could do it on your own, right? I gave you how to do it. This is the 20 MA on a 65-minute chart, right? And this is the 20. This is on the daily 20 MA. This is pointing to the downside. So my bias is going to go lower. Here's my 5-minute chart. This is how I set up my 5-minute charts. 20, 60, 200. And I put the prior close on there. This is for intraday trading. and the day's open. If it's below the prior day's close and the open, and you're looking at a daily candlestick pattern, it's going to be red or it's going to be negative. Right? So I can see that. And then I can see as this is trying to go up, it cannot. And this happens, I got this marked off here at 2 o'clock in the afternoon. Everybody comes back from lunch. A lot of times after 2 o'clock, that's when things start moving again. So a couple of things to take away from this chart. It got, let's call it short-term extended in the morning. The stabilization did not result its inability to fill the gap. It couldn't do that where I know sellers are going to be. And then after 2 o'clock, we have the 15-minute traders, right? And the 5-minute traders, things are coming together. Right? The hourly traders are like, oh, it's going down. There's no setup there, right? But it's going down. And after 2 o'clock, often that's where the trend resumes. So it's not about the moving averages. It's about understanding that the traders from this time frame and the traders from this time frame are coming together with the same bias as the ones on a 65-minute time frame. This is moving down. The breakdown should be a high probability trade for it to go lower. Multiple traders, multiple time frames in alignment with the same bias. See how this is simple, but it takes this methodology to put it together and then the discipline to follow it. So on the left side is the typical route that we most of us shoot, I pressed the wrong button. Give me a second here. I'll put this back up. It's here we go.
Do you need help with it?
No, I figured it
Okay.
out.
You got it.
The drawing thing is next to the share, then I pressed the wrong one. All right, sorry about that. All right, so here's the typical route. I've been there, done that. That's how I started out many years ago. Is it overbought? There's no such thing as overbought. You might say, what do you mean, Greg? Everybody says things overbought. I said, really? I said, oh, it's overbought. And then it kept going up. Well, how could it be overbought and go up? Prices could be extended like the semiconductors were, and they're starting to pull back. Things can get extended either to the upside or the downside. That's a better word than overbought and oversold. Prices get extended and they retrace. Right? Different settings, right? Tons of indicators. Right? You're chasing them indicators and the settings. You never understand why. Master trader approach. Right? Multiple time frames, trends, price patterns, location where they're happening, risk management. Swing trader, I gave you the time frames to use. Day trader, I gave you the time frames to use and how to interpret it. This puts together a structure and the concepts come together. By the way, the add-on that was mentioned for MetaStock that I created with them puts this together. Trends, multiple time frames, price pattern alignment, and the Explorer looks for that. And then when you look at the chart, it all makes sense to you. It all makes sense. Right? We have to have a methodology built on a structure of where multiple concepts come together. And whether someone is approaching this through some, complicated algorithm, or you just look at the chart in a simplistic way, we're all after the same thing. The question is, how are you going to approach it? The way I do it is simple. I just look at a chart and it's like, okay, multiple time frames are aligned up or down. Where's support? Where's resistance? How do I get on board and manage it? This is an important part. Well, I can't cover this in great detail. I have a whole position and money management course on it, but this one slide will keep you in the game by having you control your risk. Simplicity. And just here's an account, break up into 4 trades, and say, how much am I willing to lose on a trade? By the way, every trade that is recommended in one of our letters, swing trading letter, credit spread letter, ETF, that it's based on a $300 risk. Now, if you got a bigger account, of course, more risk, but you need to adjust your share sizing accordingly to make sure you're not losing too much money. And after 4 trades, if you got 4 bad trades in a day, you lost, percentage of your capital, stop trading. Revisit the charts, see what you're doing wrong. But here's your plan, right? Your plan, as I explained to you, putting that together puts the odds in your favor. And so create your trading plan. Trading plan is a belief system. I explained to you how to do it, how I do it. And as I said, your confidence comes from that price structure and multiple time frames. I don't have to tweak the indicators. I choose your time frames. Are you a swing trader or are you a day trader? You don't mix them up and trade with the trend, right? That's your edge. Price patterns. Pivots, that's another conversation, but when you see pivots on my charts, if there were dots there, all it's doing is looking for bars with 3 higher lows to the left and right, highs or lows. So I explain all of that. You can come in our green room or in the letters, it's all explained. This is a lot. This is an education. It's a college education in reading price action. You want the latest, greatest indicator that's going to tell you red light, green light, what to do. I don't have that for you. But I can tell you how to read charts and how to align your probabilities in your favor, and then how to manage the money and do it with a professional edge. So rather than offer you a bundle of courses, which I could, an individual course or a letter, a swing trading letter, credit spread letter, ETF letter, if you go to mastertrader.com and research there, if you have questions, email me or email support@mastertrader. If you decide that you want to partake in the special for Memorial Day, 40% off, pick what you want. You can pick the annual swing trading letter that's already discounted and get another 40% off, or come into the green room, live trading room, and take the annual and another 40% off. So a course, individual course, you can go to the site and look at the different memberships or courses. If you have questions, email support@mastertrader, or just get on board and join us and start simplifying and moving toward your financial goals. I am done. If there's any questions, I'm here.
I have a question.
Yeah.
Let's see, what is the website? Is it mastertrader.com?
Yeah. Mm-hmm.
Okay,
Yeah.
let's put that in the chat.
Should have included that, right, Jeff?
Yeah,
Thank
well,
you.
that's my job. I can help.
Thank
Okay,
you.
so I'm going to
Thank
put
you.
that
You're
in
the
the chat real
organizer.
quick, the YouTube real quick. Make sure everybody has access to that. All right, 40% off of anything. We also have a pretty good deal on the add-ons that we've kind of developed with Greg. I'm going to talk a little bit about that. Greg, great job. So I couldn't be with you to kick you off, but I hope Kelly did a good job.
Yes, very much so.
All right, very cool. Well, let me do a little bit here. I'm going to take over, and I want to say thank you for being in here.
Welcome. Thank you for inviting me again.
All right, anytime. We'll talk again soon. Ooh, we might have a question. Don't jump out yet. I do see a question pop up. Oh, it just says fantastic, Greg. I agree.
Welcome.
All right.
Thank you again. Bye-bye.
Thanks again, Greg. All right. Let me go ahead and share my screen. I want to talk a little bit about this. And I need to make sure I share my entire screen. So, because we're gonna be spending some time here together. All right. Wow, my hair's doing something a little bit weird. That's okay. I do appreciate all the work Greg's done on this add-on. It's been fantastic. So in the add-on, there's 2 different types of setups. There's the trend following setup and the gorilla reversal setup. And Here's just a list of them. Trend following systems, counter trend, guerrilla reversal systems. These are all methods that are identified in the add-on that Greg built with us for the MetaStock software program. Each one of them are going to include clear entry setups. They're going to give you defined stop placements that you can use, target setups, a trade management plan. They work really well. They're scanning, of course. We're going to talk a lot about scanning as we get into my section, which is next. But you can scan, you can sift through thousands of securities to find the ones that hit the opportunity that you want. And it's very, very easy, you know. So you go in, you run your scan, and instead of looking at 1,200 stocks, in the example you're looking at, you just look at the two that come together. He's got a trend indicator that tells you if it's group bullish or bearish or neutral. And we actually sat down and recorded a class together. So in the first part of the class, this is recorded. It's available to you instantly as soon as you purchase. He discusses its setups and how you can apply them. I love how methodical Greg is when he goes through this stuff, when he talks about it, when he shows how to use it. In the second part, I show you how to run up your scans, how to put them together, how to use MetaStock. All of that's included. So 16 price and volume setups. It's great for swing trading and day trading. Has complete pattern management, day trading tactics, trade management techniques, implementation strategies. Normally the add-on that Greg and I put together is $19.97. Instead of going 40% off with the add-on, we're going to go 50% off. We're going to drop it in half. We're going to give it to you for $9.97. We'll give you a 30-day money-back guarantee. We'll give you free access to MetaStock if you need it. You can do that at metastock.com/mastertrader. You can give us a call, 800-882-3040. And if you have any questions, metastock.com/saleschat. So very, very cool add-on. Give it a try. I love the way that we package up the products. If you purchase this, it's a one-time cost. You pay for it one time. If you don't like it, you can send it back. Well, you don't have to send it back. You just cancel your order. They give you a refund. Back in the day when I started, it was on CD. We sent CDs out, all that kind of stuff. You don't do that anymore. You just cancel it. If you do like it, you keep it. And it keeps paying for itself over and over and over again. It's such a good low risk, high reward type of an opportunity. So go to metastock.com/mastertrader. You can also do this at metastock.com/conf-promo. You can give us a call at 800-882-3040 or metastock.com/saleschat. So there you go. As we start to get into my section, I want to just say thank you to our sponsors. I want to say thank you to Stocks and Commodities Magazine. I don't have them in their sideshow up right now, but they've been a great supporter of the MetaStock platform and the conferences that we've been doing for a number of years. Huge shout out, and I hugely appreciate all the work that they've done. Also, I want to invite you to join the Traders Forum. In the Traders Forum, you can go in there, you can make friends, you can chat with other traders, you can learn about the markets. We do all kinds of really cool stuff every day, day in and day out. So it's a community of traders that help other traders. thetradersforum.com. One of the things I really like, I'm just going to, about the Traders Forum is we will go in there and we will bring in like Greg Capra, or last week we brought in John and Jack Kosar. We'll just talk about the markets. We'll talk about what's going on. We'll talk about analysis techniques. We'll answer questions that come in. Much more of a podcast style of an environment, but all of the stuff that I'm talking about now is available for free. All you have to do is register. You just go to thetradersforum.com. So we are going to talk now a little bit more about MetaStock, a little bit about some of my favorite features in MetaStock. And so I was going to kind of go through this a little bit more, but we'll go through this a little bit more afterwards. I'll just get to where I'm going. So my name is Jeff Gibby. Here's a picture of me wearing a suit. Let me read a legal disclaimer to make the attorneys happy. Today's demonstration is designed to instruct you on using MetaStock and the accompanying software plugins. It is not a recommendation to buy or sell, but rather guidelines to interpreting and using specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. MetaStock and its employees shall have no liability for any investment decisions based on the use of the software. Trading strategies are any information provided in connection with the companies. MetaStock and its employees do not endorse the purchase of a security, nor are they paid for the promotion of a security. No information contained in the presentation today should be construed as investment advice or the solicitation to buy a security. So, I have a very, very important question for you guys. Want to get a little bit of audience participation going. So what I would like to ask you is, who wants a free book? The first person to answer is going to get a free book. Who wants a free book? While you're doing that, I want to say thank you for coming. Thank you for being part of the event here. Just talk a little bit about MetaStock. MetaStock has been rated the highest software in its price category for 33 years in a row. There's a number of tools that you can use that are very, very helpful. The scanner is one of my favorite tools. It's going to allow you to find opportunities. We're going to run a scan now. The system tester, you can go in, test trading ideas, see what works. The forecaster. Today, what I want to do, though, with MetaStock, MetaStock's been a software that's been a Don wants one. Don, you're the only one that is talking. Oh, there's actually two Dons. That's why. Okay. Well, we've got a winner. So I forgot what I was talking about, though. Oh, we've got. Okay. All right. Well, Don and Don, you got it. I'm going to drop you. Let me just go ahead and do this. I don't want to forget to do this. We've got Don Jasura and Brad Griffith. Actually, there is one Don. Okay. Let me just grab. I think I can. Oh, here it is. Okay, let me do this. I'm going to start an email right now just so I can finish it later. And then Brad, thank you for participating. You probably want to know what books you want. Brad, I almost have your email memorized anyway. Okay, we've got these started. Okay. Big friend of MetaStock, Candle Profit, Steve Bigelow. Later on today, I'm going to show some of the scans that we wrote with Steve. He did a really good job of creating scans with us. But I've got a couple of books that I'm going to give away. And Brad, you're going to get a copy. Don, you're going to get a copy as long as you send me the address. So, Don, the one I'm going to send you is Candle Profits, Eliminating Emotions by Steve Bigelow. The second one I'm going to give away to Brad is High Profit Candlestick Systems by Steve Bigelow. And all you need to do is just answer the email I'll send to you, and I'll get those over to you. So thanks for being here. Thanks for participating, all of that kind of stuff. I'll go ahead and do this now that I've got that started. Okay. All right. Okay. Let me introduce myself. I just wanted to get everybody woken up, offer something for free, see if you guys are paying attention, all that kind of stuff. My name is Jeff Gibby. I've worked here at MetaStock. I've worked here for 30 years in next March. Great company to work for. I love being here. And I use MetaStock extensively to trade. And I started here in Inside Sales. In the Inside Sales, if you had questions about MetaStock, you'd usually call me. I'd answer. I'd talk to you a little bit about how you're trading, what you're doing, and what you're looking to improve. That was kind of the whole job that I had. I did it for 10 years. It was fun. I really enjoyed it. I like talking to other traders. When I started at MetaStock, I didn't even know what a stock was. By the time I was moving on to kind of the other areas of responsibility, so I just seem to getting more here at MetaStock. But as I learned a lot about the market. For the next 10 years, because we're breaking it up into 10-year periods, yeah. And until now, I've been working with a lot of the partners. So the people that have come in and talked, I've generally had a chance to work with all of them. Greg Capra is amazing. It's really interesting how nice these people are and how much I've been able to learn by kind of helping them create systems and put them into MetaStock. And so I've been doing that for about 20 years now. And for 10 years, I've been our director of sales. That's all you need to know about me. What I want to do, though, today is I want to talk to you specifically with MetaStock. Obviously, we talked a lot about system testing yesterday. Kelly came in and he did a webinar or a session on how to do system testing, why it's important, why you should do it. He did a good job with it. Tomorrow, Scott's going to come in and he's going to talk about our patented forecaster and the tools that it's going to do and all that kind of stuff. What I'm going to do today is a little bit different. What I want to do is give you a few things that you can use, that you can take home with you, whether you're using MetaStock for a while now or not. Tools that you can use that are going to be helpful for you if you do decide to do a MetaStock trial, or if you have had MetaStock for a while. The thing about MetaStock that I've noticed is we've been developing methodologies in MetaStock, and we've been packaging them up, and we've been providing them for 32 years now. There's a ton of stuff in there that is very, very cool. The thing I like about MetaStock most is it's a product you're not going to grow out of. As you test ideas, as you kind of learn, as you kind of grow as a trader, MetaStock will grow with you. So what I want to show you today is a few of my favorite methodologies, a few of my favorite things in MetaStock that you can use that are going to be useful for you. And usually I kind of go out very ambitiously with the idea of showing you 3 things. I'm probably going to only get to 2 today, and maybe 1 a little bit later today. We'll see. So the first thing that I want to talk to you, a lot of the people that we've talked about have been talking about support and resistance. You're welcome, Bradley. Don, I've got your email address. I don't need it. Thanks for being quick on the trigger there. The first thing I want to talk about is a tool in MetaStock that'll help you find support, resistance, or trend lines. It's automatic. We call it the dynamic trading tools of MetaStock. This is one of the very first add-ons ever created for MetaStock, and we decided to start including it in MetaStock a number of years ago. It's in MetaStock. I don't remember what version that we included it in, but what it's designed to do is help you identify automatically support and resistance levels and trend lines. So I've pulled up a chart of the SPY, SPY. I've applied the template, and you can see exactly what we're seeing here. Okay, this is generally how it's going to pop up. What it's going to do is it's going to automatically label, and it's going to identify any support and resistance areas that it finds, any trend lines that it finds, and whether those are uptrend lines or downtrend lines, it'll find both. Okay, so walking through what we're seeing on the SPY, and don't plan on spending a lot of time showing this, but walking through what we're seeing on the spider right here. Here you've got this longer term resistance. We came up, I'm sure you all remember, and we're trading when we came up into this big shelf pattern that happened on all the major indices, where for months and months and months we hit this huge resistance area that just would not break. And it didn't. We basically came into a pretty big top. It came down to this trend line, and then it found support at the trend line and kind of moved up. When it finally broke through this resistance, we had a significant move up. Okay? And that's what you expect when you have, especially a really coiled spring that finally breaks through support or resistance. Okay, so right here, if I hover over it, it says it's a shorter term resistance level. You can see that it was here before that. You've got a longer term that's down here, and you've got some support areas. The support areas are in red. Any trend lines, it's finding a couple of trend lines that are in here. You've got a trend line that's pointing up right here and a trend line that's pointing up right here. And if we scroll out, we can kind of get a bigger view of maybe what it's looking at. Okay, very, very simple, very straightforward. When I apply this to a chart, it's going to show me where it sees support and resistance. It's going to do this automatically. It's easy to see. Okay, it's also completely written for you. Like, it's already drawing these lines, making it a little bit more objective. But since it's drawing the lines for you, it makes it so that we can find stocks that are breaking through those levels. So, and we do that, of course, we do that with scanning. The MetaStock scanner is one of the best scanners I've ever seen. It can scan for just about anything, including, with this particular scan, a breakthrough support or resistance. So let's just go ahead and we'll go ahead and open up the scanner here. I believe I ran a scan on the S&P 500. I had a little bit of a, yeah, I did. Okay. Let me go ahead and just open up the scan. So we came in here, go to the scanner. I found the DT support and resistance long-term. I ran it against the S&P 500. And since I've already ran it, I'm just going to look at the report. This was run a little bit today, a little bit earlier today on yesterday's data. Okay, I just ran it when I got in here. Now, this scanner is a little bit unique in the way that it works. Most of the scanners that you run in MetaStock are going to tell you, okay, it either broke through support and resistance today, or it's giving you a buy signal today, or it didn't. This one is a little bit different, and I like the way that it's actually written because it tells us how many bars ago we broke through support and resistance. So if I'm looking here, this is the support and resistance longer term scan that we're talking about. If I'm looking at this, we've got a list of stocks here, we've got the close price here, and we've got a number here under breakup. If I sort it by breakup, I'm looking for stocks that broke through that longer term support or resistance level. If I sort it on breakdown, I'm looking for stocks that broke down through a support level. Okay, does that make sense? What I'm going to do, obviously, if it broke about 853 days ago, I'm not that curious about it. What I want to do is scroll down here a little bit until I find stocks that have broken through recently, maybe like within the last 4 or 5 bars. Okay, and here we do have a couple of lists. We've got CrowdStrike Holding. It broke up through resistance about 5 bars ago. On the volume where it broke down, it was actually down about 23% that day. We've got ONIC. It broke up through resistance about 5 bars ago, 16 days ago, or 16% of the normal volume. EOG Resources, Fox, Altria, Palo Alto. You get the idea. These are basically, we're looking for stocks, and I like to find stocks that are breaking up through resistance. A good friend of mine, Vince Fora, if you're familiar with him, he'd always like to talk about stocks that were breaking out of previous highs or previous resistance areas, because once you break through that, you have a nice little support area. He particularly liked to find stocks that are making all-time highs and didn't have any resistance at all. So let's take a look at some of the stocks. I'm not going to spend too much time on this. There's another topic that I want to kind of migrate to, but I wanted to show this real quick to you. So let's go ahead and look at CrowdStrike Holdings. I'm going to go ahead and open up the chart for it. I'm going to go ahead and apply the template we were talking about just a minute ago. So what I'm going to do is I'm going to right click on MetaStock here if you use MetaStock and you want to do this. And I'm just going to go to the template that's called Dynamic Trading Tools. I'm going to go ahead and apply this. This one broke through what it found as support 5 days ago. You can see we started here. So 1, 2, 3, 4, 5. That's where the breakout happened. And obviously it's taken off since then. It's a really, really good example. Maybe I should look at ones that broke out maybe 2 days ago or 1 day ago, so we can find them when they're actually kind of going out. Now, obviously this is a really good example. Let's look at a 2-day one, and then we'll move on. Okay, let's look at, do we have anything that's 2 days? We've got PNC Financial Services. It broke 2 days ago. I'm going to open it on 30% less of the normal volume. So it wasn't very well volume confirmed, but we can kind of take a look, see if it's held above that resistance level, which it definitely didn't. I want to actually apply the template to this one too. See where it's kind of, you have this downward trend line that it's kind of keeps bouncing up again. Here is where it's finding the support. This isn't as great an example of the last one, unfortunately, but I'm going to go ahead and kind of take a look at the next one and see what Philip Morris looks like. This actually looks a little bit better. You've got this support area, this resistance area. It's broken through a few days ago. Here you're setting up right up on top of this. This looks like a fairly decent trade. If we decided we wanted to buy it based on the breakout, we've got a nice little resistance area that's now a support area where we could consider putting a stop. So very, very easily we can identify those stocks that are breaking out of new support and resistance. Donald says, please give the authors. Both of the books that I gave away, Donald, I will do this for you. He said, please give away the authors and the titles of the books that you showed. These are both by Steve Bigelow. And Steve Bigelow was a great partner of MetaStock. He died a couple years ago, but we actually did a lot of work with him over the years. We designed all of his patterns and that kind of stuff. In terms of people that have had an impact on the trading that I do, Donald, Steve Bigelow is probably the biggest one. Every day when we run a scan, I run a scan for his patterns. But the names of the books, Candlestick Profits, Eliminating Emotions, and High Profit Candlestick Patterns. So later today, I'll show a little bit more of his scans in a bit of a different session. But there you go. You're welcome, Bradley. Okay. That's just one of the things I wanted to show you. A lot of traders like to find stocks that are breaking out. I'm not an exception to that rule. I love it when stocks break through a support area, or I'm sorry, through a resistance area, because you have a nice support area. I always get confused because once you break through that resistance area, it becomes support. But when you find a stock that's coming up above here, I'd probably put it a little bit higher. It's still trying to break through this high before. If it does, this would be a nice support area for you to use. Okay, let me kind of change gears a little bit here. Take a deep breath. I feel like I have a lot of energy. And let's just kind of talk a little bit more about a different type of methodology. What I would like from you guys now is to give me some symbols. Give me some symbols that you would like to look at. We'll look at the next part of what we're going to be doing with your symbols. So the next methodology I'm going to show you is a methodology that's built into MetaStock, and it's been built into MetaStock, I think, since MetaStock 11. In fact, I'm sure of it. It's based on, it's a trend following methodology. It's based on the work of a great friend of mine, a gentleman by the name of Rahul Mohinder. Rahul Mohinder is a very, very popular trader in India. He's taught thousands of students in India. He was one of our all-time most successful partners of MetaStock. And back in, this was like 15, 16 years ago, back in the Gateway days, but it's just the area where the office was, he came into the office. Now, he comes into the office fairly regularly, maybe once or every year or so. I think he's overdue for a visit now. But one year he was in the office, I remember it really well. We said, hey, Rahul, what are you teaching people to do? Because with Rahul, his cells were just going up and up and up and up and up. And we talked to a lot of his customers because they would call us. We'd offer them support in their nighttime, and they'd offer support during their daytime. And we had a really good relationship with Rahul. We still do. I talked to him, I've got an email I need to answer to him after I get done today. But we're like, what are you teaching people? And what are you teaching people? They love it. The method that I'm about to show you, he showed us back then. This is the first method I ever traded my own money with. And it's a very, very simple methodology that I like to talk about. It's a trend following methodology. A lot of people say the trend is your friend, befriend the trend, a rising tide lifts all boats. You've heard all of the cliches, right? This is a trend following methodology designed with a few things in mind. There's a few reasons I have to show it. I believe that's on my next slide. It is. It's very easy to use if I do a pretty decent job, and I'm going to aim for decent today. But if I do a decent job of explaining it to you, you'll understand it. It's objective. In other words, we're not going to say, well, if interest rates goes up, this stock is going to be affected, and this is how it's going to be impacted. We're going to be looking at what the price is doing. We're going to be studying the chart. We're going to be looking at what the trends are doing and making decisions based on that, not what we feel. It works on a lot of different time frames. It works on a lot of different instruments. I've shown this all over the world. And usually what I'll do is like, hey, show me some instruments. It doesn't work all the time, but it works surprisingly good amount of the time. It generally tends to work best on the stocks that are trending. Okay, so there we go. Now, I've got a bunch of symbols here. Thank you, Dawn, and Bradley, and Neil, and Dawn, and the other Dawn. Okay, we will look at a few of these symbols, probably not all of them, just because I know I can see what time it is, and I know it's going to take a few minutes to explain all of the rules and make sure that I properly do the job. Since it's trend following, we want to be able to objectively identify the trend. Are we bullish or bearish? And when we start to talk about trend, there's going to be three different trends that we're going to talk about. Rahul calls it the primary or the prevailing trend. That's the long-term trend. There's also a short-term trend, and then there's an intermediate-term trend. The first thing that we want to do when we're identifying what we're going to be doing with the stock is we want to identify the primary or the prevailing trend. So let me go back into MetaStock. Let me close a few charts here, and I'll just open a few of the charts that you're interested in, or the symbols that you've given me, and we will just explain how this works. Okay, so I'm going to go to the chart. If you've got MetaStock, this is easy to do. If you do the trial, it's easy to do as well. Up here, I'm on the chart tab. I'm going to come in here and I'm going to type in Dawn. I'm going to type in SPY. I'll also do NVDA. There's a .O with the Reuters methodology symbology that is used by the data provider we use. I'm going to put in CRWV, and I believe that's a .02, but I'm not 100% sure. If it's not, I'll fix it in a second. And I'm going to do FCX. Okay. I'm going to change this to the template. The template that I want to apply is one of the Armo templates. And in MetaStock 19, we actually kind of cleaned up some of the templates to make them take advantage of the brand new charting engine, which is, we made them look more sexy, which I like. So I'm going to come down here to the right, Armo. The Armo trade model, if that's the one you've been using, you're used to it, it's the same one, but I'm going to do the shaded because it just looks a little bit nicer when I open it up. Okay, it's going to open up the SPY. It's going to grab the data for NVIDIA, CRVW, Freeport Morgan, and those are the ones that I selected. Okay, so right here we've got, we do need to fix the core weave. Oh, no, it says the data is good, CRWV.O. Okay, not sure why that didn't pull up before. We've got NVIDIA here, and we've got the spider here. Okay. All right, I'm going to get rid of the exit swing signal right now, just because I won't be talking too much about it right now today. The exit swing signal, there are actually, I will give a couple of tips in terms of how that's used. I don't typically use it in a lot of the trades that I'm doing. Okay. Let's start with the process. With Armo, we're talking about a three-step process. We want to identify, first of all, the primary, the prevailing trend. The way that we identify the primary, the prevailing trend when we're using Armo is using this indicator, which Rahul dubs the Rahul Mohinder oscillator, this indicator on top. Okay. The way that you read the Rahul Mohinder oscillator is very simple. If it's above zero, long term, the stock that you're looking in this case, the S&P 500 is bullish. If it's down below zero, it's bearish. Size and shape don't matter. He wants to keep this analysis, and the analysis that you do very, very simple. You're either above zero, which means you're bullish, or you're down below zero, which means you're bearish. If I'm looking at the S&P 500 right now, at the very hard right edge of the chart, we're bullish. Okay, it's above zero. It's been above zero since right about here. You can also look at the trend line at the very bottom of this chart. It's going to say that the Armo is bullish. Okay, if we come back a little bit, we did have a last April we had a little bit of a bearish zone. It went into a bullish phase about here. We pulled back. You get the idea. If it's above zero, bullish. If it's below zero, bearish. Okay, that's it. It's that simple. If it's bullish long term, we're allowed to buy. If it's bearish long term, we're allowed to sell. We're not allowed to go short if we're above zero. If we're bullish, we're not going to be betting against the primary trend. We want to trade with the trend because I was told it was my friend. Okay. So step one, we're looking at the general market. And in this case, we're looking at literally the general market, but we're looking at, is it going up? Is it going up, down? And in the case of S&P, if I'm making a decision today, we're above zero. So long term, we've been going up. We've been setting new highs. We're bullish. We're only going to be looking to make long trades. Step one. We come up to questions. We have a lot of stocks. Don says, cool. Then does it work on 5-minute bars? You can use this on any increment, any time interval. Okay. Step number 2 has to do with the shorter term trend. Okay, so we looked at the long-term trend. What we want to do now is we want to look at the shorter term trend. The shorter term trend is swing trade number 2 right here. It's the pink line. I'm gonna make this full screen so we can just look at this for a second. With swing trade number 2, it's a lot more erratic because it's looking at a smaller time frame, but we read it the same way. I want you to ignore the blue line for now. We're going to come back to the blue line in just a second. What we're looking at is this, I'm going to call it a pink line. It looks pretty pink to me. There's probably a more technical term than pink for it. Pink is fine. Swing trade number 2 is the short-term trend, this pink line. We read it the same way. If it's above 0, it's bullish, and we're still allowed to go long. If it's below 0, then we're bearish, short-term, and we're allowed to go short. It has to match the higher time frames, so if there's a mismatch, we don't trade. If one's bullish and one's bearish, we wait till they're both bullish, or we wait till they're both bearish. Okay. If they're both bullish, we can move on to step 3. That's where we identify the trade. Okay. Very, very simple. Okay. I'm going to recap though, because I don't know why. Right here, if we're bullish long term, you'll be able to see that we're bullish long term because the RMO up here will be above 0. Or you can look at the trend ribbon down here. It's going to say the RMO is bullish. As long as that's bullish, we're allowed to go long and we're not allowed to go short. If it's bearish, we're allowed to go short and we're not allowed to go long. Simple. Okay. The second thing that we're going to look at is this pink swing trade number 2 indicator. It's a short-term trend. If it's above 0, and this is above 0, we're still allowed to go long. Notice I haven't said we haven't traded yet. We're allowed to go long. Okay. If it's down below 0, we're allowed to go short as long as we're down below 0 here too. Okay. If they don't match, we wait. The other thing that I want to point out while I'm going through this is when this goes above 0, you can see it goes above 0 here. As long as it's above 0, the bars or the candles, this is set up as bars. I prefer candles, which we could change if we wanted to. The candles or the bars that you're looking at will be painted blue or red to match whether your primary trend is above 0 or your short-term trend is above 0 or below 0. So just like with the ribbon, the long-term ribbon, we can look at the ribbon down here. With the short-term trend, we can look at the price of the bars. So you don't necessarily even need to use the indicators. Okay. All right. I think I've exhausted that. If I'm unclear at any time, let me know. Let's recap. We're bullish long-term, we're bullish short-term. That means we're allowed to go long. But how do we get triggered to go long? That's step number 3. Okay. And it has to do with the relationship of the short-term trend and the medium-term trend. So the blue line that I told you to ignore earlier is actually the medium-term trend. The trick with the medium-term trend is we don't actually pay attention to whether that's below 0 or above 0. What we're looking at is a relationship between the short-term trend and the medium-term trend to give us momentum shifts. That was a lot, right? So let me explain exactly the way that Rahul says it. Okay, if we're in a let's call this a little bit of a bearish pullback that we just had. If we're in a bearish pullback, we're going to have we're going to go long short-term. Our long-term, we're going to go bearish, but our short-term indicator is going to start to swing down, right? Once that momentum starts to shift, it's going to turn around and it's going to start to go back up. And at a certain point, it's going to cross up above this medium-term trend. That point right here is right here, okay? Where that short-term trend crossed above that medium trend, it formed a buy arrow. When that happens, Rahul calls that a shift of momentum or a change of force or a change of direction. Okay. And the reason it generates a buy signal on the chart, which it did right here, is because that shift of momentum is a signal to go long, but only as long as you're bullish short term and you're bullish long term. Okay. So if I'm looking, I'm going to get in here a little bit closer. Okay. If I'm looking at the spider here, and if you remember this from back in March, I had a bit of a huge rundown. Everything was getting a little bit scary. We have this shift of momentum here. If I'm looking at the chart on this day using the Armo, I already know I'm not going to take a long, because long-term I'm bearish and short-term I'm bearish. And until that changes, that shift of momentum is going to be ignored. Okay. And so I wait. If we wait a little bit, now the stock has kind of recovered quite a bit here. But finally, we get that shift of momentum where this short term starts to get above zero. We start to see some short-term bullishness. Okay. If we wait just a little bit more, long-term we go bullish as well. Okay. And this happened right here on April 15th. Okay. Once everything gets into that favor of your odds, you can go ahead and take a long position. And there's some very, very specific rules about how to take that long position. I'm going to go through those, but I'm going to start a little bit earlier in time so that we can kind of go through the rate. Actually, I'll do it right now. Let me go ahead and kind of just zoom into this chart a little bit more. Just going to kind of get real close here. Now we've had, just to recap, we've had that shift of momentum. It happened over here. We finally went short-term and long-term bullish. We can now start to structure a trade. The way Rahul would have us structure a trade is right here. This is the bar where we're deciding, hey, things are looking a little bit more bullish because we're bullish long-term, we're bullish short-term. Let's go ahead and take a position here. Now, what Rahul will tell you to do is look at the high of the bar where that happens, which is right here, and the bar before, and he'll have you take a horizontal line and he'll have you put a line right above that. Okay, I just moved this line out of the way just so we could see what the high was. So what I'm going to say is if we keep going up, we'll go ahead and buy, right? So if we buy, we won't buy. He wants that additional confirmation that the stock is going up. We want to break the high of the previous 2 days before we buy in. If we buy, the other thing that he wants us to do is have a stop. This system or this methodology is going to use proper money management. So the way that we look for a stop, he says that he has a couple of ways. I'm going to tell you both. Then I'm going to tell you the one that I prefer. But he'll look at the low of this day, the low of the previous day, and you could put a stop there. It's a tighter stop. And if you did that, your stop would be right at about 686. Your entry would be right at about 701. We know if we get in at 701 and we have a stop loss at 686, we have a pretty good idea of what our risk is. There's, of course, stocks gap and that kind of stuff. We don't ever have an exact idea of what our risk is, but we have a good idea of when we're going to get out of the trade. Okay, we want to know this in advance too. The other thing that you can look at is Rahul will say, hey, okay, you can use the low of the last two bars, or you can look for a recent support area. And that's the one I prefer when I'm looking at the methodology. The way I like to place a stop is I will look for what is called a pivot low. And you may not be familiar with that terminology. It's very simple. A pivot low, what I'm going to look for is a low that's surrounded by two higher lows. So if I look at this low right here, we've got a lower low here and a higher low here. That's not a pivot low, right? If I look at this low, this is a higher low, and this is a higher low. This would be a pivot low. That is where I would initially put my stop loss in for this trade, okay? Which means if it goes above 701, I'm going to buy. If it goes down below 674, I'm going to get out of that trade, okay? And I do like the fact that we know that in advance, because if I know that in advance, I already have my line in the sand. If this trade isn't going in my direction, if this trade is going against me, I want to know where I'm going to get out before I'm sitting there and just going, hey, well, it's just a temporary pullback. It's going to come back. And then the next thing you know, half of your position's gone, right? Like it just doesn't come back. I want to know where my exits are. One of the things Steve Bigelow said that I always liked was you can always buy back in if you're wrong, but you can never go and sell earlier if you're right. So I want to game this out a little bit so I can show you how to move the stop losses on this. And then we'll eyeball a couple of securities. We're running out of time already. Going to go a little bit quicker. Okay. Let's pretend that we're looking at the SPY during the tariff turmoil years. Okay. So we're looking at bearish. We have a big pullback. If we were creating this, we probably would have taken a good chunk out of the trade. Okay. I'm going to go ahead and zoom in. And we're going to say that we were playing it right back here, just the S&P, just the major index during the tariff turmoil territory. You can see how many T's I can use at the same time. Okay, so if I'm watching this here, we have a shift of momentum to the top side, which we're not going to take because we have a bearish long term and we're bearish short term, so we wait, right? If we look here, we have a sell arrow. If I went ahead and structured a trade based on this low, we never penetrated that low. It didn't continue the momentum in the direction, and that's a good example of why I want it to keep going down before I sell it. Okay. The very next day, we have that shift of momentum again to the top side, but again, we're bearish, both long-term and short-term. This should be easy to read. Okay. A few days later, we pop up, we start to get blue bars. That indicates that we might be seeing some more strength. Okay. But we're going to wait until it's bullish long term. And when everything matches up, which is right here on this bar, this is where we're going to structure that trade. Okay. I'm going to go ahead and kind of make this a little bit bigger, just so we can kind of play with it. I'm also going to get rid of the lines I drew before. So if I'm playing with this right here, and this is where I'm looking to start to buy, if I look at the high of this bar and the high before it, we can call that our entry point. If we could pop up above this one, which would probably be after this gap. Okay. If we look for where our pivot low is, it's going to be right there. Okay. So before I buy, I know why I'm buying. I'm buying because it's bullish. I'm buying because it's bullish long-term and short-term, and because we have that shift of momentum. I know where I'm going to get in as close to this as I can. I know where I'm going to get out if it ever goes down to this level. And remember, we can always get back in again because we're going to be wrong. The idea isn't to be right or wrong. The idea is to put the odds in our favor. Okay. We do end up crossing right here above that level. So we did get in before the gap and that started to move up on us. Okay. Very simple. This is what we want to see. We have a shift of momentum here. And when that happens, as long as you're bullish long-term, as long as you're bullish short-term, which we are in this case, we continue to watch it. Okay, because that happens. Market goes up, comes back down, goes up. It doesn't go up in a linear line. That would just make it too easy for us. It generally goes up a couple steps, down a step, up 3 steps, down 2 steps, up 4 steps, and then sometimes takes the elevator down. All right. So in this particular case, when we see this, we're going to stay in here. Okay. Right here, we get another buy signal. Okay, so we've had that shift of we've come up a little bit, we've pulled back enough to give us that shift of momentum, and now the bulls are taking charge again and they're pushing it up again. When that happens and you get that shift of momentum, there's 2 things you can consider. One, you should always do. The second is up to you. The first thing that you should always do is we've had an up move now, we're in a long position, we want to lock in some profits. And so what I'm going to do is I'm going to move my stop. And the way I'm going to move my stop is the same way I said it in the first place. Here's the buy signal. Here's that pivot low, the low that's surrounded by 2 higher lows. I'm going to put a stop right there. Okay? I'm going to lock in some profits. Okay. The second thing that you can do, which I rarely do, is buy more. You can actually stage into that position, which is up to you. What I'm doing here is I've bought here, I'm locking in profits. Okay. I expect the market to go up. I want it to go up, I'm long, but if it decides to not go up, I'm going to lock in some of those gains. Okay. We come up, we pull back a little bit, you have that shift of momentum, and what are we going to do? We're going to go ahead and lock in those profits right there. Okay. Now, depending on where we put that line, you see it came down here, and it either bounced against the line. If it bounces off the line and keeps going up, you can always buy back again, right? But it comes up, we get a new buy signal here, we move our stop to here. Actually, it's the same place it used to be, right? We get a little bit of a pullback. We get another buy signal. We move up our stop. and it becomes fairly easy to maintain. We're happy. This thing is making money for us. It's moving in the right direction. And as it starts to get shallower, we're going to just kind of keep tightening our stops up. We'll move it here. We'll move it here. We'll move it here. And here's where we're probably going to get out of that trade, right here where we put the stop in. Okay. Now, we could continue to play this out. I don't have time. What I want to say, though, is just looking at this trade, we would have bought at 567. We would have sold at 654. One thing I want to point out, we'll look at NVIDIA, but from a much kind of more bigger view. One thing I want to point out is this is a trend following mechanism. It's never going to get you in at the exact bottom. It's never going to get you out at the exact top, unless you're really lucky. But for the most part, what we're looking for isn't to be 100% correct. What we want to do is find those stocks that are making good trends, that have moved for a long time. And what we want to do is to be able to capture large parts of those trends. Another friend of mine, the late Robert Deal, would always, he was the son of a preacher man, and he'd always talk about pigs will make money, or I'm sorry, bulls will make money. Bears will make money, but pigs will get slaughtered. When we get into trades, we want to leave our ego on the side. We don't care if we're right or wrong. We want to be able to get out of the market when we're wrong. We want to take advantage of the positions that we have that are right. We want to be able to take those losses because we're going to have them. What we want to do when we're trading, no matter what methodology you're looking at, is we want to be able to maximize our opportunities for being right. And when we are right, we want to take advantage of it. And when we're wrong, we want to cut those losses quickly. All right, let's look at NVIDIA real quick. Holy crap, an hour goes fast, doesn't it? So we've got NVIDIA here. NVIDIA, we've had some, I'm going to kind of move this out a little bit. NVIDIA, we've kind of had some bullish, bearish, bullish, bearish, bullish. If we're looking at NVIDIA, NVIDIA's had some pretty incredible runs up until the end of last year. You can see, well, all these bullish places exist on the chart. If we're looking at kind of the hard right edge of the chart, we've had another really good run on NVIDIA. We've been bullish since right about here in April. Price has gone from about 180 to about 220. I would argue that if we were looking at just taking long string that time period, it would work well for us. Okay. What we want to avoid is we want to be able to find stocks that are actively trending, because if you have stocks that are just kind of range bound, you're just going to get whipsawed using a trend following system. So maybe a tidbit of advice would be to find stocks that are actively breaking out of support and resistance. I tied it back into the first part. I feel very, very creative with myself here. CRWD, let's take a quick look at this. Again, we've been pretty choppy. We started to break out here. Yeah, I don't love that, but I don't hate it either. FCX, this is where it really kind of starts to shine. If we're bullish during a move like this, and we're just looking at maximizing our profits and taking them out, that's where this is going to really, really shine. So net is right this minute okay up to go long SPY. If we're looking at SPY right now, and we're just looking at the methodology for Armo, okay, because I'm not going to tell you to buy something. But if we're looking at it, when we got, here is where we would have looked to get a bit long. Okay. Right now, Don, the way I read this, and this is just the way I read it for legal purposes, the way I see this, we've kind of set a new pivot high. You see this high that's surrounded by two lower highs. It's pulling back. You're about to get a shift of momentum that comes in here to the short side. That may or may not be short-lived. If we get that shift of momentum positive and we're still bullish and bullish, that would be a good time to go long. Right now, we're pulling back, and until we start to kind of move forward again, I want to buy into strength. Right now, what I see with SPY is a little bit of weakness. We're bullish long-term and we're bullish short-term, but we're pretty well into this trend, and we're kind of in a pullback, which tells me that very, very soon, we're going to get a shift of momentum to the short side. I wouldn't buy SPY right now. I'd love to buy it right here where we got the actual signal where it all worked out, though. So there you go. All right. Thanks for the question. I'm going to have to wrap up. Let me check to see if Price is here real quick. He is. Yay. Okay, good. Really cool methodology built straight into MetaStock. We kind of talked about it. There's another thing that I usually like to talk about. It's called Haguro. I told you I wouldn't get to it today. All right. The reason I like to show that, again, there's so much I could show you in MetaStock. With MetaStock, there's literally 200-300 systems in there. It's been rated the best software in its price category. It's been rated that way for 33 years in a row, which is 40 more years than I've worked here. It's got so many great things that are in there. We talked about scanning. You can scan Armo signals too. You can scan for breakouts. You can scan for gaps. There's hundreds and hundreds of systems. The reason I like to show you Armo and the dynamic support and resistance is I want you to understand there's things that you can get to know early on that are going to be beneficial for you. I love how seasoned MetaStock is, because when you get into a trading software, you get into it. And with MetaStock, it's not something you're going to grow out of relatively quickly or at all. I've been using it for 33 years and I still learn things on almost a daily basis. Oh, that's in there? Oh, I can do that with it? Oh, this is how I do that? As you grow as a trader, it's going to grow with you. You're not going to grow out of it. It's not a platform that's been around for a couple of years that just barely has a few bells and whistles that they could put on a bulleted point list. There's a reason it's been established and rated and so highly for so many years. So I want to talk a little bit about the pricing. We have two versions. We have MetaStock 20. It starts at 220 real time. And these say 19 on them. I don't tell Kelly. They should say 20. But the pricing hasn't changed. It's $210 a month for MetaStock real time and $75 a month for the what's called the daily charts. They both have data that updates and streams and is available and streams in through the day. With real time, you can get full real time and you can get news from Reuters with a package that's available through London Stock Exchange Group that's called Workspace. And if you love news or you like good information or you like good data, you love the data and the news that's available with it. For $210, you're going to get all of the software that I just showed you, all the software we've been talking about all week, but you also get a software they've spent over $1 billion implementing and designing that just does news and broad market and all that kind of stuff. We didn't talk about it yet, okay? But it's included in the price, $210 per month. If you're more interested in a streaming solution that has delayed prices, the daily chart solution will offer for the ability to do the scans on a daily basis. It streams all day long, meaning you don't have to wait till the market closes. It doesn't have the news, but that's why it's a lot cheaper. We're not have to pay to provide all of that real-time Reuters news, which hedge funds and mutual funds pay a pretty penny for. So if you want the DC version of MetaStock, it'll only cost you $75 per month. It'll do everything I just showed you, and it'll sit there and update real time. There's a ton of stuff. This was a little bit later in the week. I'm going to talk a little bit about the Ichimoku method. It's built into there. There's a gap identification system. There's a system that was put together by Michael Murmer. We talked with Jake Bernstein, and he talked about his expansion contraction indicator yesterday. When we set you up for MetaStock, we want you to succeed. This is a subscription, so you pay $75 a month. We want you to keep paying. We want it to be helpful for you. And we realize that if it's helping you make money, whether you're paying for the real-time version at $210 a month or the end-of-day version for $75 a month, if it's helping you make money, it's going to pay for itself. So what we're going to do is we're going to do our very best to make sure that it works well for you. So the first thing that we're going to do is we're going to set up an onboarding meeting where we sit down with you. We're going to have a rep walk you through the software. They can answer questions. They can show you how tests work, scans work. They can show you anything you want, really. And they if you don't know what you want, which is the case for a lot of us, they'll give you a generalized tour to just make sure you understand how to use the toolbox. And it is a toolbox. In addition to that, if you have any questions, you'll have support. You can give us a call. We'll be happy to help you. What I want to say is with MetaStock. Oh, here's the correct pricing slides. They're in there. They were just a little bit later. What we're doing as part of this is if you pay for a month, we're going to give you 3 months. So if you do the DC version, it's $75. It's a delayed chart. It updates on a 15-minute delay. It gives you global access for anything in the world that you want. $75. If you pay for a month, we'll give you the second and the third month for free, which means it's like $25 a month. I guarantee you're paying more in gas as long as you leave the house a little bit right now. So for about $25 a month, you can use MetaStock. June, July, August till August 19th, the end of summer. During that time, you can play with it. If it's helpful for you, which if you use it, it's going to be. If it's helpful for you, you can keep it. If it's not helpful for you, you can just cancel. And there's no commitment to keep going. So with that MetaStock 20, you can either do the real time or the end of day. You'll get the data of the region that you choose. With DC, you just get global data. You get that white glove, you get the unlimited support, you get all of the systems that we've been putting into MetaStock for 30 years. Try it out. There's a reason it's been rated #1 for 33 years in a row. There's a reason that I have customers that have started using MetaStock before I started here 30 years ago. There's a reason I run a scan every day to find the stocks that have the opportunity, because I want to ignore the stocks that don't have an opportunity and focus on the ones that do. So you can do this in a number of different ways. You can give us a call, 800-882-3040. You can go to metastock.com/sales-chat, and you can ask questions. You can go to metastock.com/conf-promo. And I'm just going to take this. I'm cheating a little bit, but I'll put it in the chat box for you. So you have this information. You can give us a call. Give it a go. If it's something that works for you, it's going to work, and it's going to continue to work, and it's going to pay for itself, and you're going to be happy with it. If it's not something that's helpful for you, it's $75. But I'll tell you, I wouldn't trade without it. It's the way I find the trades that I'm going to be looking for, and you should give it a try. Okay, so that information's all in the chat. If you have any questions, if you need anything, let us know. And I do see there's a couple questions that came in. We do not do brokerage. We do not do prop trading. We focus, Pernend, thank you for the question too, by the way. We focus on providing you the right stocks at the right time with the right methodologies to trade. Focus on what you're good at. That's what we do. Dawn says, makes sense. And after I wrote above, you taught us further, I realized. Okay, cool. All right, that was me. Dude, my hair is doing something weird after the gym. It's all right. I don't care that much. All right, a couple things. All of the stuff that we're talking about today, you can go to metastock.com/conf-promo and do. All of this information's in the chat. Give it a go. If it's helpful for you, or if you have feedback for me, if you have questions for me, feel free to reach out. I love to hear the good comment. I love to hear the good comments, but anything you want to say to me, you can email me. I'd be happy to listen to it. I love getting good feedback from people that have been using MetaStock for a while and that it's helpful with, because I know how much it helps me in finding and identifying and placing those trades. So as we move on, I want to say thank you to Stocks and Commodities Magazine for sponsoring the event today. You can find out more about Stocks and Commodities at traders.com. They've been great sponsors of the event. They've been sponsoring us. Sean, Jason, don't ever start saying names, because then they immediately, all of the gentlemen that we work with over at Traders, Barbara, Star, everybody we work with over there has been fantastic. Love working with those guys. And www.traders.com, you can get a subscription there. If you haven't yet, join the Traders Forum, thetradersforum.com. I love that place. It's been a little bit of a pet project. We're growing the membership. We're up to about 1,600 or so members. We do a lot of fun stuff there as well. And you can join for free at thetradersforum.com. So our next guest is another good friend of mine. We got Price Headley. Price Headley has, I remember when I met, Price Headley is actually the first person that I developed algorithms for. I moved from sales to business development. I called Price and I said, hey, I love the work that you do. Let's put some of this into a scannable format and make it available for MetaStock. At that time, Price was Top Market Timer Digest. There's I don't know if they do it anymore, but there's a market digest where you could email your trades to. They'd keep track of them and they'd say, here's the best timer for the year. And Price won that a number of years. Since then, he's been in, I don't know if he does that anymore. I don't know if anybody does that anymore, but he's also been inducted into the Trader Hall of Fame. If we start to talk about people that traders have had a big impact on the way I trade, Price is definitely one of them. And I'll say that in a positive way. He's had a good impact on the way that I trade. So without further ado, Price, are you here?
Hey, Jeff, how's it going?
Good. Welcome to the room. Looks like I ran over my time. Sorry.
You're fine. Bit. No worries. I'm trying to get used to this new GoToWebinar platform here, so let me make sure I can share my screen with everybody. It looks like
it's going to ask you to now.
Oh, there it goes. All right, let's make sure you tell me if it's coming in loud and clear. Let me know if you can see it okay there.
Mm-hmm. I can see it. I can hear you.
Perfect.
I think that's my cue to get out of the way. Your turn.
Thank you, Jeff, and good afternoon, everybody. Price Headley here. Thrilled, like Jeff said, I've been working with Jeff and the MetaStock team now for, it feels like about 25 years. We started working together not long after I launched Big Trends in late 1999. All about codifying, any given idea that you have, any edge that you want to develop, and of course then systematizing it with the MetaStock charts. One of the hottest optionable trends out there is zero DTE, 0 days to expiration options. Now this is not widows and orphans strategy, right? This is aggressive, or some would say highly aggressive approach that should really only be used with the, kind of starting a small amount of risk capital, getting comfortable, and then you can scale it as you start to see how well this can work for you. But we're looking for up to 500% winners in the same day, on the last day of an options life on zero DTE trades. But we don't just ride it blindly. We were looking to also get risk money back quicker than that, and then let the rest of the trade run. So we're going to walk you through how that works today. So without further ado, let's get it rolling. And just as we get started, remember the information provided in today's presentation is based on our proprietary research. It's intended for illustrative purposes only, should not be considered specific advisory recommendations here. As you know, stock and options trading have large central rewards, but let's face it, they have large central risk. This is definitely a higher risk, but a much higher reward, kind of a trade-off on the zero DTE strategy I'm going to teach you about today. Remember, the past performance of any trading system or method is not necessarily indicative of its future results. We all know future results are going to vary. What you cannot allow to vary is your ability to be consistent in your execution. So that's a big part of what we're constantly preaching at Big Trends, is how do you make sure that you can keep on executing after a losing trade or after a winning trade, and not getting too high or too low, right? Really managing your emotions, managing what can be the volatility of trading, and especially the volatility of options trading, right? It's a reality. And so we just always want you kind of going in with that reality in mind, and really being just frankly trading small when you're getting started, so that you can, any mistakes you make, you can keep your mistakes small in their impact, right? If you view this starting point, if you start to trade options as a learning journey, then you're like, okay, that you're getting educated even from trades that you make initially. But trading small, you're getting educated for a very small tuition, rather than people that go hot and heavy and go burn themselves out or blow themselves out, right? We don't want that. We want to keep you in the game for the long haul, even as we're trading higher leverage strategies like this. So we're going to talk about this. This is our newest strategy to our Big Trends community, zero DTE options trader. We're going to talk about buying same day options that are going to expire by the end of the day on the QQQ, the NASDAQ 100 vehicle, which of course has been the dominant leader when it comes to AI, when it comes to artificial intelligence. Its number one holding is NVIDIA. NVIDIA, as you know, has been a monster to the upside. And so it's all about saying, okay, how do we get a piece of that? And if you've missed a piece of that, this is a way to kind of get back on when things start to trend either up or down. So we'll walk you through, I've been trading 37 years, so walk you through how these trades have set up when they work. We'll also remind you what happens when they don't work. And so we do like to always talk about both sides of the coin here. And so we'll then reveal our zero DTE options trader, how you can start getting these trades in real time, not long after the market open on a given trading day, when the setup is right. We don't trade every day. We only pick our spots. If you don't know me, I'm trading options for 37 years. And so basically launched Big Trends back in November '99, now in our 27th year serving our Big Trends community. It's all about education on the front end, and it's about a systematic approach. So you gotta be really focused on how to implement systems consistently, and that's what we're going to talk about. So let's talk about some recent winning trades we've just had from earlier this month, and then we'll go into more detail on how the zero DT options trader works. Now, this was a particularly fun one because it got our 500% target on the same day back on May the 12th. We're talking about 1 week ago from today. We're going back to last Tuesday. Last Tuesday morning, and let's talk about the time frame here. So we've got 5-minute candles here. Okay, this is the shortest term candles that we'll go down to. It's one of those that you have to be just very careful about. Saying you've got a meaningful amount of activity in each candle. And obviously with the Qs, you're talking about one of the biggest vehicles. That and the SPY are like the biggest vehicles out there from a market, especially in options, from a market-based approach here. So a big part of what we're looking at on this chart is, first of all, what happens in the first several candles of the day. We call the first 3 5-minute candles between 9:30 each New York time, Wall Street time, and 9:45 to be what we call our opening range definition. And so what you see over here on the left, let me mark up our chart a little bit. So that first low is put in. You can see the lines only start to extend after the 3 bars are in play, but you can see that first low's in there, and then I've already overmarked the high here. So basically, if you look at that and say, okay, first low's in there, but you can see also that indeed the high was 710.18 right there, but actually that high right before it, right around 710, was the high that we're looking at from that third candle of the day. Okay, so we've got a couple other lines on this chart. One is called the volume weighted average price indicator, or VWAP. You may have heard of that. So it's looking at not just price action, but also volume. And volume is shown down below in the green bars. And green is important to us. We need to see a green bar that actually breaks above its recent average, which is the black line on that second panel. So if it's below that, it's gray. If it's above that, it's green, telling us bigger than average volume. So we've got to see bigger than average volume, and we've got to see in the next 3 bars after the first 3 5-minute, first 15 minutes of the day are under our belt. The next 15 minutes are where we must see a break outside of that range combined with our moving averages. In this case, that's to the downside, right? You see that we close down below the low that was made there right off of the open between 9:30 and 9:40. We had the low in place. And that low was about 706.5. So then it closes down there about 706, and we're saying that's a place where we want to buy puts, because we're saying once that range is established, the question is, who's winning the war between the bulls and the bears, right? Are there more sellers coming off of that open? Whether it was a gap up or down open doesn't matter to us, but what matters to us is, are we seeing then the proper follow through after the open, right? Are you seeing continued selling pressure after the open? That means institutions are probably going to be feeling pressure to sell more and hedge more on the downside, right? Which puts downside pressure on the market that day, typically. And then on the other side, of course, it was breaking out to the upside. The institutions are feeling the pressure to get long more because institutions, they're like you and I in that they want more of a good thing, less of a bad thing, but they're often graded differently than you and I grade our portfolios where we up or down that day. They're graded compared to the average, right? So if they're sitting on too much cash, the market's going up, they're falling behind their benchmarks, right? That's basically the benchmark. I know some friends that are money managers that are literally compensated based on how they perform versus their benchmark. One friend of mine made a multi-million-dollar bonus one year for being only down 10% when his sector that he was benchmarked against was down 40%. So he crushed it against his sector, and he was actually down on the year, right? So that doesn't quite make sense, does it? But yeah, when they're dealing with that kind of money, that extra outperformance can make a big difference for a mutual fund. So bottom line is that, okay, this is a different mentality. When you understand that, you start understanding why does the market tend to keep going to the downside when it breaks down, and why does it tend to keep going up when it breaks out to the upside, right? That pressure is on both sides for those who are leading the market. Let's face it, institutions are driving the market. Okay, so that's, before we get into the charts, kind of the overview philosophy of, like, we want to follow that money. We want to follow those whales and sharks. We don't want to be fish food for them, right? We want to say, no, we want to stand in front of them. We want to actually tail behind them and be happy to still pick up plenty of opportunity going where the next feeding opportunity is. So bottom line is that this is a downside play. Now notice, what do we buy there? We're trading in the neighborhood about 706. And that day, these options are, this was May 12th, these options are going to expire at the end of the day. And the Q options, that, by the way, keep trading until 4:15. They don't stop at 4, they keep trading until 4:15. But still, we're wanting to be out well before that. So we buy a 702 strike put here. We'd like to get them for $1 or less. So here we pay 88 cents. That's $88 on each contract to control 100 shares of stock on the Qs. Now, if you bought 100, or in this case, sold 100 shares of the Qs, that would generate $70,600 in proceeds, right? So you're controlling over $70,000 of the Qs for under 100 bucks. So right away, you can see theoretical 700 to 1 leverage. I mean, that's pretty insane, right? You're not going to get all that because, of course, there is time erosion that we're dealing with, and we have to manage that carefully. So what do? First things first, before we even talk about making money on our profits, we put in a 50% stop loss. Okay, so right away we're saying if we're down 50%, we will say sayonara, bye-bye, we're done, not going to be participating thereafter. Okay, so that's the first rule. Then we say, okay, how can we make many multiples of that 50% risk? Okay, so what we do is we say, okay, we're going to do two things. We're going to seek to get our risk money back as quickly as possible within reason, while still having some meaningful contracts left to let run to potentially much bigger. And you see our profit target, 500% is our ultimate profit target. So on what we paid, right? So you do, that means a 6-bagger on the 88 cents we paid, right? So 6 times 88 cents puts you up in the neighborhood of about 5 1/4. Okay, 528 as it turns out here. So, but you see, we did something first. And by the way, when we got into this trade, look what happens initially. Initially, we get a reversal move at first against us, right? So we were down probably 40 some odd percent, right? We probably got close to our 50% stop loss there, but we did not get stopped, right? So this is the trade-off of, right, how do you be careful about not putting too tight of a stop where you whipsaw yourself out of a good trade, and at the same time putting yourself into a position where you can still say uncle and move on, but also then still be around when it does go the way you thought. So here our rule is sell at least 2/3 of our position for a 50% gain. That creates a free trade. If you do the math, you know, in the old days, I would just go for a double on half and say, well, that may be too long to wait and we may not get there sometimes. So we say, okay, how about we sell 2/3 at a 50% gain? And then what that does, it gets your risk money back. If you put in exactly $1,000, it's up 50% to 1,500. You sell 2/3 of your position, 1,000 of your 1,500 that you're at, and now you have 500 left. That's a free trade, right? Once you get your risk money of that 1,000 back in your pocket. In this case, we sell a little bit more than 2/3 because we bought 11 contracts. And so we're using an example here of if you put in $1,000 a trade, you can do it with less, you can do it with more. So the idea here is, okay, in this case, we're saying, look, we put in bought 11 contracts, $88 a piece. That's what, $880 plus another $88. We're pushing up into the $964 investment. Plus your commissions. Remember, commissions should be no more than $1 a contract on each side. Some brokers aren't even charging commissions on the back end, on the closeout side. So, and to get more active, you can get your commissions well below $1, sometimes down to 50 cents a contract or so. But anyway, point being that yeah, we like, you know, to go ahead and say we want to buy options. We're not doing spreads here. We're not doing option selling on the front end. We're saying, look, we just want to buy an option that we think can take advantage of one of the things that attracted me to options in the first place, which is the asymmetric leverage, meaning that we can make many multiples of our risk, right? When you buy an option, the most you could lose is what you paid for the option. In this case, $88 per contract of risk. But we're expecting to make multiples of that when things go the way we anticipate them going. So, and they did here. So we obviously made a lot more than our total risk, and even, of course, even more than our 50% stop loss risk that we're really putting on intraday here. So the point is, look, we bought and then we sold 8 of our 11 when we could get our risk money back at a 50% gain. We actually got a little bit more than our original investment back, 8 times $132 a piece when we paid $88 a piece. So you can see we're making in the neighborhood of about was that 44 cents, 44 bucks per contract times 8 on those first 8. But the more important point is that we're getting your original risk money back. 8 times 132 puts you into the neighborhood here of about $1,050, give or take, that you're taking out on those first 8 contracts back into the safety of cash in your account, right? We paid $960 for, and so we're getting out for essentially about an $80 profit, even if the other 3 contracts went to 0. So we want to give that trade a chance to run until it either does one of 2 things. If it gets to a 50% loss on the remaining 3 contracts, if we gave back that profit, then okay, that would be one potential exit area. But in this case, we're shooting for a 500% gain, because when we're right, we can turn into something that's really right. That's been the history of classic trend trading, is that often you're right longer than you expect, or you're wrong longer than you expect, right? So we need to cut and run quickly enough when we're wrong, but at the same time, let part of our trade run. You can see this was a day where last Tuesday where the market just kept on trending down. You can see we stayed below our other trend lines, but the key is that we had a plan to take it out when it hit our target profit of 500%, 6 times our original investment at $528 a contract, right? So those last 3 contracts generate $1,580, give or take, right? Of the $1,672 we made in total, right? So you can see here that the vast majority of our profit is in the final third, or like 27% of our original position here with 3 out of 11 contracts, right? So the idea here is that you want to give yourself a chance to let that trade run. You should not be trading scared, right? I know a lot of people that are trading scared who don't do well because they just whipsaw themselves out. They lose conviction. They don't stick with their plan because they're nervous. So that means either you're trading too large, or else you just haven't developed a conviction and a belief in what you're doing yet. So for new subscribers, I'm always saying start really small. Of course, we'd want to see you have at least 3 contracts in this type of a setup, so you get the chance to potentially sell 2/3 of those and keep 1 to let that runner run. Because you see that last contract profit on those final 3 contracts was $88 turning into $528, amounts to a $440 profit per contract, right, on the original $88 invested. As it happened, we got out right near the lows. Now we don't try to be exact and say we're going to call exact tops or exact bottoms, right? We are happy to leave something on the table for other trend followers who may see opportunity, right? But our system said we should go ahead and let this thing run to the 500%. That's why we don't shoot for more than that. As you can see, the market had a massive reversal that came back not only above the trailing moving average, the VWAP line. You learn about all these settings and stuff when you become a subscriber. You see as it started to rally back up, it had some trouble at that VWAP line, and then as it cleared that, it ran all the way back up to our opening range low point, which was pretty amazing right near the end of the day. So that's the other advantage. If we had bought and held into the close, we'd be dealing with a wipeout, right? You've got to be proactive. But the key is that we got the volume confirmation here in green. If we hadn't gotten the volume confirmation with the breakdown, we would not have taken the trade. And once we're past that first half hour or so, we're not going to be messing around with a trade. It needs to break down or break out early enough. That trade generates $1,672 in profit minus a $22 maximum commission, $1,650 net at least on one single trade. That was just last Tuesday. Here's another one from the week before that, May 8th. Now we've got a bullish example here. You can see the market started off just under 700. 699.5 was a low, and you can see here that it started working its way higher. You see that first opening range high was in the neighborhood of about 702.5. You can see we blast through it on the 4th 5-minute candle. That would be at 9:50 a.m.'s close. That we actually close there well above it. Now, we don't try to wait for a pullback to the support VWAP lines, to the opening range lines. We just say, get on in that trade. And this is another important point, is that when we get a signal, we fire it out as quickly as possible, not just through real-time emails, but we also encourage subscribers, especially with the 0 DTE approach, to get on the text alert list as well as part of your subscription, because then you're going to get instantaneous updates when it's time to get in, or if anything changes where it's time to get out. So we get subscribers in quickly. You can see that trade pauses over that next 5 to 10 minutes, but then it's pretty much off to the races, right? And you can see that literally within about maybe was that 7 candles, that'd be about 35 minutes later, we're already getting target 1 achieved at the 50% gain, right? So what do we buy? We bought the 707 strike calls here. We paid, as you can see here, about 67 cents. So we bought 14 contracts on $1,000 worth, and then we sell 10 of those 14 when it goes up 50% and change at $1.01, right? 101 bucks a contract, exited. So we're getting our $1,010 back compared to our original about $1,000 invested there. So now we got 4 contracts left. We let it run. Now you can see what starts to happen here is that we don't get to our 500% profit. Maybe up at these first highs, it might have been up pushing a 300% profit, but then we're losing a little bit of time, right? We've got a 707 strike. We bought them when the Qs were maybe what, 704, about 3 points out of the money. You really get paid well in options when you go from somewhat out of the money to somewhat in the money, right? Because of course the at the money option is the one that holds the most time value, even on the last day of the option's life. So it's just a question of how close you're cutting it to the end of the day. We usually say by the time we hit 3 o'clock, which is 1500 military time, right? That's 3 p.m. Eastern. We're saying that is a place where we're just comfortable enough to say, let's go ahead and shut this thing down. It's around 710. We're selling our 707 call. And actually, maybe we got out a hair before that, maybe closer to 709, because it should have a little bit of time premium left. We're out at 243. Okay, so we're out there. Yes, it did rally a little further. We could have made more by the end of the day, finished close to $4 intrinsic. But hey, you can't be a perfectionist. That trade still generates $1,044, and it gets you out as a subscriber with room to spare an hour before the QQQs close, hour and 15 minutes before the QQ options finish trading at 4:15. So we're around that 3 o'clock time stop, 262% on that last runner piece. Okay, so you start getting a feel for how dramatically these moves can happen in very short order. So you say, what is 0DT Options Trader? It's an alert service in real time, getting in the morning, getting out no later than 3 o'clock in the afternoon, running for the first target to get your risk money back at 50%, and then shooting for as high as 500% gains or the time stop exit at 3 o'clock, and then also the 50% price stop. So opening range breakouts, a lot of people will look at the first half hour. We think for this strategy, that's too long. We feel comfortable with the first 15-minute range to be defined. And then we filter it with the volume weighted average price, or VWAP, as well as the volume being stronger than average on that breakout, right? So you don't want to see weak volume on a breakout. That's more likely to become a fake out. We're looking for a super strong potential here. So with this understood, we're saying, okay, so we're going to trade the same day options. We know that, yes, there is risk because we're talking about out of the money options. That's OTM, means out of the money, usually because, hey, the Qs have been volatile, right? I mean, we've seen even today, the Qs trade down in the early going. Of course, today we kind of chopped around too much in the first half hour, so didn't give us a setup today. But then we chopped down initially. Now we've rallied all the way back up to yesterday afternoon's highs on the Qs. So we've actually had a pretty volatile day with about a 10-point range from 696 to just having tagged 706 while I was starting off here today. So the point is, okay, plenty of movement in the Qs, but you still got to pick your spots and catch the trend days. That's where you really get paid. The chop days, you don't get paid as well. So the 5-minute time frame allows us to identify that first 15-minute opening range high-low, and then we catch the breakouts quickly on the next 3 5-minute bars after that first 15-minute high-low range is established, the opening range, we call it. So, and we didn't develop that term, opening range breakout, or ORB. You'll see a lot of people talk about that maybe on different time frames. But we're looking for that only one bar outside of that range, but it's on a close with strong volume. So you only need to follow this thing for 15 minutes each trading day and say, hey, they should send me a signal between 9:50 and about the latest you could get a signal is about 10:05 after the 10 o'clock bar closes. So, we'll allocate a couple minutes for the emails going out and text going out in real time. Bottom line is that, it's all about speed, and it's also about managing your time that you're following the market, right? We only want you having to follow this when we get a signal, and then you do two things. You set your 50% price stop and your first target on 2/3 of your position at a 50% gain. Once that's achieved, then you can set the 500% target on the rest of your contracts. Okay, and then if it hits 3 o'clock, you haven't gotten that target, you cancel that order and just say, go ahead and get on out at 3 o'clock when we send that reminder update to hop on out. So plenty of trade opportunities with this method here. So of course, same day expiration options, we're talking about, what frankly is the higher end risk area of the spectrum, okay, but with a lot more reward relative to our risk. That's why we're excited about this methodology here, because we're not just trying to take small gains here. That if you just take a small 50% gain on your whole position, you would basically kill the system's edge, right? Because even though we do that a reasonable number of times, you're paid by that runner piece that keeps on going, right? So we're looking at, that's where those outliers, those super strong trends, can move many multiples of what your original investment was. So we're looking for that, six-fold move compared to what we invest on the front end. 50% stop against that says, okay, look, we can still make a reward to risk of not just 2 to 1, but averaging out into the neighborhood of at least 3 to 1 when we get those two pieces out at a 1 to 1 and then a 6 to 1, right? 3.5 to 1 average when we get the 500% ultimate target. Average contract entry price has been under 85 cents, $85 per contract on the Qs since 2023. So like if you're buying $1,000 worth, that would average you in for about 11 contracts per trade. Now we're not trying to trade for maximum contracts. We're trying to trade for what we think is the right approach here to let winners run and then cut losers reasonably quickly, right? 50% stop loss, 50% first profit target on 2/3 of your position, right? We did that math earlier on why that gets your risk money back. And sometimes it'll be more than 2/3, might be 70 or even 75% of our position, depending on making sure we get our risk money back at a 50% gain on the first target, then running on the remaining contracts for the 500% final objective. With that understood, and you say not just picking and choosing trades, looking at all trades called out by the system since the beginning of 2023, a $5,000 model portfolio would have grown to over 30,000 gross, more than 25,000 gross profit, 25,736 gross profit. That's gross before commissions and before subscription investment. Okay, the beauty of this is it's not compounded, right? We could compound it and show it bigger, but we like using the more conservative, just fixed $1,000 per trade. Even as the portfolio is growing from 5,000 to 30, we're still using $1,000 a trade. So as your portfolio grows, your risk per each position you put on is actually diminishing in a growing portfolio, right? Now, $1,000 per trade, if it was a $30,000 portfolio value, it's just 3 1/3% maximum risk. Whereas, of course, we started out with 1,000 on 5. That would start out as 20% of the portfolio on the first trade, right? So we want obviously to reduce risk as the portfolio grows. We don't want you to be compounding your amount invested higher and higher on a run up, and then that means you'll just give it back that much faster when you do get a drawdown, right? We don't want that. We want to be more conservative. Remember, this is the past, so past performance does not guarantee future results. We all know future results are going to vary. Like what I said before, you can't allow your own approach to vary based on what happened on your last trade. You can't say, well, I lost on that last one, I'm going to stop trading it, or I won on that last one, I'm going to double up on the next one. That's gets you in trouble, right? You've got to be not reactionary. You got to just be consistent in your execution and your capital allocation. Okay, so that's the gross portfolio value as of through today on all closed trades, 30,736 before commissions and subscription investment. And so you say, okay, yeah, it's had its own six bagger, 514% gross profit before those commissions and subscription investment, which have all come down dramatically. So you get to keep the vast majority of what you earn these days. Now, our specific setup again is that we're looking for this high to low range to be coming in just the first 15 minutes of the NASDAQ 100 QQQ trading. Okay, so that's going to help us to say, yes, we want to really focus there. We're going to then look for, once we got that high and low range, we need a 5-minute close outside of that range on those next 3 5-minute candles. So at 10:50, 10:55, or I'm sorry, 9:50, 9:55, 10 o'clock closes, we're getting a breakout up, getting a call buy, or down, getting a put buy, if and only if on that breakout the volume is above average. So, and again, we give you all those settings of those rules of what are the averages, what are the parameters for volume weighted average price, and our big trends volume confirmation, BTVC is what that means, big trends volume confirmation. And then basically you see that, yeah, we're looking for those things to happen quickly, right? I don't know about you, but the best breakouts usually follow through pretty darn fast, right? You don't want to be waiting around or saying, Well, there was our high, and then midday it tries to break out. It's like, no, that's too late. It's just too. It's not getting that catalyst, that kind of surge that we want to see. The institutions really pounding the buy button, pressing the accelerator, or hitting the brakes and pounding the sell button, buying puts when they start to dump and continue to dump on the downside their QQQ shares, right? A lot of institutions will use vehicles like the Qs either to add exposure or to hedge by selling the Qs short, because they're not going to sell all their positions, that the institutions have to stay fully invested typically. So that's just a hedging strategy. Some of the hedge funds and other more proactive funds that have that ability can hedge with the Qs on the downside as well. So we think that's a big reason why you see these trends continuing. Let's look at some other prior examples in different market environments. One of the things you should notice on a good breakout, in this case to the upside, you can see that where we open is right near the low of that first 15-minute opening range there, where we make the highest highs. Those second and third bars are making a high up there in that about 607 area. Okay, you can see that then we're getting our breakout right behind that. Okay, so you see that we break out that very next bar, so we're buying right at the start of this bar right here. Okay, not the close of that bar, but the start of it, because the prior one was the breakout close. So you can see during that next 5 minutes, it actually dips down right there by almost maybe 3/4 of a point on the Qs. So sometimes you might even get a better fill when you're acting quickly right off of a breakout, because sometimes it can retrace, but we don't want to miss it, right? This one's one where we bought some relative cheapies, right? We were at 607, we bought the 609 calls. This was back on October 8th. And you can see that we bought those calls just a couple points out of the money for just under $0.50. And we might have said buy it at $0.50 or less, and maybe our average entry was 48 cents. So we always measure based on, in those next 5 minutes or so, thinking, okay, what were subscribers able to get at our maximum entry price or below? And so then we say, okay, we're in at an average of 48 cents. So right away, you get 20 contracts at 48 cents. You sell 14 of those 20, that's 70% of your original position. And there's your exit 72 cents. So right away, you can put your order in for selling 2/3 or more of your position at a 50% gain of 72 cents if you paid 48 cents. So obviously, if you paid 50 cents, you'd be targeting 75 cents, right? You can adjust based on what you get as your fill price, but you get the idea, and we guide you every step of the way here. So then you can see what happens. It does retrace after we get out of that first target one there, 50%. It retraces right back to the volume weighted average price point, that green line there. That's the one and only kind of test point of that in a monster trend day, where you see that we just keep running. And at 3 o'clock, in this case, closer to maybe, we got out closer to maybe 3:30 in this case. If we think that 3 o'clock we've gotten a lot of our gain, we don't want to give it back, we can get out there. We could take it to 3:30. We don't want to go past 3:30 at the absolute latest. You can see this worked out pretty nicely at 6:11. We're near $2 on the option. That's where we're at $1.95. That's a quadruple, or 306% gain on the last 6 contracts. And again, look at the math here. Before I even show you the total dollars made on the trade, look at what 6 contracts did for you. You paid 48 cents, just under $0.50. You're out at almost $2, right? You're making not quite $1.50, but you can see it 147 bucks per contract times 6, right? So you're making almost $900, and you made $1,200 or so on your total trade. So about 3/4 of your profit came on the last 30% runner piece of your trade. So you hear about the 80-20 rule. Maybe this is the 75-30 rule, but the idea is that a minority of your contracts are generating the majority of your profit. Do not cut your profits short when you get to that risk-free position on the first 2/3 out. Then you should be free financially and psychologically to not trade scared anymore, to not trade afraid, to not be worried about a trade, but to say, give the thing a chance to grow. And some will, some won't. But the idea is that if it doesn't grow, you are in a no-lose position when you've gotten 2/3 out at 50%, right? You can't lose on your overall trade now. And now you're really freed up to let those things really hum when they do go for that as high as 500% gain. Not every winner, of course, is going to get to its final 500% target. Time stop as late as 3:30 p.m. Eastern. Here's another example of that time stop kicking in. This is one that goes back to November 5th. Okay, so November 5th, you can see what was happening here. We actually came in just a touch later than you might expect, because we were waiting for that volume confirmation. You see those first couple of breakout bars, it didn't get it, but then it did. And so we said, okay, it wasn't by much. We barely got it right at the last potential checkpoint here. We said, okay, yes, we want to go ahead and take advantage of that. You can see as we hop in, we do get one little retracement here over this next 15 minutes. It doesn't stop us out. You were in for $1.15. Might have gone down to maybe 75 cents or so as we got in near 621.5. It pulls back to 620, right? So that can happen, and you don't want to overreact to that. But you can see here, we get that first target achieved as it pops up here at about 624. See what we had? 623 calls. See what's happening? We're going from a couple points out of the money to a point in the money. That's only a 0.5% move on the Qs, good for a 50% gain on the options, right? That's 100 to 1 leverage that first move makes. And then you see what happens here is that, yes, it was going along very nicely. And then we hit our 330 point. You see it's starting to roll over here. So we're out there at 330 and we're saying, okay, now we're up to about 625.5. And you see maybe 625.25 as we get filled there. And that's basically intrinsic value on a 623 call out at 2.25, 95 and change percent in the last two contracts, right? So that's not going to make you as much. It's only $568 profit on your original 8 contracts at 115 bucks, got you in there for 920 bucks, right? You see your effective total return there ends up being something in the neighborhood of about 60%, give or take, right? 65%, but that's fine. We're happy with that. But the key is we gave it a chance, and then at 330 you say, don't hang on and hold. Even though the options are going to trade till 415, don't play that cutting it so close game. Just go ahead and say, okay, it's time to go, right? The window of opportunity is closing. Now, why do we require this confirmation from multiple indicators? It's kind of like, one day, one bar, one candle, that's just a data point, right? And so from this perspective, it becomes a situation in which we need more than just one input, right? So if you think of, I'm in Kentucky, in Lexington, Kentucky, one of the homes of the thoroughbred horse business, and of course, you've got your trainer, you've got your jockey, you got your odds maker morning line saying where they think the edge is. Everybody's got an opinion about if that horse is ready to go or not, right? If that trade's ready to go. 1 tip's a hunch, 3 tips from 3 independent sources, now you've got an edge, right? You've got multiple points of confirmation saying yes. It's like 3 rivers flowing together into one more powerful river if they're all flowing the same direction. If they're flowing against each other, you're going to get a lot of chop and churn, right? So we want to align these things up, opening range, the volume weighted average price, and the volume confirmation, right? So that's our kind of 3-legged stool of everything being supported. And so, of course, there will be losing trades. So this is one where we got whipped, even though it would have worked out. It happens sometimes. Let me show you that. You see that we get our confirmation right after our first 3 5-minute candles on the very next candle. See that the volume is there and the breakout is there. Not a huge breakout. And sometimes, by the way, you might say, oh, that's too much of a breakout, I shouldn't chase it. Those are a lot of times your best trades, right? This one wasn't as big of a breakout. Maybe we would have preferred a bigger breakout, but we're following the rules of the system. We close outside that range, just over 604, maybe 604.25, and we're buying a 610 call. You can see we paid 66 cents a contract. So that gets us right at 15 contracts. We're just under $1,000. 66 cents. Our stop is at 33 cents. Now in the next 15 minutes, we get a slam down, right? It comes back into the opening range, undercuts our VWAP line as well in green. You see we're back intraday to 600. We were just at 604. Guess what? That's too much volatility, right? 0.2% gain move against us in 15 minutes, hits our 51, just under our 50% stop, 51.5% stop, filled at 32 instead of 33. And so we're out of that trade. So, okay, lost 34 bucks a contract times 15. It happens, right? So, just over $500 loss on that trade. And your commissions, right? So that's part of the game. So that's why, and you see, as it turned out, yeah, it went to 610.4. But the point is that, yeah, it just was too volatile. So that's part of the game. We'll stop them out. We will not look back. We'll just say, okay, it's just going to happen. We cut and run and say, moving on to other opportunities. Preserve capital if it's not the right setup, okay? These are same-day trades. You're not waiting around. These are obviously trades that you can trade on a small account because they're not expensive option contracts, and you have a 0 overnight risk. So when you look at this, you say, okay, here's another example where we get our breakout, And you can see here that this is where we get the 50% gain in the next 15 minutes or so, right? So this is again why you want to be ready to get in there quickly in at 67 cents out of the $1. And you can see what happens is that did snap back down initially back down to where we would be down at one point there on the remaining 4 contracts. You know, we paid 67 cents. We might have been down 50% or so on those contracts at the absolute low point at the black moving average line, right? And the point is that once you're in a free trade, just give it a chance. If the other 4 contracts had crapped out, we're still in a break even at worst, right? But in this case, by not whipsawing yourself out of the trade, whether you broke the VWAP line or even the black moving average line, that you say, okay, look, if you'd broken those, we would still have said, hey, wait till 3 o'clock or 3:30 in this case. 3:30 exit. Now it's gone up to 623.5 worth about $1.50, 131%. That trade makes $692 rather than ending up, you know, exiting the last 4 contracts at just 30 cents or something, right? So that was the important part, right? That made a good chunk of profit because we didn't panic. But that's the power of selling the first 2/3 at your break-even level. So sometimes we'll get the first target and the remainder will hit a loss. So it's still designed to be risk-free. What's that look like? Here's an example of that. So here's your setup. The first 3 or 4 bars, we're kind of stuck there, but the 5th bar, we close above it. So we're buying, you can see right into that start of that 6th bar right before 10 o'clock here. You can see that we start jetting up pretty quickly over the next 25 minutes. We're getting to the first target. $62 a contract turns into $93 a contract. 11 of the 16 are closed. You got 5 left. And you can see here, even at about 1 o'clock or 1:30 or so, we're still, you know, up. But then it does take a turn for the worse, right? And like we said, we're giving it a chance to go. And so this is one where, yeah, it does start coming down. And this is one where, yeah, by the end of the exit window here, even though it bounced back a little bit, it was now too far out of the money. The options were essentially a wipeout on the last 5. It will happen. But guess what? You still made $31 on the trade, okay? So the point is that no pain, no gain. Sure, we gave up some from where we were at the peak. It will happen from time to time, but that's the price you pay to let the trend keep running, and occasionally it doesn't. Occasionally it goes the other way. So we just want you to just give it a chance, right? And just be sensible about that. When you're sensible that way, we think you'll get lots of opportunities. Like I said, it's not just on call trades, it's also on put trades. So you see what a classic kind of a put day looks like in this case. This was March 20th this year. You know, market was coming down through much of March with the Iran war and the price of oil rising persistently as it continues to do. You can see the NASDAQ breaking down here, right? We had the first 3 bars set up there, and you can see 5th bar, we got that spike up in volume as the volume started to break down. 6th bar did it again, but we're getting in the start of that 6th bar right here. 586 puts entered, we're about 587.5, point and a half or so out of the money, paid $122. And you can see first target not achieved on this one until about 1:30. Right now we're down to about 583.5. We're in the money by almost 2 points or point and a half or so. But you can see here that out of the $1.83. And then the key is look at the runner here. This is an amazing chart when you think about it. You say from 1:30 to 3:30. You say that looks like a nice move where you can make some money, but to go from a 50% gain to a 500% gain in 2 hours, that should get your attention. It certainly got mine. And you know, we've looked at a lot of zero DT systems and basically said, you know what, it's one of those where you really want to position yourself to let the runners run, right? That's where you get paid, right? That bulk of that profit came off those last 2 contracts that made $610 a piece, or $1,220 of your just under $1,600. So again, about 3/4 of your profit in the last 2 of the 8 contracts. So final 25% of your trade. And you can see, you can play the game of should I have held and gotten even more? And then you see you held and hang around, and then it rips back the other direction right into the close. Right, so these things can get very volatile. And so that's why we think it's important to just follow the rules of a system. Do not get too high or too low. Do not become discretionary, okay? Here's another big downside move, all right? You can see the breakout downside happening freshly off the first 3 bars low. The 3rd bar low there broken on the 4th 5-minute candle there at 950. right? It did bounce a little bit as we're getting in there. So again, some subscribers might have gotten an even better price. Our average entry there was $1.34, 134 bucks a contract times 7 in for 938 bucks. Okay. Our 5 of our 7 contracts sold at a 50% gain at 201 bucks a contract. Now we're down here, you see around 608, 608-ish, maybe 608 and change. But you see we're maybe $1.50 in the money, and we're out for $2. And then it just rips to the downside. And look, 500% is achieved before 11:30, right? I mean, because it's just going absolutely vertical on the downside, right? When you do catch those steady waterfall declines or those steady persistent surges to the upside, you can definitely see how dramatic these things can get. And so that's what we're looking to take advantage of for subscribers. And then at that point, we're done for the day, right? You can see by the end of the day, yeah, it finished closer to 600.5. We're about 9.5. We were out at 804 at 11:15. I don't know about you, but I value my time as much as valuing our return on our investment and our money is valuing our return on our time. As I say, we're done by 11:15, and we say thanks very much for the 500% gainer. That trade makes $1,675 off of your original investment of 938, right? So you see how potent that is, even as the minority of the trade generates the majority of the profit. Yet another downside example from early February. You can see February 3rd. This one was a cheapie, right? We paid just 34 cents. We're usually going to pay a little more than that because we got to be careful about the volatility, right? But in this case, the volatility works nicely in our favor. We get out of 20 of the 29 contracts when they're up 50%. Now you have a free trade. You do not sweat this reversal, right? I can assure you on this reversal, you're back to break even or even below when you're back to about where you got in and you've lost just under an hour of time, right? These things are probably trading at 28 cents at that point. We're not worried about it because we're at a risk-free position now and we're trying to let it run. She gets down to 611 at about 2 o'clock. And you can see though, we didn't have to wait that long. we got out just at about the power lunch midpoint of the day near 12:45, and we're ringing the register at 204 bucks a contract on the 9 contracts, 500% gained. Total trade makes 1,870 bucks. There was a little more commission there, 29 in, 29 out at most. It's why as you get more active, you should check with your broker about getting your commission costs down below $1 a contract, which I definitely think you should be able to do as you get more active in the service over time. And then a call trade that still, while hitting its time stop, made a healthy gain from a classic trend day pattern here, right? Here's where the first 3 candles were actually working their way lower. You know, if you're initially starting to react prematurely off of the open saying, well, we're now below where we opened those second and third candles. Aren't we breaking down? We're saying, no, we're setting in place the highs and lows here. And then you can see the breakout coming. The breakout comes right there. We buy right at the start of that. And again, I think we looked at this one earlier, but you can see the idea is that 114 bucks a contract, 2 different test points of our moving average and right near our volume weighted average price in green there, continue to adjust to the upside. And then we get our first target when it's up on a 612 call up to about 613 and change and out at $1.71. The rest keeps trending, makes 224% out at 370 up near 615 and a half, 3.5 bucks in the money or so. So you can see just a steady trend day. Again, from 611 to 615 wouldn't be much to shout about on a typical day for the Qs. It's up maybe 0.2%. But we're saying it still generates 224% of that last piece for an $854 total profit. So how do you take advantage of these? You say, okay, guess what? You can get these real-time trade alerts from us, and the way I've got it set up for quite a while to come here over this next year and set you up to really take advantage of what I think is a great day trading market here in 2026. I mean, it's been phenomenal here of late. We can't guarantee what any one trade holds, but we're confident about the system over time. We think a year is a great way to lock in plenty of time, but also at a great value so that you can tiptoe in at first. I don't want you to be a plunger. I don't want you to rush in on your very next trade you get when you get signed up. I want you to change your goal. I want you to say, my first goal is going to be to execute this system. I want to prove it to myself. And you prove it to yourself over the next at least month worth of trades, you know, preferably over the next 10 trades or so, you know, prove to yourself you can follow the system on just a small number, even 3 contracts, right? Sell 2/3, sell 2 of the 3, and then hold the other one, follow the same rules that way. that we do, even if we're trading $1,000. And then you start following the rules, proving to yourself you can do this, then you can scale up. Okay, that's how I like to think. Start small and then build. Trading is scalable. Your first objective is to build confidence, conviction, and ultimately consistency in your execution so that you can follow the system. You also, with this super special today, get all the things that my long-term subscribers get in terms of the resources. Weekly video training from me. You get our settings and rule sheet, which tells you how to set up the VWAP, how to set up the moving average filter, how to look at the volume confirmation, everything you need to know as an insider, as a subscriber, okay? But you don't have to do that work. We do the work for you. We call out the real-time emails and the text alerts whenever we get a new signal. And then dedicated email to reach me and my analyst team anytime you got a question. Now, if you were buying this off of my Big Trends website, you'd pay $297 for every 30 days. That would be a total package value of investing over $3,500 for the full year's worth of access. But today, I'm going to do something super special because Jeff and the MetaStock team have been so good to me. I'm going to say, you know what? Let's take it down. We start off saying, let's take it down by about 2/3. Speaking of 2/3 on our typical exit, well, 2/3 off. Well, I said, I want to make it even more dramatic for you to say, how can I make it such a value that it's so compelling that you don't want to walk away from this? This is what I'm doing for you today and today only. You can apply this promo code on the page I'm about to give you. Your special code that will save you $1,000 extra on this is day 1,000, right? This is something where you can take advantage of lots of days on just in one morning, out by the afternoon, never any overnight risk. You don't have to worry about what happens coming out of Washington, D.C., what comes out of Iran, what comes out of Russia, what comes out of the oil market. You don't have to worry about any of that. You basically say no overnight risk. Yours today for only $297. Where do you lock in that super special? You go to this page that we set up for you here. It's bigtrends.com/MetaStock. I can pop it in the chat here. Let's see. But basically, you say, okay, look, and one more minute, Jeff, and I'll hand it back over to you. But basically, thanks for popping that in, Jeff. Always so kind. Bigtrends.com/MetaStock. Quickly, let me show you what you have to do. You do have to do one thing to save $1,000 extra. You have to go down to this have a promo code link here, and you have to say, if you forget it, we spell it out for you. Apply the promo code day 1,000. So we're testing your ability to execute right now. I just copy that day 1,000. You can go over here and go to the promo code box and type it in as well. However you like to do it. You see, type it in or copy and paste it into the promo code box when you hit the have a promo code link. Day 1,000, you do have to hit the apply button on the right. Once you hit the apply button, watch what happens. Instant $1,000 extra savings. Remember, it was already 2/3 off. So now we've taken it down by more than 90% off of the $3,500 value to give you the next 365 days of 0DTE options trader for less than $1 a day, $297. If you think about that, one trade that can make you, I showed you $1,600, $1,800 on $1,000 invested, and you're investing less than $300, we're talking about potential 5 to 6 baggers ROI on just one trade for paying for your entire year 5 to 6 times over when we get it, right? The reality, we will have winners, we'll have losers. So know that you need to be sensible about how you execute each trade. Don't get too high or too low off of one trade, right? Prove to yourself you can follow it. It's definitely something that's unique. If you've got questions, you can call our 1-800-BIG-TRENDS number there. It's spelled out for you there, 800-244-8736. It's 800-BIG-TRENDS on your phone if you forget it later. Or you can email our customer service team via clientcare@bigtrends.com. We take all the major credit cards on this secure page. When you, either which way you do it, secure, put your information in that way. I like the PayPal option because I don't have to type anything in. You just review terms and conditions that are hyperlinked there, how we do business now in our 27th year, serving our Big Trends community. You click I agree, and then you either put your info in there, complete your purchase, or even better, don't type anything in, click through to PayPal securely. You log into PayPal, choose your money source. A few clicks later, with the promo code day 1,000, you've locked it in for the next year for $297. There will be no rebills a year from now. We're confident that you'll want to renew. You'll get our best renewal pricing in 365 days a year from now to lock in even more value. But I'm confident you'll be able to pay for this many times over, and you'll keep learning while you're earning. I want to hand it back over to Jeff. I know I got started a few minutes late, but I was hoping he'd get a few minutes to tell you also about a super thing that MetaStock has called the Big Trends Toolkit, which is another great vehicle that you can get a lot of my indicators in MetaStock and scan it and find opportunities yourself. So here we're giving you the fish. MetaStock helps teach you how to fish day after day as well. Let me hand it back to you, Jeff, and thanks for having me. Folks, go to that page. It's bigtrends.com/MetaStock.
Hey, Price, do you have a couple? You do have a few questions.
Oh, great.
Do you have time for them?
Yeah, absolutely.
All right. Peggy wants to know why we would do 0 DTE options instead of playing futures.
Yeah, well, I'm an options guy first and foremost, Penny. So it's a good question. So basically, futures is another great place to fish, but the reality is when you trade a future, that is a commitment to be on the line, whether you're buying or selling the cues or anything else. If you don't follow your rules properly, you can really get yourself in hotter water with futures than you can with options. Here we've got a defined limited risk, and I showed you every example here was no more than $1,000, a maximum risk, even if it blew past your 50% price stop. So the reality is we're shooting for a $500 risk with our 50% stop. I just like the risk reward ratio of options so much better because of that. Thanks for the question, Penny.
Don wants to know what percentage of trading days do you actually place a trade?
That's a great question, Don. You know, our typical expectation is that we're going to see this setup firing somewhere around a third of the time. So basically, we'd expect to get about 2 trades per week or about 8 trades a month, give or take. It can be a hair more or less in a given month. We're never going to force a trade. It's really important that if you're not getting trades, don't force a trade to get action. We're not trading for action and activity. We're trading for results over time. And we're playing our edge when we have our signal. If we don't have our signal, we don't trade. So yeah, it's a good question. But yeah, expect about 8 trades a month. So over the course of a year, you expect to get in the neighborhood of about 90 trades or so, give or take, would be a reasonable expectation.
Along the lines of reasonable expectations, Brad wants to know what is a reasonably expected win rate.
Yeah, we get win rate questions a lot, Brad, and bottom line is that yeah, win rates are part of the equation, but I don't expect to have a super high win rate or even need one with this type of an approach, because the size of our winner to the size of our loser is just as important of a stat as win rate. You can actually email that email I showed you earlier and get our full track record. Go to email clientcare@bigtrends.com. We'll send you, Brad, or anybody else our full track record for the 0 DTE service. You can study every trade, but realize this is more about, hey, if you even win 50% of the time and then you win twice as much, 3 times as much, 4 times as much as you lose. If you played a heads or tails game that way and won $1,000 every time you won, and then you only lost $200 when you lost, or $300 when you lost, you'd play that game every day of the week, right? So the idea is that, you know, I like to kind of retrain subscribers that, yeah, this is more of a big win, smaller loss, taking advantage of the asymmetric leverage of options, even with basically closer to a 50-50 win rate, works really well.
Okay, Don says, thanks. I love 0 DTEs. Play that blindly on SPY. Do you also look for setups on the SPY, or why do you favor the Qs if you don't?
It's a great question too, Don. That basically you could do it with SPY, and I've done it with SPY myself, but the Qs give you more bang for your buck, right? Because let's face it, the Qs are even more driven by big tech. Yes, SPY is too, but Qs are more driven by NVIDIA, Apple, Microsoft, Amazon, Google, Tesla. All those names, Meta, all those names are in your top 10 in the Qs, and they're the ones that are driving the market up or down. You see the market go through these manic depressive stages, right? Sometimes they're in love with those names, sometimes they're not in love with them and dumping them, right? So the idea here is that we want to make sure we're taking advantage of them, whichever way the institutional pressure is to the upside or the downside once we get our confirmed entry signal.
All right. That's all the questions, Price.
Thank you, Jeff. Great being with you as always, and I hope you get to talk about the Big Trends Toolkit.
We will. Bigtrends.com/MetaStock, $297 for a year. Sounds pretty good. Bigtrends.com/MetaStock. You can click on the links in the chat. It'll take you straight to where Price was. Thanks again, Price.
Thanks, Jeff. Great to be with you.
Okay. All right. Let's go ahead and just make some changes here. Okay, share. I might, if we have a little bit of time, go into a little bit of a deeper dive on Big Trend Toolkit at the end of the session today, just because we are out of time. Big Trend Toolkit, though, does take advantage of all of the methodologies that Price has created over the years, the indicators, the systems, the things that he's grown. here's a big list. You've got Bollinger Bands, you've got acceleration bands plus Bollinger Bands, you've got his big trend score, the big trend score breakdown. All of these methodologies that you see listed on your screen, this is Big Trend Toolkit version 3. So it's been so successful, we've made 3 versions of it, or 3 iterations. Over those 3 iterations, we have all of these methodologies. These are all methodologies that will give you exactly entry signals. They're testable, so you can go and see how well they work, what the drawdowns look like, all of that kind of stuff. In addition to that, they give you suggested options entries and suggested stop losses. It's a great methodology. And like I said, towards the end of the day, if we have a little, I'll probably take a little bit of time just to show it to you. How 17 experts, 17 explorations, system tests, templates, indicators, all that kind of stuff. Normally it's like $700. That's a one-time cost. $400, you own it forever. 30-day money-back guarantee. Includes a trial to MetaStock, 800-882-3040, or of course metastock.com/sales-chat, or metastock.com/bigtrends. And I will, as I said, we'll go into a little bit more detail at the end of the session today, and I'll just show you a few of the really cool systems that are in there. So for us, if you haven't yet, you should join the Traders Forum. You can find out, you can join at thetradersforum.com. We do a lot of sessions. We've done a couple of times where we've pulled Price in and we did a little bit of a podcast with him, and then we put it on YouTube later. We do a lot of lessons. I think with trading, the design for the Traders Forum has always been, let's improve what we're doing. It's a community of traders designed to help traders, and you can join for free. You can come to our weekly sessions for free. You can come to our weekly podcast for free, thetradersforum.com. There's no reason you shouldn't join right now. It's thetradersforum.com. All of the offers we're talking about today, you can find at metastock.com/conf-promo. You can call us at metastock.com/sales-chat, or you can call us at 800-882-3040. And those are all in the chat. So our next presenter is Melissa Armo. Melissa Armo talks a lot about the gap methodology that she's perfected over the years. Gaps are a huge, significant symptom of a change in investor sentiment, obviously, because of the price of gaps. Melissa's got a methodology that she has used over the years to identify the best gaps. I think she has a 23 or 26 point recipe. I don't remember the exact same number, but she's going to talk a little bit about it. And let's go ahead and get you started, Melissa. Melissa, are you there?
Testing. Can you hear me?
I can. You're very soft. Let me. How about now?
Hello.
I can hear you. But I had to adjust my volume up quite a bit. I don't know if you're far away from your microphone.
Let me see where my microphone is. Can you hear me better now?
I can hear you great now. You sound like an angel. Are you an angel?
I am an angel.
Okay.
I'm a city angel. I don't know how to share my screen though. That is blacked out.
That's okay. That's my fault. Let me go ahead and make you the presenter, and then it will actually ask you if you want to share your screen. And while you're getting kind of set up for that, I have a little bit of I want you to give me a hand.
Is that
I
good?
can see it, yeah.
Wonderful.
Can you give me a hand for just a second before you get started?
Sure.
Go ahead and help me pick out a prize. I'm going to give away another Steve Bigelow book. I put him over there, but Steve Bigelow has a book called Eliminating Emotions. I'm going to give away a copy of it. And what I need from you is just a number between 1 and 4,955.
37.
Ooh, that's a little one. Okay, 37. Okay. Well, Werner Y in the USA just won a book. So thank you for that, Melissa.
Congratulations to him.
Yeah, I'll drop you an email right now so that I don't have to do it later. And I'll just ask you to verify your address. And if you do, I'll send you this book. Melissa, I can hear you though. I can see your screen. I'm going to get out of the way.
Okay, great. And where do I see the chats? Okay, I see the chats here. You still see the screen?
Yes, ma'am.
Perfect. All right, I'm going to get and welcome everyone. So as Jeff said, I talk about gaps. So that's what we're going to talk about today. My name is Melissa Armo. I own my own company called the Stock Swoosh, and I've been trading now for almost 20 years. It's hard to believe. Never seen a market like we've seen this year in 2026. So lots of volatility today, yesterday, probably going to be the rest of the week. Very interesting time to trade. Again, volatility is your friend as an active trader if you actually know how to trade it. And if you don't, you can get hurt. So I think it's important for people to always have a strategy to trade under any market conditions. And when I got into trading, I got into shorting, which I'm going to talk about today. And then I got into gaps. And I realized that gaps have a lot of momentum. And they have a lot of momentum because they're made with institutional money. So we're going to talk about trading on the side of institutional money. And again, if you have any questions, you can plop it in the chat. You can also email me at melissa@thestockswoosh.com. And you can follow me on Facebook, YouTube, or X. Again, my company's name is The Stock Swoosh. So again, everybody starts out, they want to trade, they want to make money. But unfortunately, a lot of people go into trading with the thought of gambling. It's going to be very difficult for you to see any longevity in this industry if you are gambling. And to be honest with you, I think a lot of people are gambling right now. They're gambling on Trump tweets, the war, news cycles, and that's dangerous. You know, you could make money for 3 weeks in a row or 3 months in a row and give it all back in a day or a week if you're gambling. And so I learned very early on that you needed a trading strategy in order to trade successfully. So lots of people want to trade, like I said, but they don't have a set strategy. And I also got into, like I was saying, shorts because I made a lot of money shorting. Why? Because stocks sell off faster than they rally. Actually, we shorted the SPY today. So we shorted the market today and it worked. The market gapped down today. And so I don't have the chart here in the market in here today, but you can look up your chart. You can pull it up. We were down today. And again, there's a lot going on right now. So we're having lots and lots of gaps. And I think it's really important if you've been attempting to trade successfully for the last several years or maybe even longer than I'm alive, you know, you always can start fresh. Tomorrow is a new day. Don't blow up your account if you're having a bad day. You know, just because you did one class or took one subscription or signed up for some subscription and didn't make money or lost money or did something and you regret it. The bottom line is you always have tomorrow. You can learn a new strategy. You can learn a new system. You can start all over, you know, and I always tell people, give yourself a second chance. It's very, very rare of all the years that I've traded, like I said, that I see people that just, you know, took one class and immediately made money out of the gate. Most people go through a process of several classes and several systems until they find something that clicks with them and they get it right. But it is important to have an optimistic attitude. It's important to be very, very thoughtful, especially when you're risking money. You know, a lot of people risk money and they're in fear. And I say, if you're in fear, then chances are, A, you have too much risk on in the trade, or B, you don't know what you're doing with the trade. There's no strategic reason for you doing it. And again, we're in this environment right now where I really think a lot of people are gambling. And so if this sounds like you need to kind of take a step back. You can make money in the market, but you have to have a positive attitude. You have to have a good trading system. And I also think it's important to have actually a good mentor. So don't forget also that time is money. You know, we're getting into, it's really the end of earnings season. Big earnings out this week is NVIDIA. It's Wednesday night into Thursday. NVIDIA probably will gap. I don't know if it's up or down. I don't take trades into earnings, but NVIDIA is the big one this week. And then after that, we have the holiday, and then we come back in June. Of course, we have a FOMC meeting in June, and then next earnings season starts after July 4th. So it's just a busy time to trade, but I don't trade all day long. I trade in the morning. I'm in and out, done quick. I was done today very early. Half an hour is all I trade. If I was trading all day, I couldn't be here right now. The market's open till 4. So I really only focus on the morning. The morning has the best and biggest bang for your buck. So again, if you're someone that wants to trade on the side, you can trade on the side in the morning, do a quick trade in the morning, and be in and out fast. And again, if anybody has any questions, you can plop it in the room. I'm seeing that on the side here. Anyways, let's talk about shorting, and let's talk about fast moves. Okay. So again, I was talking about institutional money. Institutional money is big money, hedge funds, big traders, professional money that's in the market. When they sell, guess what happens? Panic comes in, And then stocks fall, or the market. Again, we saw the market down today. What happened? Market sold off yesterday. Market sold off the last 24 hours, actually. Again, why people are panicking. The war is going to be back on. Trump's going to bomb Iran. Something's going to happen. The reason doesn't matter. The fact is people panic. So again, you can make money very fast shorting, because when investors panic, then they sell, okay? And you're shorting that. So as a trader, you can make money shorting the selling action of investors who panic, okay? Makes sense? And again, you can have panic to the upside, but it's really, really rare. It's just like so rare, you almost don't see it that often. Mostly panic is to the downside. And again, one of the reasons that I follow gaps and follow institutional money is because you have big momentum usually in gaps. And so again, as an individual trader, you want the most momentum you can possibly get, whether it's small size, advanced trader size, whatever size you're trading. You want stocks to move big so you can get a big move. Whether you have 100 shares and or 1,000 shares, you'll have a good risk to reward. So again, money comes quickly in shorts. And that's really how I got into it. I didn't want to sit for 6.5 hours all day waiting. And I just felt like that was really a waste of time. And again, when I look back at many, many charts and even the market, I realized that most of the move happened in the morning. And so I was trying to find a quick move in the morning. And again, this idea of shorting. Here's a good example of one. UPS fell today. It says UPS is a 1-minute chart. So again, this was back, I don't even remember the day this was actually. Stock closed here, gap down, open, dropped, fell. So again, fell here, and fell very quickly, fell very fast. So again, what happened right out of the gate, you could have done it, could have got in, got out in 15 minutes. And you could have shorted this and you could have made money. And again, you know, this is a 1-minute chart. Jeff, I'm just realizing I grabbed the wrong PowerPoint. Since you sent me everything yesterday, I don't know if you want me to switch it out. I just realized this here with this chart. Jeff, are you there?
I am. I just go with what you got.
Because I just realized that I had 2 saved because I had it done and then I plopped in your things. I'm sorry.
Yeah, it's all right. Go for it.
Anyways, getting back to what I was saying, this is a quick drop in the first 15 minutes of the day, and you would get in and out. So again, you don't have to sit all day. You don't have to wait. And so you could have got in, got out, and made $2.50. So if you have $1,000, you could have made $2,500. Again, this is shorting on margin. Now, I do options as well. And I do have a couple options trades in here, which we can talk about. But when you're doing an option, you're buying the put to enter it and selling it to exit it. Or if you're doing a call, you're buying the call to enter it or selling it to exit it. Okay. So anyways, you need a system that will tell you, is this stock going to fall or is this stock going to rally? That's what I ended up developing. Okay, so I'm looking in the morning for gaps. I'm looking mostly for bearish gaps. UPS was a bearish gap. And then I developed a rating system. It's a 26-point rating system where I'm looking for 20 points or more to decide if the gap is going to follow through in the direction of the gap. And again, I will go long and short, but I prefer to actually short. I will tell you that we did a call that was CVX. You can look it up at Chevron. That is continuing to rally today. Again, that's oil. Price has been going up, and that had a really nice move yesterday, and it's continuing higher even here today. So again, you can go long, you could short. I just prefer to short. So I developed a method and a system that teaches how to rate, pick, and play professional bearish gaps. The golden gap trading system looks at 26 points to examine and rate the stock. That is gapping. And this is how you can find which gap is the best to trade each day. So if you come and you decide you want to learn my method, you would learn the 26 points. You don't have to have a perfect score, but you want to get 20 or more. So you do all this prep and you rate it in the morning in the pre-market. And then if the stock sets up in the open, then you take the trade, you get in, and you do it, and you short it. So again, we shorted the SPY today. It was a really, really nice move. We were in aggressively in the morning, and we got out. I think I got out around 10:15 or so. We had a great exit, And again, the SPY has daily options expirations, which you could have bought a daily put, or you could have shorted it on margin if you wanted to do it. So, you know, this whole idea of having a checklist, this is my system. This is my strategy. This helps me find the best stock to short. Otherwise, you're looking at news and you're trying to trade the news, or you're trying to trade the president's tweets, or you're trying to guess what Iran is going to do next, or the Fed. These are things you cannot predict. These are things you have no idea or the outcome. And even though people feel very confident, like I said now, in certain outcomes in reference to the war and the president's tweets, that is all a gambling mentality. We live in an environment where things can change, and they can change on a dime. When I'm looking at the chart, okay, when I'm looking at the chart and I'm using technical analysis, that allows me to look at what? I'm looking at the current price. There's no, argument about that. Everybody, if they have live data and their net feed, can see exactly what the price of something is and pretty much agree to it, again, with a live feed. And then after that, you take the trade. You look at past price data. Past price data, for me, what I use in technical analysis, I look at past price data, and then I use that information to predict future price data. And that's how I make the decision that I'm going to do something like the SPY today, or something like CVX, which was a long, like I said. So again, I love shorting stocks, the gap, and I love shorting, but I really love gaps, period, just because they have large momentum moves. And I like the idea of being able to trade in the morning quick and be out, particularly in the summer. It's the summer. Nobody wants to stay inside, at least in the Northeast in the summer months. No one wants to stay inside all day. We had a horrible winter here in New York City. It was the worst winter I've seen in so long, very cold. Now's the time to be out. Nobody wants to sit at their desk all day till 4 o'clock. And again, if 80% of the move of the stock and the gap is made in the first hour, why would you? Why would you? And this whole idea where I'm talking about panic and selling, that's where we've really been able to capture a lot of these moves that have happened since January. Like, again, I know it's hard for people to believe, but actually the market had a really sharp sell-off February, March, when the war thing started. The ceasefire has been going on now for over a month, but there were some great short opportunities before the ceasefire. And a lot of people didn't get that move, didn't take advantage of it, and actually lost money because people were long. So this whole idea of focusing on shorting also really gives me a niche. And I get in very small entries, and then I put the stop in. I use a limit order stop, and then I try to really take size in my trades, but you can take small size if you want to. There's a new rule now that's been approved where you can trade and have a margin account with less than 25,000. I think that begins June 4th. That's huge for a lot of people who didn't have the 25,000 and want to be able to trade on margin and want to be able to short stocks. Somebody can have, 10 grand or 5 grand and get 4-to-1 margin at a retail broker now starting June 4th. So that opens up a lot of activity and volume, I think, that's going to come into the market for people to be able to day trade. And again, people can do options. There's no set margin requirements for options, but the fact is day trading is very profitable if you're fast and quick and in and out and get the exact entry right on the 1 minute. Whereas with options, I'm holding my options like a little bit longer. Anyways, getting back to what I was saying, if you want to work fast in the morning, and again, I'm trading on the 1 minute. It helps me be consistent and get the fast move. So let's talk about what is a gap. A gap is a break in continuity, interruption, hiatus, a divergence, a disparity. What is a gap? So again, the basics of what a gap is, if you don't know, a stop gap from the opening price today is different from the closing price of the previous day's trading. A gap is a break in the price action from one day to the next. So again, the SPY gap down today. Almost everything gaps every day. Sometimes things gap up, sometimes things gap down. Again, you don't know until you get up in the morning and see exactly where something is gapping. Does everything follow through in the direction of the gap? No. Does everything fill the gap? No. Again, that's another misnomer that people believe as well. Gap fills do not work as a way to consistently make money in the market. Again, if that was the case, then you know, it'd be easy to trade. We'd never lose. And that's not reality. If I just played everything for a gap fill. So it's just not that simple. So I have in here Friday's trades. We had a really nice day on Friday. We did 2 day trades. Again, these are margin trades. And I put in here an advanced trader risk and a beginner trader risk just to show you. And here's the daily chart. So this is INTC. Again, this sector is responsible for actually most of the move, the bullish move up of the market. Here was the rally that this had. Then we had Thursday into Friday. So again, what is a gap? A gap is the difference between the close and the open. So INTC closed at one price on Thursday night at 4 o'clock and opened at a different price on Friday morning at 9:30. And we shorted this. And we got in and we got out and we made money. And this is a gap. Now, I also want to show you this is a gap too. So this was Friday and then this was Monday, which was yesterday. Gapped up. It did not rally. It did not get bought. Okay. In fact, it fell. Now, again, this was a day trade I'm going to show you here that we did on Friday. But I just want to show you this actually had another gap on Monday and it reversed. Okay. So the entry, the trade was, we shorted the stock. This is advanced trader risk of 108.70 was the entry. I called the trades live in the day trading room. And again, I'm looking for $1 or more. We get out at 107.05. This kept going though, but I'm just showing you. And it was a $4,125 profit, a nice trade. If you had a smaller risk, if you had 500 shares and it was $1,000, you could have made $16.50. This was in and out very, very quickly on Friday the 15th. Again, this little tiny, tiny bar here, but we got in, got out, fast, made money, we're done. So that was a nice trade, okay? And again, this is a margin trade. So we're shorting shares. If you want to do 100 shares, do 100 shares if you want to. Any questions about that? Then we also did the Qs. So I told you we did the SPY today. This was Friday. So what happened to the Qs? The Qs gapped down. This was Thursday, closed here, gapped down. Actually, Thursday, market made brand new all-time highs. Closed at one number, opened at a lower number. We shorted this, we got in, got out. Similar thing happened here with the Qs, like INTC. Market gapped up on Monday, the 18th, and then fell. So this was the trade. Again, this is a day trade on margin. So you need a margin account, or you could have bought the QQQ daily expiration for the 15th. You could have done that. The market has daily expirations, like I said. Entry was 709.20, added at 708.10. This was a huge trade. Exited at 705.95. This is not the low of the day. Even it kept going. 13,500 profit with a 52.50 risk. And if you would have risked less, you could have risked 1,050 and made 2,700. This is just one day, you know, one day. And again, even if you had a small risk here, you're up over $4,000 as a beginner, you know, risking $1,000. So you don't have to risk huge amounts of money in order to do well. You have to have a good system, and you have to have like a very pinpointing the exactness what you want to see, which I do when I'm looking for my entries, and I do when I'm looking for my direction of the pick, where I would short this, okay, to get that kind of entry, to get in and out very, very fast. So again, if you had an advanced trader total Friday, you could have made 17,625. A beginner trader total Friday, you could have made 4,350 just in one day. So a very nice Friday. And so again, there's opportunities. There's opportunities today. Like I said, there's lots of things you could have done today. I typically do one trade a day. I did do 2 things Friday. But again, how do I pick which gap to trade when there's thousands of things are gapping? You need a proven system to find the best gap. You can't just take every gap in the opposite direction. You can't just take every gap in the direction it's going. So I developed a system over 3 years to figure out which one to do and in which direction to do it. And again, I focus on shorting. Shorting gives me a niche, even in a bullish market, specifically in a bullish market, actually. Like today, I shorted the SPY. I don't know how many people did that and made good money, actually. So again, it's about looking at something on the chart and then figuring it out and then getting in, getting the move, and getting out. So again, I developed a 26-point professional bearish gap rating system. The purpose of the system is to help you evaluate which gap to trade each morning. Since there are so many stocks each day that gap, using a system is significant to your success. Without a system, you are gambling. You're risking the farm or betting on all kinds of things that you don't know the outcome and can't predict. So again, that's one of the reasons, like, I think that this market is going to be interesting to see here what happens, regardless of the war. Again, income, when you're trading for income, it's way, way different than long-term investing. Long-term investing is you can get in a stock, you can buy a stock, you can buy the market, and you can hold it. You could do a long-term option, which is a leap, or you could just buy shares in the market or buy in your retirement account or whatever. You have no timeline. Or if you're in a leap, it's a timeline out for a while. It could be into 2027. But you're looking for longer term moves, or you're trading the trend. I'm a day trader. I'm an active trader. I'm a momentum trader. I'm looking to make money today, right now, tomorrow, by Friday. That's different. That's income generation. That's what I do. That's what a trader does. Otherwise, you're just like the buy and hold mentality, but when are you ever getting out? And when I say when are you getting out, when are you getting out when you're up, and when are you getting out when you're down? You know, a lot of people don't get out when they're down, and then they lose more. A lot of people don't get out when they're up, and they go and they double down. Do you know what I'm saying? And then the trade doesn't work and they lose even more, and they were up, you know? So again, how do you make money consistently? You need to find momentum. You need to find the time frame to do it. And how do I find momentum? I'm looking for institutional money in the gap. So first, I find a good gap. I'm trying to find the best gap. I want to find something that's going to have a move, a morning move, momentum. And what's the purpose of momentum? The purpose of momentum is so that I can make money, no matter how much size I have, whether I do as a day trade or an option. The whole point is to get a big move. Again, I'm saying $1 or more. If it's a higher price stock, I may want a larger move than that to get paid, especially if some of the options are expensive. But momentum trading would not be possible if we didn't have large investors in the market. There are hedge funds in the market. There are big, big investors in the market. Momentum trading is made possible because of institutional money. It's just like if I'm going long, like CVX, which is getting bought. Institutional money has been buying that. Very clear. In fact, it looks very different than the market, actually. Where institutional money is not buying the market. Not today, not yesterday, not the day before. So again, I didn't go long the market today. Like I said, I shorted it. Momentum traders take positions in stocks in anticipation that the stock will have an explosive move. This enormous move is in one direction, and it usually happens quick and fast. Okay, and again, for me, it's the morning focus. Momentum trading is one of the most profitable and fastest ways to make money trading, just because the fact you can get in and out quick and you don't have to worry about everything else that's going on during the day, news alerts or things that could mess up your trades. And then you can be done. Momentum trading is very profitable as long as you enter the play before the fast and big move takes place. Again, I'm not predicting where something's going to gap or go. Like, I don't know what NVIDIA earnings do. I have no idea. When I see the earnings, I will see the gap. I will rate it. I'll make a decision if I'm going to go long or short it or not do it at all. But the fact is that that's not the move. The move happens on the live day. Again, if the live day opens at 9:30 and you don't see a big move till 10:30, then again, 80% of the move could be done. Then you're having to get in quick or get out quick and basically scalp. You know, so let's get back to talking a little bit here about playing to the downside. So the benefit of playing the momentum in stocks to the downside is that the moves in selling action happen faster than they usually do in longs. It's just because there's no panic for something to move up. Like if you want to buy a stock, if you want to buy Apple, you're like, well, I'm thinking about buying Apple. Maybe I'll buy it today. Maybe I'll wait till after the war stuff. Maybe I'll buy it after the earnings. There's no panic. You know what I mean? Unlike if you're long the market. And you were up more money if you were long the market last Thursday than you are today, 4 days later. It's Tuesday. So that's the truth. If you were long before Thursday and into Thursday. Market made new highs Thursday. We've been falling ever since. So there is rarely panic buying, but there is panic selling. If you are an investor who is down money, you want to sell your position as quickly as possible, whether that is to stop losses or to save what you're up so you don't lose more. You know, you don't, again, as something's dropping, you want to get out. You can always retake it. So many people sell, they sell fast, and then stocks drop, and then it keeps dropping more, then it drops fast. And again, as a trader, you can short this, okay? You can short this, you're shorting the selling action, and you're doing it as fast as possible. And this is what I do, to play on the large momentum and the volatility, then to get paid. Here was a really good one that we did like a month ago now. Shop, stock closed here, gap down, open, rallied, dropped. So Shop had earnings. We shorted it. Again, this was a giant move for the stock. Absolutely huge. One of the biggest bars on the chart. And so this is momentum. And what happened to the Shop? I didn't read the earnings. I don't know, but it got dumped. People dumped it. Nobody bought it here. And if you did, you didn't make any money. Okay. So the play here was to buy a put or to short. Okay. So again, when you're doing something with an advanced trader risk or a beginner risk, the whole idea is not how much you're risking, because how much you risk has to depend on how much you have in your account cash-wise. I mean, that's just flat out reality. It has to do with having more winners than losers, and it has to do with the precision of the entry to get the move to build your account. If you have a $5,000 account, you're trying to build it up to 6, 7, get it up to 10 so that you can increase your risk. I don't think this is the time of the year for anybody to be increasing their risk. People should not increase their risk until earnings season start. You know, I would keep your risk the same at least till July. There's 4 quarters a year. We're already 2 quarters into the year. So every few months you can assess your risk. But getting back to what I was saying about win ratios, you are going to not make any money if you have more losers than winners. You're never going to make so much money on the winners to ever cover more of the losers if you're upside down in your win ratio. And it's not like it has to be some high win ratio, like 90% or something. I mean, you could have a 55, 60% win ratio and be making good money. But if you have a 30% win ratio, you're going to lose. There's just no way. You can't make up the ground with that. The idea is to have some big winners, which you can't always plan. Sometimes it happens out of the sky and you don't plan it. They cover your losses, and then you still have to consistently have more winners. It's just the way that it works. You can't always go in every day and lose. You're going to just run out of money that way. So again, we shorted the SPY today. Yesterday, actually, we shorted the Qs. Friday, we did the Qs and INTC. So we've been on a roll here. Like, again, there has been stuff to short. This kind of thing has been bothering me, though, this chart. This fell. I'm just going to go over this gap here, this meta. Stock closed here, gap down. This was earnings. So the 29th here, it closed. Then it had an earnings here on the 30th, and it dropped, fell. We did this here. We did this here. I'm going to go over this. But this has really been bothering me because I've been watching this to fall off a cliff. It hasn't done it yet. Every day I think it's going to fall off a cliff, and it hasn't done it yet. It'll be interesting to see if this actually does fall off a cliff. Or if this is a turnaround for this. But this has been a great short, but I really expected more from this chart and more from this trade, actually. But here was the trade for the first. So again, here's the morning. 5-1. We got in, got out, boom, done. Call it a day. So again, half an hour, 1 hour, get the move, do, boom, out, done. And again, I did this as a day trade. Now, if you don't want to do that, you could have bought the closest strike, the closest expiration date for the put. Could have done that. We've been doing puts in this though, but 614.05 was the entry. Again, it was kind of a big stop. Added it at 612, got out at 608.60, made $7,072. This was on the first. I want to show you here though where this went. Came all the way down. Came all the way down to 605 and change. I didn't hold it all the way down there. This is again a day trade. And again, there's new rules starting June 4th that you can day trade on margin with under 25,000. You still have 4-to-1 margin. So again, I like the fast trades. I like the quick plays. Here's another one we did. In fact, I wish I would have done this more days. The Shack, this was earnings too. Stock closed here, gap down, closed up here. And then it had earnings, then a gap down around 25 points. Open, dropped, fell. This is the volume. And then again, I wish I had done this in here, but I did it here in the 5-7 day. Here was the trade. Stock closed here, gap down, shorted it, got the drop. You could have held this one actually a little bit longer, or you could have got out quick. Entry was 68.80, got out at 68.05, made 22.50. Again, I like to get out of things fast in the morning, but if you held this, this actually kept bleeding down. And then 2 days later, like I said, this went at a really big move here. You could have bought a put here, and you could have held it for that one. That was into the following week. But that was a nice trade. Again, these are all shorts. So I'm doing a really big Memorial Day package, which we'll talk about at the end, where you can get all my trades to the end of next year, to the end of 2027. This is huge. So I'm doing a big package for Memorial Day, which is in a week, for the June classes. And you would get all my subscriptions, all my trades, access to the live room, the options newsletter, the rest of 2026 and all of 2027. So it's a really, really big deal. And I'll talk about that at the end. Here was UPS. Again, this was back the beginning of May. This was earnings. So actually this had earnings here. Then it rallied. I don't know why this did what it did here, but anyways, it didn't do anything right here. And then it went and fell. So we did this trade actually on the 28th. We did the $100 puts, which was here. So I bought the put. It was upside down, and then it went boom and fell all the way down. So again, sometimes things go immediately. Sometimes things take a while. I usually am holding options for longer moves, but this was so cheap. It was $1.25 for one contract, and it went actually over 4. It was just a huge trade. 220% return on investment. Again, I was down in the trade until it went. So it wasn't even a matter of really managing it. It was just holding it and waiting for it to go. $19,250 profit. And again, that stock has continued to fall. If you pull that chart up, if you did $12.50 risk, you could have done one. You could have risked $125 and made 220%. So again, you choose your risk, you size yourself, you let the trade play out. If you find yourself scared though about taking a certain amount of risk though, I'm telling you that chances are your risk is too great. You should back it off. I always tell people that. And so again, I am doing options, but I'm holding them for longer. Netflix, we did a bunch of times. Now that's been backing up. I don't know if that goes anywhere until the next earnings. We did the 92 strikes, 5-4. And here was this one, 5-4 here. So we bought a put and it dropped. Boom, boom. This was a good trade. That was a nice trade. Another one, dirt cheap, $1.30. Sold at $4.30, made 21,231% return on investment. Again, you could have bought 10. You could have made $3,000, risking $1,300. That's a good, solid trade. You could have risked half that and made $1,500. A good, solid trade that went pretty quickly. And again, you would have had to be willing to hold it. So I hold overnight. I don't do swing trades. I do options because there's a fixed risk. So worst case scenario, I would have lost the whole amount, but I wouldn't have lost any more. So it's a fixed risk. And I give my trades time to work, like with the UPS. But anyways, getting back to what I was saying about the market and everything that's been happening right now, I've talked to a lot of different people. Again, I do webinars, I run my room, I'm on YouTube, I'm on television. Everybody's a different opinion about this market. Some people think this market is going to keep going up forever. Some people are buying this dip here today. I would never, ever buy this market today here. Why? Because we gapped down. Like I told you this morning, I shorted the market and made money. So again, I'm looking for institutional money when I take a long or a short. But everybody has very strong opinions right now about this market, where it's going, what's going to happen next, what's Trump's going to tweet, what's going to happen with the war. Again, I'm a short-term trader. What happens a month from now is not even in my purview. You know, I'm in trades out that expire Friday. I'm going to do trades tomorrow, get out tomorrow morning. So I think really the short-term trading, being an active trader, is actually the easiest way to trade right now because of the fact that you cannot predict what's going to happen 2 weeks from now, 3 weeks from now, 3 months from now. Nobody knows. Now they're talking about raising interest rates. That's really going to kill this market rally. We don't have a Fed meeting until June, but we had horrible inflation numbers last week. And if you shop, if you're a consumer, you know the numbers are bad out there. I mean, they've been bad. I can't even believe they were not showing up till now, but these things will always take time to show up in the numbers. But, you know, some people have been going long since the flip and the ceasefire and swear the market's going to go up forever and double down or buy more every time we have a little dip or a little gap down. What are you going to do if the market falls? Are you going to keep buying? I mean, this is like a real question that I've been asking people, and some of them don't have the answer and some of them say yes. Unless you're a long-term trader where you can buy and hold until it goes back till whatever it is, the high goes over the high, whatever, you have no money management really. If you're just saying, I'm going to just buy every dip because I think it's going to keep going up because of this thing or that thing or whatever. And basically, like I was saying, it's like people are gambling now. They're just gambling on certain things that they really don't know the answers to. It's not based on a system or a strategy or something you can see on the chart. So anyways, I teach a class once a month. It's called the Golden Gap course. This is a class where I teach my entries. I teach my method. I teach 6 different entries, how to enter and exit the trade. I teach you 26 points. Again, I'm doing a big special where you can get all my trades to the end of next year. And the plays are important because really that's how you make money. But the rating system teaches you how to get the picks. So you can do it without me, you know. But I'm very good at what I do because I'm doing this a long time. So I think being in the room is very, very beneficial for people. So one of the most intricate and important pieces of information, the Golden Gap 2-day course, is how to take precise entries with small stops to make a lot of money in a play. Again, that's exactly what we did today with the SPY. Exactly. We pretty much had a low of the day exit, which isn't always the case, but we really did. I can't see what the market's doing right now, but before I popped on here, I was thinking that. Learning how to trade these momentum moves with small stops is very valuable, and it's a detailed piece of information that will help you make money very quick, very fast. Again, if you want to be an active trader, you have to learn how to maneuver yourself in and out. And I think also this whole change of the system where people can now trade on margin starting June 4th at every retail broker in the United States is really going to help people. Again, I do options too, but you have to be patient with options and you have to hold them sometimes to wait to go. UPS was a good example. Day trades, you're in and out, 5 minutes, 10 minutes, 15 minutes, done. And you're just looking for the same thing every day, Monday, Tuesday, Wednesday, Thursday, Friday. I'm looking for the same thing, but in a different stock, in a different gap. So again, you can use the system to day trade equities, and you could do swing trading. I'm not, but you could. And you could do longer term options. Again, I'm doing the weekly, Friday weeklies, but you could do longer terms if you want. But it's still the idea of income generation. It's still the idea that you are making money very quickly. It's still the idea that you are using the gap method. So again, if you're someone that likes to swing trade or you feel comfortable buying a put out or a call out for a long, long time, although like if you wanted to buy calls for the market right now, even out longer, they're very, very expensive. You're going to pay up for it. So you really have to have, you have to have the risk to reward has to be there really to get the move. Like you have to know that this could go really, really a long way down. Like again, I've been watching this shop again because it had such a nice drop in here. This broke 95 again for the day that we did it in here around 115, came all the way down, went 20 points down. So you could have done something out for like 2 weeks or something. Any questions here so far? I don't see any questions. I don't know if anybody has any questions. Jeff?
There are tons of questions.
Okay.
Somebody has a 3-part question, actually.
I don't see the questions. Why do I see no questions on my end?
It's under the questions tab. So
the questions tab, yeah, it says nothing for me. Maybe I don't know.
All right. Oh, well, I can read.
Okay.
I'm proud of that too. Royal wants to know if you're shorting a stock, does it depend on the broker to borrow the stock?
Yes. Most of the stocks, though, that we went over in here, most of the ones that we're due, you're going to have at any broker. We're not really doing any weird ones or low float stocks or penny stocks. So everything we do, you should have available at your broker. But yes, you're going to need it available and you can check it in the morning. But we're doing names that the companies, Netflix or you have Netflix. It's not like we're doing any weird things.
Greg says you answered his third part of his question. He wants to know what dependency on additional tools, how self-contained is the 26-point system after you take the course? what type of tools, scanners, subscription services you need to effectively day trade after the course.
You don't have to pay for any scanner. You don't have to. I mean, I don't have any separate scanner that I use or look at. So again, years and years ago, I had paid for a scanner myself when I first started, and then I thought it was overlap and it just wasn't worth it. So you don't really need any, you don't need to pay for any separate thing or scanner. I'm doing it with my brain, and you're going to learn how to do it with a notebook and your brain. And you need charts. You got to have charts. You got to have a daily chart to be able to do it. But that you should get for free with your broker. But there's no special software. There's no special scanning tools. I don't use anything like that where you have to buy or pay for it. So it's pretty much is self-contained. But you do have to have live feed and live data. Yes.
And I would point out, like, if you want to run a real quick gap scan in MetaStock, it's super easy too. Like,
yeah,
it seems
you should do that sometime after I do a lecture, Jeff, and I can talk even through it with you. I never even thought to do that, but that's something we could do together actually sometime.
Hey,
I know
sounds like a topic of a future discussion. That sounds like a cool webinar too. We could look at live markets and tell people not to buy what we're saying.
Well, I think it would be helpful for people to at least, if I, was you or something, obviously I have to do the class to learn the rating system, but just to look at a scanner and I'd say dooba-dooba-doo or whatever, and you can have it up. Like that could be helpful for people, for a future
I'm going
lecture.
to write that down. We'll workshop it.
Yeah. Or even you and I could just do it and you could tape it and then you could put it on your website or whatever.
Cool. The second part of his question was how much of the 26-point process, how long does it take to go through your 26-point process?
Again, I don't rush. I get up early in the morning, 6 a.m. I look at the market. I go for a walk in the park. I come back. I have breakfast, and I start scanning around 7:30. Room opens at 9. So I give myself a good hour and a half, a minimum. I would say give yourself an hour. If you're new, it might take you 10, 15 minutes to rate one gap. Whereas I could rate something very quickly, like in 1 to 3 minutes, but the idea is not to rush. And the idea is to take your time and pre-pick what you want to do. So I'll tell you, this morning I looked at HD and then I had the SPY. And then again, in the room this morning, I said, you know what, I really like this market. I really love this market. I really like the market. And then HD opened late. So then it was a no-brainer. We didn't end up shorting HD. We did the SPY. HD open, I think 9:33, and it was really, really spreading. And so then we did the market. So I usually try to narrow it down to 1 or 2 things, but I would give yourself an hour and I wouldn't rush it. And you're not rating 10,000 stocks every day. Even if you had a scanner that pulled up 10,000 things, you're only capable of doing 1 or 2 things at a time anyways. You just have a small watch list. You have the ones that rate good. You watch them and you do them. And that's good enough. Again, you set your goals. You want to make $500 a day, $1,000 a day. The more trades you take, the more you are apt for losses. So that's why, like, if I take one good trade, I'm done. I did the SPY today, done. Boom, close out the room. I had lunch. I'm here with you guys. I mean, don't sit and trade like a crazy person all day. It's going to kill you in this market.
All right, those are the questions.
Okay, good.
Back to where we were.
Yeah, I'll finish up. But that is something I never thought about doing, that we could kind of just do on the fly.
Oh, people would love it too. It sounds like I'll follow up with you as soon as next week comes.
Yeah, I mean, we could do it in a lecture. We could just do it, and you could just film it or something.
Do it in the Traders Forum, maybe.
Yeah, I think you did have me on there a couple of years ago for a lecture, but we could do that again, sure.
Awesome.
So again, this is about empowering yourself to trade. So I mean, my next class is until June, but I had the May class this past weekend, and it's kind of funny because I was talking to people in the class, and I said, for some reason, we're getting into this thing. Everyone's talking about AI and all this stuff. People don't want to think. You do need to think. You do need to think and make rational choices and decisions. And again, I find a lot of people that get into trading and they start to gamble. Then you get away from the thinking process. You get away from using your brain. Then you're just trading on emotions, and chances are you're going to lose and you're not going to do well. So you want to use your brain. It's your best asset, and you want to strengthen your brain and get good at something. So again, the philosophy behind the system is to find stocks to trade that have, number one, a high probability of directional bias for the entire day. 2 big moves on the day, and 3 early confirmation of my bias and the move, and 4 precise entries with follow through and a good risk to reward. So it's a complete system, which I've been trading since 2008, and it took me 3 years though to figure out my system. So in the class, you learn the entries, you learn the rating system. And again, time is really money. So it's an investment to come and take the class with me, but you can get up to speed and start trading with me right away. So, I mean, I think that people really have to decide if this is something that they really, really want to do. And for me, it was like no question when I found out about trading, I thought I can do this. Now, I didn't know that it was going to take me 3 years to figure out my own system. And I thought I'm really smart. I can figure this out in 6 months. It didn't turn out to be that way. So you know, you're going to go through challenges to get to the point that you become successful. Don't fret about, like I said, if you've done other things in the past that haven't worked, you got to let that go. I find traders are notorious for holding on to things that they have in their head. I lost this much money doing this, and I lost this much money doing that. Until you're ready to let that go, you're never going to move forward. And you have to look at every single day as brand new. Like I said, you deserve a second chance. If you've tried to make it and failed in the past, doesn't mean you can't make it now. Doesn't mean you can't make it with me, or if you learn something good. So think about what I'm saying. You want to invest in your own learning, your own education, your own well-being. If you really want to do this, and again, that's a decision that you can make. I can't make that decision for you. You have to decide if you really want to trade. I'm telling you, it's fun. It can be very profitable. It's exciting. I try to make it as fun as I can in the room, and even, you know, teaching the classes. And, you know, it's learning first is actually more important than trading. But, you know, again, if you have an account, you can start trading with me right away, even before the class. But you don't want to give all your hard-earned money away to the market in mistakes. And I think this 2026 market, like I said, with all the things that have been happening lately, has been ripe for people to be in this gambling mode. And it's trouble. It's trouble when it goes against people. So you want value from what you're learning. You want to learn something you can use for a very long time. And my class is value-driven education. You're going to get something out of it that you can use for the rest of your life, with or without me. But, you know, because I'm running the room and I'm the mentor and I design the system, you know, you'll learn from me. You'll learn from me when you're in the room and you're getting the trades and in the class. So I give the picks, I rate the gaps, I call the entries, the stops, the targets, I do it all. And I don't think it's hard to follow me in the room because I'm usually doing 1 or 2 things a day. I can try to make it very easy to follow me, but the trades do set up fast. The trades set up fast, quick, and you got to take them if you want to do them. But, you know, if you're someone that needs a mentor, needs that support system, you know, the room is a good support system. You want to be able to go ask questions of someone. And again, my class is a live class. You have to be there live, and you want to be there live to get the most out of it. Okay, so you've got to have conviction in what you're doing. You've got to have conviction in even wanting to do this, that you're driven to do this, that this is something that you want to do, that you want to trade. You have to believe in your trades. And if you find yourself on shaky ground or feeling like you're losing sleep at night, if you're going to bed and you're in a trade, chances are you have too much money at risk, or you should have got out of a trade that you were up, or again, there's no strategy behind that, and then you're going into that gambling mode. So think about that. Listen to that inner voice, that intuition inside of you that's telling you that something is right, or if it's telling you that something is wrong. You know what I mean? It's like, chances are usually your intuition is telling you like, oh, I shouldn't have done this trade, or no, I shouldn't have taken more, or whatever. Anyways, when you have conviction in the trading strategy, you can produce positive results. And when you do not have conviction in a trading strategy, guess what? Do not expect positive results. That's the problem. A lot of people don't even have a strategy at all. And then no wonder they don't have, you know, positive results. And success requires like strength. It's an inner strength. I'm a very, very strong person, or would have never been able to figure this out, or be on TV, or trade, or call trades for people to follow me. You know, not everybody has the same personality, but you have to be determined that you want to do this, and not worry about things that happen in the future, or classes that you took where you didn't feel like you got your money's worth, or trades that you lost in. That is part of the process. You got to get over it. And you got to move forward, because until you're willing to do that, you're not going to move forward. Okay. I also think it's important to have the financial goals for how much money you want to make, how much money you want to risk, how much money do you want to make between now and the end of the year. I think you got to get clear with your own goals. That's how you're going to be successful. And again, you know, if I could go back in time, I probably would have started out trading, you know, earlier in my life. I didn't start getting into trading till later after my mortgage career. I wished I would have done this right out of college. So it's never too late to do it. And it's never too early to start. Some people are like, well, I'll do it when I'm retired. Why? Learn now, even if you can't trade full time, because then you'll be ripe and ready to go when you retire, that you'll know what to do and you'll know how to do it. So think about what I'm saying. Think about how serious you are. How badly do you want it that you really want to do this? I mean, I can't believe half the year is almost over. Like I said, summer starts in a week, but there's plenty of opportunities still in the market and plenty of trades to do. So empower yourself today to trade if you want to. Invest in yourself as a trader. The class for June is June 13th and 14th, 9 a.m. to 5 p.m. Eastern Time. Classes online. All my classes are online. You must email me for the sign-up forms at melissa@thestockswoosh.com. The cost of the class is $6,999. You can call me and ask me questions. Again, I live in New York City. You can call me. I do pick up the phone or leave me a voicemail. I will call you back at 929-3200 GAT. And I'm doing a huge Memorial Day package. It's Fleet Week, actually, in a couple of days. Fleet Week starts in New York. And so this is huge. I talked about this earlier. If you sign up on Memorial Day, you'll get the trading room, the options newsletter, and the market report free to the end of next year, which is huge. If you sign up for the bundle, which is 3 classes, you get 3 classes and 3 subscriptions, and you're good to go to the end of 2027. And the price for the bundle is $89.99. And again, you will get the Golden Gap course in June, the Trends course in June, and the Options course in June, and then all my trades. So this is huge. I already have people start this, sign up, trade with me this week. And again, we had 2 winning days in a row. So again, until you do the class, it will go slow. It starts slow size. But again, if you have an account, if you are ready or set up to go, you can trade and you can do it. Any other questions? I know I'm getting close to the time.
No more questions. I'm just typing your information here into the chat. It's melissa@thestockswoosh.com. So ignore the first time when I did not do the stock swoosh.
Oh, I didn't see that. Well, there's only one stock swoosh. It's me. It would have bounced. It's thestockswoosh.com.
So don't bounce. Go to thestockswoosh.com. All right, that's it. That's all the questions we do have.
I will talk to you soon. Have a happy Memorial Day if I don't speak to you.
All right, sounds great. Thanks, Melissa.
Thanks.
All right, let me go ahead and switch over here a little bit. Okay. I promise. I'm working on this. Okay. Okay. Should be able to see that again. You should be able to see this again. And I think I'd like to do something a little bit fun right now. Do you guys like to have fun? We did a stock prize grab earlier, and it was just like say I want to win a prize, and you can win a prize. I like that idea enough, and a lot of people are typing in things. What I'm going to do now is I'm going to give away a prize. In order to win this prize, though, what I'm going to do is I'm going to have you guess a number between 1 and 100, and the closest person to the correct number is going to win the prize. So anywhere between 1 and 100, you can do this. So if you're watching a GoToWebinar, you can watch this if you're doing it on YouTube. Give me a number, any number between 1 and 100, and if you do get close enough that you're the closest person, you will win a prize. You might want to know what prize you're going to win. I will tell you. So on this particular prize, we're going to give away Larry McMillan's home study course. It's a $499 value. Contains over 20 hours of educational material spanning 14 topics. This video bundle is the perfect learning tool for traders at any level, divided into novice, intermediate, advanced volumes. A 14 seminar home study course promotes a comprehensive options learning experience in a slideshow seminar format, instructed by Larry McMillan himself. Larry's awesome. He does such a great job. Each educational video is more than an hour long and includes guided audio and visual instruction from Mr. McMillan. So that's a prize. Thank you to Larry McMillan for the prizes. We have a lot of numbers coming in. A lot of them. Okay, so it might take me a minute to figure out who the winner is. I want to make sure that we've got some guesses in YouTube as well. I'll have to do both of them. So let's just figure out what the number is. I haven't come up with a number yet. let's see, give me a random number between 1 and 100. 90. Google went kind of high on that one. Okay, 90 is the number. Let's take a look here at the chat. And let's just decide. Let's see who's coming in here as closer to 90. Do have a couple 50s. Russell came in before the number was guessed. No guesses of 90 now count, by the way. Russell looks like you're closest at 81. So I have your email here, Russell H. There we go. I'm going to go ahead and send this back to the chat. And let me copy that to the clipboard. I'll send that over to the team over at Larry McMillan, and they'll get that sent out to you. Congratulations, Russell. You want to press? Maybe I'll do that again. Stay ready. It's a fun way to do it. As we migrate to the next feature, I want to say thank you to Stocks and Commodities Magazine for the support of the event over the years. Really appreciate the work that they've done. You can find out more about stocks and commodities at traders.com. Also want to say, hey, have you joined the Traders Forum yet? You can do so. It won't cost you anything. Melissa just said we did a pretty cool, we did a podcast with her. We call them Ticker Talks. And we just talked about her trading experience in the markets and general stuff like that. We do that. We've gotten a lot more current event topical in our discussions about what's going on in the markets, and that's kind of cool. We'll talk about indicators. We'll chat all day about different stocks that we may or may not like and why we like them. I personally have learned a lot about the markets just by being a part of the Traders Forum, and I'd encourage you to come join. We'd love to have you hang out with us. We do talk an unhealthy amount about Costco there. You can join us at thetradersforum.com for free. So there you go. All of the specials, our software, as I've said a number of times, 32 years in a row, it's been rated #1 in its price category. We've talked ad nauseum about scanning and testing and finding the right trades. Tomorrow, we're going to talk a little bit about the patented forecaster that's in the software. Software is great. It has hundreds of methodologies. It's a toolbox that's designed to help you succeed in finding the right strategy, finding the right strat, entering at the right time to trade. Talked a little bit about the special that we're offering. If you buy a month, we'll give you the second and third month for free. Pricing starts at $75. You can get started at metastock.com/conf promo. You can call us at 800-882-3040. 3040. Yeah, that sounded wrong when I was saying it. Metastock.com/sales chat as well. So there we go. We do have, congratulations, Russell, on the win. I do have a little bit of an announcement to make right now. And unfortunately, our next presenter, John Thomas, had to go into emergency back surgery. He knew it was coming though, and he pre-recorded his message. So I'm going to go ahead. I need to make sure that I share this properly when I share this. So let me go ahead and share the screen again. I need to include media sound. And let's go ahead and share this. Okay. This, when I do this, it's going to mute my audio. It looks like I've never done this before. If you have any issues hearing the audio while the video is playing, let me know. But I'm going to go ahead and turn off my mic for now. We're going to go to his pre-recorded message that he recorded before he went into back surgery. So give me just a second. We'll go ahead and get everything started. And if you can't hear the audio, let me know.
Okay, the market shockwave, how to profit from the coming global crisis, is now on. And this is John Thomas, the Mad Hedge Fund trader, broadcasting to you from Silicon Valley in California. One quarter of all the profits made in the United States occur within 10 miles of where I'm sitting right now. That is how concentrated the AI boom has become. So take out your pen and paper to take notes. Or start typing into your smartphone, for I am in the early retirement business. Your early retirement. I'll tell you what to do, when to do it, and why. How would you like to become a successful investor, trade for a living full time? pay for educations, cover medical bills, pay off mortgages, and not just for you yourself, but for your entire family. I've seen plenty of people do that. You trade independently and make a lot of money at it. You get to do things other people don't get to do, like ride the Queen Mary from New York to England in the owner's suite, which is a mere $50,000 a week. Once you get to London, you can take the Orient Express to Venice, Italy. Once in Venice, you can then use your own private helicopter to go island hopping, so you don't have to bother with those pesky and expensive gondolas. They're now $100 a trip, and that's for a short trip. And you get to pursue any hobby you want, no matter how wild, dangerous, and expensive it is. In my case, I like to fly vintage aircraft, and I've flown plenty of airplanes older than me and plenty of airplanes that are 100 years or older. And of course, you get to buy the latest hot car. This is the second Tesla Model X that was ever delivered in California. Who got number one? Elon Musk. I was right after him. So, in fact, I've known Elon for 27 years when he first wrote the PayPal code. So, to earn that kind of money, you need to get some pretty spectacular trading results. And this is what we do. I mean, this is our main job. Our trailing 1-year return right now is at 62.83%. That's through last Friday. And you notice we basically are grinding up every day. Occasionally we get a black swan like we did here last April with the end of the trade war and the Trump tariffs. And after that, it was basically straight up with only drawbacks of a couple of percent. Big wins, no losses or minimal losses. That works for a lot of people. And I wasn't just lucky last year. This is my 20-year return. We're averaging 49.69% a year versus 29.77% for the S&P 500. See, the S&P is down here in orange. This is up in blue. And we only started using artificial intelligence back here in 2013. And since then, our performance relative to the rest of the market has taken off like a rocket. So 70, 80% years have really become the norm. It's the early days that are dragging down our averages. So why listen to John Thomas? Well, I do have 55 years of experience in the global financial markets, 10 years as the economist correspondent in Tokyo and later the White House. Yes, the same White House that Donald Trump is occupying. 10 years running the international equity division of Morgan Stanley in New York. Brief timeout as a Marine Corps combat pilot in Desert Storm. And yes, I do know the Persian Gulf like the back of my hand. 10 years running the first international dedicated hedge fund, 5 years fracking for natural gas in Texas, and now 20 years publishing the Diary of a Mad Hedge Fund Trader. I am one of a handful of founders of the modern hedge fund industry who is still working. I am also registered with the U.S. Securities and Exchange Commission, registered with the Commodities Futures Trading Advisor with the U.S. CFTC, registered as an investment advisor in the state of California. I passed the Series 7 securities license test, the Series 63 test. I get no commissions or kickbacks in making this presentation. We don't resell our subscriber information to anywhere. We value it like the gold that it is. For us, the big payoff comes when happy subscribers renew their subscriptions, and that, fortunately, is most people. The trading opportunity of a lifetime is at hand. The Iran war has destroyed the old investment world we knew, but a new one has arisen, creating tremendous opportunities for the well-informed. It's all about making money in volatile markets. Let me, John Thomas, the Mad Hedge Fund Trader, teach you how to make money in every market condition, up, down, or sideways. Draw on my 55 years of trading and investment experience, as well as my own Middle Eastern and energy industry experience. Cash in on my 90% success rate. Sleep in at night knowing your retirement funds are safe, and that's me in the Persian Gulf a couple of weeks ago with one of the original Arabian horses. The new economic reality, closure of the Straits of Hormuz has cut off 20% of the world's oil supply, 30% of the fertilizer, 10% of the aluminum, and 35% of the helium necessary for chip making. The Iran war may never end, but continue at a slow burn, on and off, eventually taking oil to $200 a barrel. The Straits will never reopen unrestricted again. We basically have had a free pass for the last 80 years, with the Iran wanting to charge $2 million a ship now. That alone will create $75 billion a year in new revenue for the Islamic Republic of Iran. Oops. With the doubling of value of their oil exports. The war gave Iran a switch to turn on and off the global economy, which it alone controls. If you can do that, who the heck needs an atomic bomb? They may be happy to trade off their nuclear ambitions in exchange for taking tolls on the Straits. The U.S. has created the most unfriendly investment environment in a century. Risk control is the order of the day. Many Persian Gulf oil fields were completely destroyed by the mandatory shut-ins and are never coming back. Gasoline prices will never return to pre-war levels. Middle Eastern oil sources have become proven unreliable and will not attract new investment from outsiders. Many damaged oil facilities will take 5 years and cost $5 billion to rebuild each. And believe me, I was on the ground a few weeks ago in the United Arab Emirates, and I saw the damage with my own eyes. Don't believe what you read in the media. Even if the war ends tomorrow, it'll take 4 months for the first ship to reach the U.S. or Australia with new oil supplies. U.S. is energy independent only on paper. The reality is that it needs to import 3 million barrels a day from the Persian Gulf to keep prices at $4.50 a gallon, which is where they are today. In the meantime, U.S. hoarding and stockpiling has increased demand by 3 million barrels a day. People are running around with their gas tanks full all the time because they're afraid that may be the last chance they get gasoline or petrol again. And there are long lines all over the state in California. So what did Trump get wrong on Iran? I mean, how could you blow it so badly? Well, he thought Iran would surrender in 4 weeks. Oops, we're now into week 11. The U.S. went into the war with ammunition and oil stockpiles at decade lows. The ceasefire happened not because we were close to a peace deal, but because the U.S. ran out of missiles, and it takes 6 weeks to restock. Anybody can be bought at the right price. This doesn't work in religious theocratic autocracies. Firing 80% of your intelligence staff and using the remaining 20% to invent false narratives to support your political views gets you really terrible intelligence. Trump was completely amazed that Iran responded to our attacks by attacking 12 other countries in the Middle East. Iran's military capability was wildly underestimated, attacking a dozen countries at once up to 2,500 miles away. There is no Iran opposition to step in and take control. Any potential opposition in Iran was executed a long time ago. Iran is in fact willing to sacrifice large numbers of its own people to stay in control. So stocks look kind of expensive in this global backdrop, which is volatile to say the least. U.S. stocks are not cheap, trading at a record 23 times earnings, and technology stocks are at least 50% higher than that. They dropped to a more reasonable 19 times at the outset of the Iran war, but the 2009 bottom was 9 times earnings, less than half the current level, and the current energy crisis is much worse than the 2009 subprime loan crisis. So lower prices beckon. Current earnings forecasts are based on a world that no longer exists with energy at half the current levels. We just had a great 17 your run in stocks, which is now ending. Maybe it's time to sit down, smell the roses, and start looking at short plays, how to make money on the downside. This is something I happen to be an expert in. There is a new game in town. The Iran war will accelerate the great rotation, which was already underway just before the war. It'll take money out of technology into non-tech, out of growth into value, out of domestic into international, out of non-yielding assets into high-yield assets, out of the US dollar into any foreign currency, out of paper assets into hard assets like gold, iron ore, coal, and so on, out of digital into real-world assets. This could go on for the rest of the decade. There is a method to my madness, and it's time to entertain a global long-short all asset class review. A global stock market crash is imminent. Could happen in weeks or months. You haven't seen anything yet. The 10% sell-off with the outbreak of the war is just a preview. What happens when the world completely runs out of jet fuel or gasoline? Gold took a huge hit in the outbreak of the Iran war, but will be the first asset class to come back. Any bond or fixed income investment is toast because interest rates will soar. Excuse me. Long-term bull arguments of super liquidity, tax cuts, artificial intelligence, falling interest rates are all ancient history. Those were all the arguments to buy stocks at the beginning of this year. Jobs data remains dire with massive layoffs happening in the US on a daily basis. Just yesterday, Meta announced they were laying off 10,000 people and Robinhood another 1,000, all replaced by artificial intelligence. Gas lines globally are already starting $10 a gallon or $2.50 a liter for gasoline. Here we come. US dollar is catching a new bid as global positions unwind. For a start, nobody's buying $2 billion a day worth of oil anymore because it's locked up in the Gulf. That eliminates demand for $2 billion a day in the foreign currency market. Commodities will sell off, then recover as AI accelerates. Bitcoin not moving much, didn't give you much downside protection last year. I'll take a pass on that for now, given the other opportunities that are out there. So what do these four names have in common? Well, any elementary school child in California knows who these people are. Stanford, Leland Stanford, Crocker, Huntington, Mark Hopkins, and Huntington again. Who are these people? What do they have in common? Well, these were the big four who sold the shovels to the gold miners during the 1849 California gold rush, becoming the billionaires of their day. Hint, you may want to sell shovels to the gold miners. That is where the big money is made. And of course, you can do that in the technology and semiconductor areas. The gold rush of 2026 is on. $1 trillion is pouring into artificial intelligence this year. The changes to the tax code has accelerated the move into the sector. This enormous amount of money is funneling into just a handful of companies. It will be a winner-take-all situation with a few companies succeeding. The big tech is building 7 new AIs when only 1 or 2 are needed. So we're building a massive bubble of overcapacity in AI, which will probably pop fairly soon. So this is why you're seeing some tech companies do really well right now and others are getting their stocks absolutely slaughtered. The big play in AI isn't buying the winners, but selling short the losers, of which there will be many. And how do you find the losers? Well, just talk to John Thomas. We know plenty of them. Get in on the early stage of the right companies, you will increase your wealth by 100-fold. So you get numbers like this. Again, you get to live a lifestyle of your dreams. And again, we've had AI as a supercharger for the last 13 years to give her these blockbuster numbers. And we make money every month. The goal is to have every month positive. And we've been able to deliver that for a couple of years now. And you can see we made 5% in January, 3% in February, 4% in March. We're up 818% since we started this service 20 years ago. But don't take my word for it. Listen to a subscriber who's made a fortune following my daily trade alerts. And this is going to be tricky to get started. Yeah, let's see, try this.
Hi, my name is Wilson, and I've been with the Mad Hedge Fund Trader, John Thomas, since 2019. I caught the phenomenal returns in 2019 and 2020, somewhere in the order of the 80–90% returns on both of those years. I caught all of those trades, NVIDIA, the TLT, the Teslas, and so many more. And then in 2021, I started trading in some additional accounts, and I have caught almost all of those trades as well, and have been getting almost the entire returns that John has received, and it's been just fantastic.
All right, thank you, sir. Okay, let's look at the individual trades that my friend Wilson here did to get those kind of results. He made 482% on NVIDIA, another 811% on NVIDIA, 421% on Berkshire Hathaway, 412% on JP Morgan, 394% on Palo Alto Networks, 350% on Vertex Pharmaceutical, 113% on silver, and 87% on JP Morgan again. And of course, those who are in the market on a daily basis know these stocks didn't move anywhere near that much on a certain amount of time. And in fact is we have customized strategies that deliver very high returns on fairly small stock moves with minimal risk. That is something we can teach you how to do. I'd much rather teach you how to fish so you can support yourself for life than actually give you the fish. I think there's something in the Bible about that. Okay, so this is our secret weapon, the Mad Hedge Profit Predictor. That is our market timing index. It's an artificial intelligence-driven algorithm that analyzes 30 different economic, technical, and momentum-driven indicators all day long. Took a team of mathematicians, 1,000 hours of calculations to create this, and this is our big money maker. Whenever we get down to the low end of the range, where we were a couple months ago, that generates strong buy signals. When we get up to the top of the range, those generate still strong sell signals. Go long, go short, go long, go short, go long, go short. It's a real money-making machine. And this is this morning's update. You can see we're at the very high end of the range right now. This is 1 year of hourly market timing index readings, and you can see we had 3 bottoms over the last year. Back here in the trade war crisis, back here in the end of November, and here right before the Iran war. It's like they knew something was coming, and then it took off like a rocket once the peace talks were announced or hinted at or rumored. And of course, we got this gigantic move up here. So we moved very rapidly in just 1 month from buy territory to sell territory. That means you should be looking for short plays right now. And of course, you don't want to short the market leaders here, things like Micron Technology, NVIDIA, Intel, and so on. You want to support the loser. You want to short the losers, the ones that failed to participate in the rally. And that is most stocks in the market. They have not participated. It's been the most concentrated bull market in history. It's literally to be found only in a couple dozen stocks. So lots to do. You just have to know where to go and how to do it. Why do you need an algorithm? Well, why use a toolbox missing its most important tool? Algorithms become so dominant in the market, you should never trade without one. It does the work of a seasoned 100-man research department in seconds. It runs real time and optimizes returns with the addition of every new data point far faster than any human can. Imagine a trading strategy that upgrades itself 1,000 times a day. It is a learning program. Don't go to a gunfight with a knife. If you're trading against algos alone, you will lose. Algorithms provide you with a defined, systematic trading discipline that enhance your profits. I talk to starting traders all day long. The big question they have is they don't know what to do. Well, this tells you exactly what to do, how to do it, and when to do it. Once you like someone tapping you on the shoulder when it's time to buy and everybody else is throwing up on their shoes, and when it's time to sell when everybody else is euphoric and believing that things can go up forever. That's very handy to have, by the way. I used to be one of those people. That's why I know. This is 3 years of profit predictor performances. And you can see we get many round trips a year, lots of buys at market bottoms, sells at market tops, buy, sell, buy, sell. It's a great timing tool. You use something like that, and suddenly trading goes from being highly stressful and risky to a joy. I look forward to getting up every morning and seeing what's happened overnight and how I can start my trading days. And of course, you become successful as a trader. You get to do things that other people don't do, which I mentioned, like buy a $2 million boat, which is called the perfect trade. How about that? I actually had a perfect trade on Monday. We had a $10 rally in oil because of some shooting in the Persian Gulf, and I knew it wouldn't last because the U.S. doesn't have any ammo. So I shorted oil when it was shorted the USO when it was up at 155, and it's since dropped 20%. And that option display expires on Friday at a maximum profit. People who picked up the trade will end up making 10% on their capital just for this week alone. And of course, I'm not the only one using algorithms. I was walking on the Miami, Florida waterfront and found this super yacht. Algorithm trading is some 80 to 90% of all market trading right now. So why cover all asset classes? It sounds like a lot of work, and it is, but I love doing it. I've been doing it my entire life. Information about one asset class sheds light on all the others. For example, knowing what the bond market is going to do, and therefore the interest rates, is an incredibly useful advantage when picking stocks. Some asset classes will be doing great, while others are dead in the water. It will point you to where to trade with winners and avoiding losers. Give yourself every advantage. Know what's happening all the time, everywhere. So what do you want to do when the euphoria wears off in the market? Well, there are a lot of core trades you can do to make money in that situation. It's time for you to become a bear market expert. And when do you become a bear market expert? When there is a runaway bull market like we have right now, because your bear skills are about to come into demand. So I'll start with the easy ones first. There is the SDS, that's a 2x short ETF that goes up $2 in value for every $1 the S&P 500 declines. And you can see it's been performing really well. When the Iran war broke out, the SDS was at a lowly 67. It made it all the way up to 80. That's about a 25% gain in 1 month. That is a good moneymaker. And of course, you're making money while everyone else is losing their shirt. Not a bad feeling to have. And we have, if you don't want a 2x short ETF, there's a 3x one out there, the SPXU, and that really goes up triple the amount that the S&P 500 goes down. And you can see the track record here shows it delivers. It started out at 45 at the beginning of the war, made it all the way up to 62. That's almost a 45% profit in just 1 month. Not bad in a falling market. You can also, if you have long equity portfolios, which most of you do, and you all own the same stock, so it's really to figure out what you own, you can sell short call options against your long equity position. And what that does is it lowers the average price of your cost on the stock, and reduces the volatility of your portfolio because you're taking in money against your long positions. In this particular example, we sold short the October 2025 470 calls in Tesla for $38 a share, and that is just for 1 month. And we collected $1,000 as for each dollar that Tesla went down during that time. And of course, Tesla went down a lot from 470, went down from 470 down to 340, about $130. So 130 times 1,000, you can do the math. Another very low risk, very easy way to protect your portfolio and bring in extra income. And you can do this every month. You can also buy volatility, the VIX, the so-called fear index, and you can see the VIX actually started anticipating the war at the end of 2025 when it was all the way down here at 12. We made it from 12 up to 36 in just 2 months, and then we shorted it. You can short VIX also, bring in a lot of time premium that way, and there are lots of options, futures, ETFs that allow you to play these gigantic moves in VIX. There is also the IPO ETF. Turns out that recently issued stocks or IPOs go down twice as fast as any other stock in a bear market. And you can see that here, where we had that huge sell-off last February when Trump came into office. And the IPO ETF, as it is called, went from 48 all the way down to 39. And of course, once the trade war ended, big pop there, another way to play the market volatility. There's also momentum. It turns out the momentum dies in falling markets. So you want to be short momentum in down markets and long momentum in up markets. And of course, another great way to hedge your portfolios and diversify your risk taking. And of course, there's the high beta ETFs. Beta also collapses, or the daily movement of single stocks. And again, it's another instrument to play market directions, and we can tell you when to go long and when to go short, thanks to our algorithms. And then, of course, there's the hedge ETF. It's an ETF that hedges all movements in the markets. And you can see going into the war, we had a tremendous run up and are now selling off. Of course, if the kitchen gets too hot for you, you don't like the volatility, you can always hide out in 90-day U.S. Treasury bills, which are currently yielding 3.53%. That is a government guaranteed principal and interest, endless liquidity. These trade like water, 100% collateral value for margin. So you can keep all of your money in 90-day T-bills and then trade options against it and just use the T-bills as collateral. You can lock in a guaranteed income. It's nice to know you have a guaranteed profit of 3.53%, which you can then trade options on top of that. You can sell them anytime. You get paid interest up to the day. They'll survive any bear market, but you have to ask your broker how to buy them. And by the way, Warren Buffett's Berkshire Hathaway owns actually, it's now $400 billion worth of 90-day T-bills. So let's just cover some of the major asset classes here. Stocks, we just saw a gigantic short squeeze in the market, which took stocks to all-time highs led by technology stocks. The global airline system is grinding to a halt, creating fuel prices rising up to 400% One airline, Spirit Airline, in the United States, already went bankrupt because of high fuel costs. Big banks are shaking off their private credit fears, but are taking a break because interest rates are rising. Netflix tanked on good earnings, but weak forward guidance. Maine becomes the first U.S. state to ban server farms, and there'll be many more states after that. They don't want the big tech companies coming in, draining off all their electricity and fresh water. SEC removed day trading limits, prompting a 25% jump in Robinhood. That is great news because it'll increase market volumes and market volatility. Amazon is taking on Starlink, launching their own satellite-driven telephone system by buying Globestar for $11.6 billion. United Airlines tried to take over American Airlines to make one company that has 40% of the airline business in the United States, but that's since died away. And Wells Fargo misses, sending the shares down 6%. One of the big surprises of the Iran war is how badly defense stocks have performed, and that's because they all have guaranteed profit caps in dealing with government contracts. So this is the buy right now group. This is the next group of stocks that will lead to the upside once technology takes a break, which inevitably will come. You want to be pouring into emerging markets. And of course, our favorite is Brazil. They have an ETF, the EWZ. They just had an election with a pro-business outcome. Interest rates are falling. The currency is appreciating, and they're replacing the U.S. as a major food exporter to China. I was just down there a couple of months ago, and business is booming. You want to be in Brazil. I'm looking for a 50% gain here, and it's also a great leaps candidate, which I will talk about on another day. And you want to buy the emerging markets ETF in general. It's also been one of our top performers. We're also looking for a 50% gain here. It's cashing in on the fact that China's economy is stronger than Europe or the US, and it's also a weak US dollar play, which we are absolutely certain will happen. This will be one of the best weak dollar plays out there. So these are the buy on panic days groups, and you need the discipline and a market timing index, by the way, to help you identify the panic days. You can look at halo stocks. What is a halo stock? It is a high asset, low obsolescence company. It can't be replaced by AI. So many businesses now are having their stocks wiped out because AI is about to eat their lunch. And I'm talking about big companies like Microsoft, like CrowdStrike, Palo Alto Networks, and so on. They are immune to AI shocks hitting low asset, high obsolescence stocks, which are the software companies. Halo massively outperformed Laho in recent months, in January until the war started. And these are typical Halo type companies. Texas Pacific, Corning Glass, Southern Company, Baker Hughes, an oil company, Southern Copper, FedEx, Hershey, Colgate, Apple, of course, has the ultimate brand, and any oil company. So let's take a quick look at the banks. They will be a major market leader as soon as interest rates start going down, which will happen later this year. JP Morgan, we're expecting to see $400 a share, and this is the buy signal generated by our AI algorithm. And when it happened, and it happened, of course, all the way back here after the end of the trade war. Citigroup falls into that category. So does Goldman Sachs, one of my favorites. A huge trader, $50 a move is not unusual in this stock, so it's a great options player. Morgan Stanley, where I worked for 10 years, great company, just hit an all-time high today. BlackRock, beaten up by the prime credit crisis, but now is recovering. And Interactive Brokers, another new all-time high. on exploding option volumes. By the way, 70% of all traded options now are same-day options, and all of that volume has showed up just in the last 2 years. So that makes Interactive a great company, and I don't understand why it's so cheap. So I'll be buying the next dip when we get it. Second half of the barbell are technology plays. These are the sell on rallies group, and we're having a heck of a rally now. Could be prime time to sell. One is the index. We expect a 20% correction in NASDAQ to happen this summer. Tesla looking for new lows here. The car business doesn't make money, and robots are years away in profitability. In the meantime, there is nothing to do but do the SpaceX IPO. So people will be selling Tesla to buy SpaceX. Yes, that will be the play. Microsoft getting slaughtered as a lead software company. Stock dropped 40%, struggling to recover, but it's just not happening. And by the way, these are all planes that I've flown in various air shows over the years. That's a B-17 bomber right there, which I'm qualified to fly. And that's a B-24 bomber from World War II. Palo Alto Networks, another software company, getting slaughtered. Bonds. You want to forget about bonds. Forget you even heard the word bonds, because there are no investment opportunities here. And in fact, there are probably some good short opportunities in the bond market, and we'll talk about it in a second. Interest rates are soaring as the market is pricing in no interest rate cuts for this year because the inflation rate has taken off, because guess why? Gasoline prices are up 50% in 2 months. Iran war-driven inflation is the reason. Gas prices up 50% in 2 months. The only buyer of U.S. government bonds right now is the U.S. government. They're basically, taking money out of one pocket and putting it in the other. And Treasury's doing the issuance. Federal Reserve is doing the buying. The last country to do this was Japan. And the end result of that is a stock market that didn't move for 35 years. Ouch. 10-year Treasury yields topped 443 a couple days ago. They're on the way to 5%, 6%, and 7%. So great short play there in the bond market. Australia's raised interest rates. They're also part of that trend, and private credit jitters have spilled into Wall Street, dragging down the specialist companies there. So here's the ETF. The TLT just broke down to a one-year low, and 10-year yields to a one-year high. So the harsh truth is, you really need my help. The majority of individual traders lose money. They lack the correct training and discipline to succeed. Most broker research suffers from grievous conflicts of interest. Wall Street is all about moving money from the uneducated to the educated. The easy solution is to get educated yourself. Fidelity did a 20-year study and learned that their top performing investors were dead people. Why did dead people do so well? They never sell. And this is the last broker I spoke to. I found in a shop in northern Italy. His name was Pinocchio. I didn't believe a word he said, quite honestly. Gave me terrible advice. You need a real pro to guide you through the market maze. The market is not monolithic, and 95% of it can be completely ignored. There are a few great sectors and a lot of awful ones. You can earn a 10x return on the great ones, but get wiped out by the losers. Let a 55-year veteran steer you to safe waters. Let me sit next to you and guide your hand on every winning trade. 81.58% trailing one-year return. That is a performance to die for. Richard made millions religiously following my trade alerts. He now spends his time restoring vintage aircraft and flying them over the California coast, and occasionally he lets me fly one. Greg turned 100,000 into 3 million solely on my trade alerts. He bought a new home in California with Tesla solar panels, Tesla Powerwalls, and a Tesla Model 3. Still had enough money to send 3 kids to college. So let's talk to another investor who did very, very well following my trade alerts.
This is Bob. I live near Denver, Colorado, and I'm hiking on top of the Continental Divide. 9 months ago, I joined John's global dispatch service and was so impressed with the profits I made that 2 weeks ago, while hiking in the Dolomites, I joined his concierge service. And in 2 weeks, it is 100% paid for it, and I couldn't be happier. Life is good. John really helps. The other day, I had a text message exchange with him regarding some concerns I had with TLT. Put spreads, he encouraged me to stay in. I did, and today they went out at 95% of maximum potential profits. And that's the way it works for me. I hope you all do well trading yourselves. Thank you.
All right, Bob, thank you. So what do we do about all this? Well, stocks, you want to sell rallies. Bonds, you want to sell rallies. Commodities, sell rallies. Energy, buy dips. Currency, buy dips. Precious metals, buy dips. If you are not up 81.58% in the last 12 months, as I was, you are reading the wrong newsletter or following the wrong trade mentoring service. Most of these people have never worked on Wall Street. 50.97% annual annualized return. And here's the very long view. The 2000s were the hard decades for making money in the wake of the dot-com bust. The making money in the 2022 to 2030 period will be like falling off a log as a new AI golden age ensues. Only a select few will make big money for the next decade. Now is the right time to join that club. Sit with me, John Thomas, the Mad Hedge Fund Trader, and my Global Trading Dispatch. Discover how you can tap into the top performing trade mentoring service in the industry, up 81.5% in a year. Follow my research and market beating trade alerts, and you will rake the profits in. Let a Marine combat pilot steer you to big profits. We trade single stocks, options, and ETFs for global equities, bonds, foreign exchange, energy, commodities, precious metals, and real estate. And yes, that's my 1932 de Havilland tiger moth, which I keep in England, and I fly a couple times a year. This is a typical trading month for us. You can see 10 out of 11 trades made money. We made 16% buying the S&P 500, 8.6% shorting treasuries, 14% on Russell, 12% on Amazon, 7% on Apple. We lost 21% on Biogen. We stop out of losers very quickly. It's easier to dig yourself out of a small hole than a big one. Just a matter of time before stocks break down to new lows. Watch this space melt down into the 2030s. Get ready to start reeling in those whoppers with Global Trading Dispatch as your guide. This is how it works. Our algorithm identified an upside imminent breakout in NVIDIA, so we sent out a trade alert. And this is what a trade alert looks like. It says buy NVIDIA at 48 or best, opening trade, and in this particular case, you need to buy 210 shares for a $10,000 exposure. What happened? NVIDIA went up almost every day for 22 days, or about 45%. Do we just sit around and pat ourselves on the back? No, we send out a trade alert. It says sell, take profits. Sell NVIDIA at $69.50 or best. And on this trade, we made $4,515 on a $10,000 investment in just 22 days. So with my Mad Hedge Global Trading Dispatch, you get instant trade alerts sent out at market sweet spots, about 200 a year, and all the reasons to execute them. Live bi-weekly strategy webinars with an interactive Q&A highlighting the next trading opportunities. Special reports on urgent investment topics, invitations to strategy luncheons around the world, and my next ones are going to be in New York City, the Queen Mary, our seminar at sea, London, England, and Amsterdam. Get new trading ideas on a daily basis. I'll even give you the name of a surfing camp for seniors in North Africa. Watch out, it's a lot harder than it looks. This is the one-stop shop. Learn all you need for every level. It's for individuals who want to understand what is happening with their retirement funds. It's for people who want to learn how to trade for a living, get the financial education of a lifetime. It's for smaller institutions and financial advisors who can't afford an in-house research department. Get in before the next melt-up or meltdown begins. This is what you get with our service. You get our global market comments in your inbox every morning telling you what to do that day. And you get our Mad Hedge hot tips, 5 most important things that happened today and what to do about them. This is why I'm not going to charge you for this service. I'm not going to charge you $100,000. That's what I charge my big hedge fund clients, and they're happy to pay because I make them millions of dollars. And I'm not going to charge you $3,500. That is the full price on our website, which we offer the public. This is the real deal. Creating this product cost me millions of dollars. With the best customer service in the industry, running it cost me millions more. This is the offer you can't refuse. Just $997 for 6 months. This is a limited time offer. This is an exclusive service, so we only take 25 new subscribers at a time. First come, first serve. I can't wait to make you a top drawer trader. Just click on the chat box on the right. That'll take you to a dedicated sales page, which is only available today. And there it is. And I see https://madhedgefund.com, blah, blah, blah. So click on that. That takes you to the sales page that is only available right now. 6 months for just $999. I keep kicking myself. I should be raising the prices of this thing because we're just making so much money for people. Buy now and you will instantly receive a trade alert with an extremely high probability of success that you can execute immediately with the next market opening and make some of the most serious money in your life. Don't leave good money on the table. 90% of these trade alerts make money immediately. And just to give you a tease, here's the chart for the trade alert that is waiting for you in your inbox as soon as you subscribe. Sign up now, you'll receive my free video course, Options Trading for Beginners. It's a 12-chapter course about everything you ever wanted to know about options, written for the basic beginner, but it turns out old pros like taking that course too. Subscribe you now, and you can join my May 19th Traders Workshop, only available to new subscribers. There is no such thing as stupid questions, only stupid answers. Albert Einstein said that. Learn some of the tricks and strategies that only the most seasoned pros understand and make money hand over fist with. Give yourself the unfair advantage you deserve. So if you're going to work with me for 6 months, it's best to find out who I am. My family origins are very humble, growing up as the oldest of 7 children on a remote farm in Southern California. I lived the all-American childhood playing Little League baseball and becoming an Eagle Scout. There wasn't much to do in the old days in California but hunting, so I picked up a job as a paperboy for the Los Angeles Herald Examiner. There I found stock pages, bought IBM at 20, sold it at 30, and suddenly found a far better way to make money than delivering newspapers off the back of a bicycle. By the time I was 16, I earned enough money to fly to Europe. By the age of 17, I'd visited more than 50 countries and spoke 4 languages. At UCLA, I majored in math and DNA research, which landed me a job at the nuclear test site in Nevada. Their yield didn't mean interest paid, but millions of Russians killed. I didn't see much of a future in that, so the government sent me to Southeast Asia for a few years of intelligence missions where I learned how to fly and jump out of perfectly good airplanes. Then I advised the militaries of America's Asian allies. As the war wound down, I became a foreign correspondent for The Economist magazine in London. When they learned I had a math degree, they switched me over to covering the Asian economy and the stock market. And all I got for my 10 years of government service was this box of medals. which I trot out once a year on Veterans Day. As a foreign correspondent, I covered China during the Cultural Revolution, was the first American reporter to visit North Korea during the Korean War, and covered the rest of the continent all the way to India. I figured out very quickly you didn't have to be that smart to make money in the stock market, so I got into the industry, joining Morgan Stanley. After 10 years there, I started my own hedge fund. And yes, that's my original ID card from Morgan Stanley. Yes, the years have been cruel. I rapidly became the top performing hedge fund of the 1990s, eventually bringing in a 1,000% return in a decade. Then the money really started to pour in. It's an understatement to say that when your income goes from the thousands to the tens of millions, it really has a big impact on your lifestyle. You get to fly the latest airplane, buy the latest hot car, collect vintage Rolls Royces, and go marlin fishing in Mexico. I now spend my days pursuing my first love, finding winning trade alerts. But I now do it from my 3 mansions in San Francisco, Zermatt, Switzerland, and Lake Tahoe. And I've quit turning millionaires into billionaires. If I can take a $50,000 account, turning into $500,000, that is more job satisfaction than I could ever get anywhere. I now travel the world ferreting out the best trading opportunities anywhere I can find them. And I can see the orders are starting to pour in. So if you are sitting on the fence, hemming and hawing, go ahead and make your move. Subscribe now because the store shuts off at 25 sales. In the little free time I have left, I pursue my other love, flying vintage aircraft on weekends. You see an old plane flying loops over San Francisco or London these days, it's probably me. The ultimate luxury, of course, is to give to those who need it. As a Marine Corps veteran, I volunteer for grief counseling for widows and orphans and am a major donor to wounded warriors. When wildfires hit California, I visited the main evacuation centers, handed out $10,000 worth of Target gift cards. So let's go flying and fasten your seatbelts, because sometimes people get airsick watching this video, but I'm going to go ahead and start it anyway. When you make millions of dollars for your clients, you get a lot of pretty interesting invitations. $5,000 cases of wine, lunches on super yachts, free tickets to the Olympics, and dates with movie stars. So it was in that spirit that I traveled to the famed World War II. Let's get going. To the famed World War II fighter station at Biggin Hill in England to meet Mad Hedge member Peter Monk. Peter was a poorly paid pilot for Ryanair when he first signed up for my global trading dispatch. After doubling his money in the first year, the money really started to pour in. Peter plowed his Mad Hedge trading profits into restoring a 1940 Battle of Britain veteran, a Supermarine Spitfire Mark IX, in his backyard, begging, borrowing, and trading for parts all over the world. He eventually built his fleet up to 16 flying aircraft, which today are worth over $65 million. When Peter invited me to fly one, I jumped at the chance. It was a mild and blustery day when we took off and headed for the English Channel. Even though the plane was 82 years old, we managed a brisk 250 miles per hour over the countryside. The Spitfire could outmaneuver any plane the German Air Force could throw up against it. This particular plane is credited with shooting down 2 Messerschmitts, and it's easy to see how. We found a clear piece of sky over the white cliffs of Dover between 2 big fluffy cumulus clouds and commenced a full-on aerobatic flight test. Pilots always want to see what I can do with these old planes, and this time was no different. I executed multiple loops, barrel rolls, chandelles, lazy eights, Immelman turns, and wingovers, careful not to exceed the 1G limitations or the wings might fall off. Spitfires can dive like crazy. We dropped from 8,000 feet to 2,000 feet in seconds. Then it was back to Beacon Hill for a perfect 3-point landing and a pint of beer. Let me make millions of dollars for you, as well as I've done for thousands of other people over the last 20 years. I look forward to working with all of you. This is the offer you can't refuse. Just $997 for 6 months. Okay, this is John Thomas, the Mad Hedge Fund Trader, signing off for today. Good luck and good trading.
All right, there you go. Oh, okay, hold on just a sec. All right, that's the video. Hopefully John's surgery went well today. Let me go back and get into the PowerPoint. And we can kind of just move on from there. So here we go. You should be able to hear me again. That was an interesting presentation that John did. I'm glad he was able to kind of get a recording ready for us. As we move on to our next live presentation, I do want to say thank you to Stocks and Commodities Magazine again for supporting the event today. They've done a great job of supporting us over the years. I also want to remind you to go to thetradersforum.com. You can register. You can get an account for free. You can chat with other traders, learn about the markets. It's a community of traders helping traders, all that kind of stuff. Today, if you want to take advantage of any of the specials that we've talked about so far, you can go to metastock.com/conf promo. You can go to metastock.com/sales chat, and you can also give us a call at 800-882-3040. So our next presenter, and this is something I'm pretty excited about. We have a brand new product. In fact, we just barely got it out of testing yesterday. Dan's going to talk about it. Dan, I like to call Dan the mad scientist of trading. And we've been working on a new band concept that really looks cool in MetaStock. So, Dan, let's make you the presenter.
All right, man, I'm ready. Let's do it.
And I can guarantee Dan is 100% live today.
100%, baby.
All right, let me make you the presenter. Here we go. All right, should ask you if you want to share a screen.
All righty.
I can see it. I can hear you. Let's get you started. I know we're starting you just a little bit late, but take your time. No worries here.
No problem at all, my friend. Hey, friends. How you feeling today? All right? All right. I'm feeling pretty good. Pretty good.
I'm good.
Now, quick question before we start. Have you ever felt frustrated when your trading income just isn't quite what you think it should be? Like you're being pulled in two directions. On one side, you want that feeling of the safety of selling way out of the money option spreads. On the other side, you want to make money by collecting those big fat premiums, which require closer to the money option spreads. If you ever traded credit spreads or wing spreads or covered calls or cash secured puts, you have felt it. Today, I'm going to share how I discovered a simple way to get closer to that perfect sweet spot, that way to avoid stocks blowing through your strikes and taking in the most option premium. And that, my friends, is the key to making money with income trades. Hey, listen, I have a question for you. I don't know if I can see the questions box. Am I able to see the questions? Let's find out. Hit that questions box and tell me how many income trades you make in a typical month. Do that right now. That'll let me know whether I can even see the questions box or whether I should save my breath.
I just made it so you can see the questions box.
Oh, I can see it.
Yeah, you can. Yeah.
Awesomeness. Russell makes 81. Boy, that's a specific answer. What happens when you find an 82nd grade trade? You make that one too? Who else? Who else? Come on, I'm taking a little survey here. How many income trades do you make? And I'm talking like covered calls, cash secured puts, credit spreads, even iron condors and such. How many of these income type trades do you make in a month? 81, 13, about 10, 20-ish. Well, listen, zero. Hey, Neil, what's up? I didn't know you made zero. All right. Well, listen, those of you who are listening in on this and want to learn how fear and greed can destroy income trades so that you can maximize your profitability with them, whether you've been doing them like Russell, who's done 81 of them in the last month, or Neil, who's just getting started with them, you're in the right place at the right time. And what I'm going to share with you today can change your trading forever. Before we get started, I need to point out options are not for everyone. Please read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here is providing generalized information, not specific to your situation. Friends, I have been there. As traders who use options to earn income, we've all been there. Because here's the problem that you have. Income traders are always in a state of either worrying about the stock blowing through their strike price, leading to early and unwanted assignment on wheel trades or credit spreads, and you end up making less money than you should or losing money. Another super common trade killer is you don't make enough on your trades to make it worth it. Your premiums are too small, and it's just not worth it. For spread traders, one loser wipes out 10 winners. For wheel traders, you make too little and miss out on too much. You're stuck in the middle and being pulled apart, and you know it. You feel it. You have felt it before, haven't you? The answer is yes. What we're really talking about here is fear and greed. And it's a balance between the two. But here's the thing. What if you could find the balance? What if you could hit what if you could hit that exact sweet spot every time to maximize your chances of not getting assigned and giving up real money, not having your shorts in the money, but to make the absolute most profit on every trade by taking in a big, fat, meaty premium every time, selling that exact perfect strike, option traders? Wouldn't that just make your life so much better? Well, that, friends, is what we're going to cover today. I'm going to share with you a new tool I've created to trade my covered calls, cash secured puts, and credit spreads with an edge I honestly never dreamed possible. And then I'm going to share how you can use it too. I'm Dan Passarelli, and this is a pictorial representation of just some of the companies that I've worked with. I'm a former member of both the Chicago Board Options Exchange and Chicago Board of Trade, now part of the CME Group. I'm the author of 2 of the top option trading books, The Market Taker's Edge and Trading Option Greeks. And now, Wiley has just published my new book, Build Consistent Wealth with Options, which has been in the bestseller list on Amazon in the category of options for 3 weeks since the day it launched. I've been a regular contributor to Bloomberg TV and Fox Business News and lots of other online publications, and I train income traders and investors just like you, literally all over the world. Thousands of traders in over 50 countries. Let's say you have a stock like this, and maybe on this trade you're trading as an investor, and you're considering selling a covered call on the stock you own. Not to get assigned and sell the stock. That's not your motivation, but instead to profit from the option premium. Okay. Or maybe you're looking at the stock and you're an active trader and you're thinking about a call credit spread. What are your 2 goals? Make more money, which you get from a bigger option premium, because the more you sell the option for, the better, right? And the lower the strike price, the more money you make on option premium, right? See that? But if you set the strike at too low of a price, you might get assigned and you might miss out on the big money. And if it's a covered call, you might miss out on big upside, or you might have a big loss if it's a call credit spread. Okay, well, where do you set your short strike? Let's make this easy and assume we're talking a covered call. There's several tools traders use for picking the strike price. We can use resistance, and we should. But with this stock, basically, we formed one resistance and not really even the other one yet. We hit an all-time high. There's not really enough data to make a data-driven decision. So using resistance is not really what a real trader would do. So resistance, I don't know, not really here. Use delta, that's not ideal for some reasons. Standard deviation, premium, maybe it just feels right. None of these are irrational, but none are really data-driven. They're all in some way arbitrary. They might make you feel good with a false sense of confidence, but they won't help the trade work out. And yes, the best traders here will use implied volatility and theta, and probably even use the annualized static return. And I do too. But what is the likely range for the stock to be in between now and the option's expiration date? Without having a way to understand that based on real data, nothing else matters. But here's the problem. The solution didn't exist. I looked at Bollinger Bands, thought maybe that would work. RSI, ATR, Keltner channels, even stochastics, nothing. Nothing was built for option traders to anchor option strike prices. Back around 2010, there's this company, a big company, you've heard of them. They asked me to actually build an indicator for them. And I said, no, I didn't. I honestly didn't think I could do it. I assumed that building indicators were for genius mathematicians. But now I needed one. I needed a way to make more on my wheel trades and my credit spreads, and I needed to stop seeing good trades destroyed because of the stock going through the strike price so much. That's kind of the stuff that kills your P&L. So I talked with some of the smartest guys I know when it comes to charting indicators. It started with an idea, and now, well, I made a key discovery. I was able to, for the first time ever, create an indicator that was based on real data that could give a true range between now and the option's expiration date. The date that the stock, or the range that the stock was most likely to trade within. It's the perfect indicator for income traders to choose strike prices most likely to produce a winning trade, and the results are powerful. I call it the Price History Anchored Strike Indicator, PAS. The PAS indicator is designed to cut through the guesswork of option strike selection. Instead of pulling levels out of thin air, it anchors each decision to a stock's actual historical range over a defined look-back period. By grounding strikes in price history, PAS gives traders a data-driven edge, highlighting levels where probability, premium, and price action all intersect. The indicator is the only indicator created by an option trader for option traders. Based on some math that we'll explore in a few minutes, the bands identify a range based on the past price history where the stock is unlikely to rise above, in the case of the light blue line here, or fall below in the case of the lower royal blue line. This is for traders who want income. It is the most powerful indicator created for covered calls, cash secured puts, credit spreads, both call and put, condors and iron condors, butterflies and iron butterflies, and even time spreads and double calendars. Let's talk about a covered call real quick. I know I'm throwing some strategies out there, and I know not everybody is a hardcore options trader. Covered calls, they're reasonably simple to understand. Here's a quick crash course. It's going to take me about 30 seconds. So a covered call is when a trader or investor, difference, owns 100 shares of a stock and then sells one call on that stock. Each one call represents the rights on 100 shares. So when I sell a call, I'm selling it to someone who's buying it. That person is paying me money, a premium, option premium, for the right to buy that stock from me. So I might sell that stock. If I put the stock at a higher strike price, then if the stock goes up, I might sell the stock at that higher strike. But let's narrow in on what the objectives can be for this. The possible objectives are either one, just to skate and profit from just the option premium. That means I sell the option premium and I don't want to sell that stock. I don't want the stock to go up above that strike price, which is the price I'll have to sell the stock. Or my objective might be to sell that stock at a strike price above where the stock is. And if the stock goes up to it, for the stock to go above that and for me to sell the stock at that strike price. I can have either of those objectives. So look, let's say I own the stock that's trading at $120 a share. I sell one 14-day to expiration, 125 strike call at $1. Okay, so what happens here? If the stock stays below $120 between now and expiration, the option expires and I get to keep that $1. So basically, my break even becomes $119 a share. It's like I lower my cost basis. And I have done this on some stocks where I basically own the stock at a 60% discount. Yeah, I collected so much option premium that I collected 60% of what I actually paid for the stock. This is possible. This is what is so attractive about this kind of trade. If the stock is above the strike price, well, that's fine too. Then that might be fine. I would sell the stock at $125 a share, which is good. I make $5 on the stock going from 120 to 125 plus the dollar option premium. I make $6. But if I really thought the stock was going to continue a lot higher, I left money on the table. So let's talk about this. Here's an example. I've got GM. Now, in this example, let's say I own the stock, and it's been kind of a little up and down over the last month, but I think it's going to keep going higher in the long run. I don't want to sell the stock, but I know that I can make a little bit by selling covered calls on it, take in that option premium. When that expires, sell another one, take in more option premium, sell another one, take in more option premium. But I don't want the stock to go above that strike price and have to sell the stock. So let's zoom in here on the most recent days of trading here. So the upper PAS band, this is the blue one right here, is right around 80, what is that? Maybe like 80, not quite $82, a little under $82. We'll explain the math a little more later if we have time. But what this means is, based on the math, the reason why these bands are here, based on the math in the proprietary calculation, it's very likely, based on the past range, that the stock stays below $82 a share. So here's what I can do. If the band is just a little bit below $82 a share, that means it's very unlikely to go above 82 based on the past range. So if I'm going to sell a call with a strike price that I think the stock is not going to go above, I can sell the 82 strike call at realistically about 50 cents. Now, that's a covered call. I own 100 shares at, 79 or something. I sell the 82 strike calls at 50 cents. They have 14 days until expiration. If I take that 52 cents and annualize the potential return on that, that comes out to an extra 17.2% on an annualized basis that I will make by selling this call if I don't get assigned, which with the PAS band, it measures out that I'm unlikely to get assigned. This is kind of a big deal. This is what gives you confidence in your trades. Your option picks, your option strike prices are anchored, they are measured, and this is a repeatable process. A cash secured put, that's a lot like a covered call here. I'm not going to go into everything that's about. All you option traders know already. But here, we're going to sell a put at a lower strike price than where the stock is, okay? And my objective is to sell the put and not have to get assigned on it. If right now I don't own any shares, is the assumption I'm making here. Don't own any shares. If the stock goes down through my put strike, I will have to buy 100 shares. But I don't want to buy the shares here. I just want to sell the premium, keep the money, and do it again. Sell the premium, keep the money, it expires, sell the premium, keep the money. So how do I find a strike price to sell these puts that is unlikely to expire in the money, that is unlikely to get assigned? Well, this is where I consult the lower PAS band. We collect a premium, and that's going to be the objective for this trade. The danger in a trade like this is that if the stock falls lower than the strike price, we have to buy the stock, and that's not what we want to do. That's how we can lose a lot. So we use the PAS bands to give us a data-driven trade entry. Same process, same strike selection, and it becomes really mechanical, not emotional, not reactive. It is mechanical. So the lower PAS band, the darker blue one, it's just above $180 a share. So we want to size up selling a strike at or below the lower PAS band. So like maybe the 180 strike, or maybe even a lower strike. We're going to anchor the put strike to something measured and reliable. Now, I like to be conservative on these. So selling the strike just lower than the PAS band, like the 180 strike, we could get $107 of cash, $1.07 of option premium, again, for a 14-day to expiration put. We maximize our chances of not having the put end up in the money and becoming a losing trade by using the PAS bands. We maximize our chances of winning. And we take in a rich premium for this 14-day trade. $1.07 annualized means we could make 15.5% annualized return on this trade. So, I mean, look, we're talking about real money and giving ourselves the most optimal chance of making that happen. PAS bands take you from guesser to data-driven trader. Good traders don't guess. They do what's safe. They do what makes money. And look, if you're a wheel trader, an extra, 15% here or 17.9% there, it can make a massive difference in your life. And that's because of compounding. So let's dig in to how the PAS bands work, okay? I'm going to kind of give you some secret sauce here. So I want you to write this down. We do a calculation similar to the average true range, okay? But instead of calculating the true range candle by candle, we calculate the true range for a longer period. And we match that period to the days to expiration. Then we use a moving average to give us a much more accurate band because it incorporates more periods of data. This helps us identify a statistically grounded zone to anchor strike prices. So it's pretty easy once you have it on your charts. Can you see yourself using this in your own trading? Can you? It's good, right? Go ahead and type the word confidence in the questions box. If you can see yourself using this in your own trading, type the word confidence in the questions box. Hit that questions box for me. Type the word confidence. Sharon says confidence. Luke, confidence. Andrea, confidence. Jason, confidence. Bradley, confidence. Tim, confidence. Raj, confidence. Yeah, I know. Mike, confidence. Jesse, confidence. Jennifer, confidence. Tom, confidence. Right. So let's take a look at this. Right now, I'm going to blow your darn mind. Okay? I'm going to blow your darn mind. When I put these together, I was actually putting these together for my new book, which is all on the wheel. And I built this specifically for covered calls and cash secured puts. But as I was using them, I made another discovery, almost accidentally. I wanted to see what it would look like if we traded off where the bands were a few days ago to give myself a little bit of a runway, but still anchor the strike to today's band. And for spreads, it works incredibly. This is what I did. I added a look back period. Did you see how now there's two dotted lines that have expanded to the left here? I found that when the stock price touches one of these dotted lines, when one of the candles touches one of the dotted lines, if I sell a credit spread where the short strike is at not the dotted line, but the band price, I set up a statistically excellent credit spread. Let me show you what I mean. So look, here the stock rises and it touches the dotted line. It actually breaks through the dotted line on this day. So that is my trigger. I sell the call as part of a call credit spread at or above the dotted line. So here the dotted line is just above 400. Well, here the band is just above $400 a share. And this works great. So I sell the next strike higher to where the band was. So in this case, I could sell the 405 strike calls and then buy like the 407.5 calls. Right? And you know what? I actually, hold on a second. Just realized I got my colors miscolored. Someone's got to help me color the colors. Hold on a second. I told you this thing is brand new. Brand new. First time doing this presentation for Jeff. So here's what I can do. I could sell the 402.5 calls, but I'd rather sell a little bit of a higher strike, the 405 calls, to give myself a little bit of an extra wiggle room, and then buy the next strike higher, the 407.5 calls. So what I do is I sell the 405 calls at $1.09, and then I buy the 407.5 calls at about 95 cents. But realistically, I can do a little bit better than that. Let's just say sell these at 110, or actually I could do better than that even. Let's say these I sell at about $105, and I buy these at about 95. So either way, what I do is I anchor the strike price based on where the band was. Now, kind of had my strike scooped up on that screen. I'm sorry about that. In fact, I want to make sure that I'm showing you exactly how this works. So let me just fix that for you. What I meant to show you is this. What I meant to show you is a trade that makes a little more sense here. So what I'd realistically do is sell the 402.5 calls, buy the 405 calls. Okay, so here I could probably sell these at about $1.40, buy these at about $1.15. So I collect 25 cents. Okay, so if I collect 25 cents on these by putting on this spread, now I've got a spread where it's only 7 days to expiration on this. I was able to change the parameters and make it just a 7-day trade. I've got limited risk, but I know based on the actual mathematically calculated true range of a series of 7-day periods that this stock is very unlikely to go through that range. And when I'm using the extra look back period, it just makes it massively, massively powerful. The real problem of why credit spreads and the wheel don't work, it's never a strategy, right? Because look, covered calls work. Cash secured puts, they work. And credit spreads work. Those strategies have been used by a lot of traders successfully for decades. So what are you willing to do to make income trades work for you? So I'm going to make this really, really easy. And you can bring this home today. The whole PAS bands bundle that I've put together for you, the complete PAS anchored strike framework, includes all this. The PAS indicator, of course, These are going to appear right on your MetaStock charts. And then you're going to love this. This is what I call the PAS customizer. You'll be able to adjust the periods to match the time to expiration for the specific option you're trading. And if you choose to, you can customize your risk parameters to your risk tolerance and trading style. And we've made it super easy to do because it's all explained in some quick, easy accelerator videos that train you how to use this indicator. And we'll even walk you through the setup with an onboarding call so that you can find the videos easy and add the indicator to your platform of choice. Think about what a difference this can make in your trading. This is going to make things 1,000,000 times better. Think about it. This is what you're going to get today. You're going to get the PAS indicator for 1 full year. Now, this I use on my covered calls and cash cured puts and credit spreads and wing spreads every day on every trade. This, even if you're a small trader, has a $1,997 value. Very easy to justify. We want to make sure you can use it. So you're going to get the PAS accelerator videos as well to show you exactly how it works so you can start using it right now. And you're going to get hands-on training for 1 full year every Monday morning. Every Monday morning, you'll be in our group trading room to get coaching on how to use the PAS indicator and other indicators and other techniques that we use in our own trading. It's a total value of $4,747. But like I said, I'm going to make this super easy for you today, right? I can give you 1,000,000 reasons why this is worth $4,747. But today, you're going to get it for just $997 for 1 full year. Go to metastock.com/sales chat, metastock.com/sales chats, or you can call 800-882-3040. That's 800-882-3040. And you're going to get the PAS bands indicator and the accelerator videos and everything that I just shared for just $997 for a full year. Wow. How would you like it if you could set up all your income trades, all your covered calls, all your cash cured puts, and set the strike prices anchored to a level that becomes extremely unlikely to ever have the stock go through? Now, there's a couple other things. I got something you're going to love, and I don't know how to even put a value on this one, but for the next year, John Kamisic, who's the head coach of our group coaching, and me, along with the smartest guys in just about any room you walk into, we're going to continue using this system along with you. And when we find ways to make it better, we are going to give you updates, free updates for a full year. And it might be a small little upgrade, or I might discover an entirely new way to use the PAS bands. Like I said, I accidentally discovered that they were great for credit spreads. Either way, when you lock in today, you'll get a year of not only indicator updates that we make, but also new insights and use cases. If all you got out of this was just the weekly training on income trades like covered calls and credit spreads and iron condors, along with the other option strategies in the group coaching, wouldn't it be worth it just for that? But you're going to get the PAS indicator and the videos and all that and more. In fact, you're also going to get today, when you join right now and start trading like a professional trader trades by anchoring the strikes, selling overpriced option premiums, we're going to send you your I Love Overpriced Option Premium t-shirt. That's going to be yours today. It's going to be my free gift to you. So, as a recap, when you go to metastock.com/sales chat or call 800-882-3040, 800-882-3040, and ask for the PAS bands indicator, you're going to get the indicators on your chart, all customizable. You're going to be able to set the date to, you're going to be able to set the days used in the calculation to the days to expiration, so that you're going to be able to match up the expiration cycle with the indicator, which is really important. You're going to be able to put the look back period dotted lines used for spreads on the chart, or take them off to just use them for covered calls and cash secured puts. And you're going to need to know exactly how to use this and exactly what I'm talking about. Didn't have time to cover everything today, so I created these accelerator videos to get you up and running. And I'm going to give you hands-on coaching in our Monday group coaching. Every Monday, you'll log in at 10 o'clock Eastern time for 1 hour, and you'll watch our head coach, John Kamisic, former Goldman guy, go through every option trade of the day that he's observed. And with a lot of them, he'll use the PAS bands indicator. With some of them, he'll even use other indicators. That's your hands-on training across a broad spectrum of option trades. Now, can you use PayPal? Yes, you can use PayPal. We have a deal with PayPal to offer you both PayPal as a payment option and PayPal credit. So you can lock in the PAS bands today when you check out using PayPal and just choose PayPal credit. Just go to metastock.com/sales chat. Hold on a second here. Like I said, this is the first time that we're making this available to you. metastock.com/sales chat, and just say you want to pay with PayPal. All right, now I'm going to take questions. What questions do you have about the PAS indicator? How can I clear that question up and help you make the decision to join and get the PAS bands indicator on your charts and do that? Oh yeah, Michael asked earlier, and possibly also the same approach for collars. Yes, absolutely. You can use this for collars as well, because a collar is just it's just financing a protected put with a cash or with a covered call. And with a collar, you really don't want the stock to go through that covered call strike. So you're going to want to use the PAS bands indicator to help avoid that. Now, what questions can I answer today to help you make the decision to join us? Yes, everyone will get their very own I Love Overpriced Option Premium t-shirt. The last time I wore that out, there's a guy who's like, I didn't know he was an option trader. He's like, wait a minute, you're an option trader? I love that shirt. And he tried to buy it off me. He literally tried to wanted me to take the shirt off and give me money for it. Yeah, it's kind of weird. It's kind of weird, right? But you're going to get this today when you go to metastock.com/sales chat or call 800-882-3040. Greg says, what are the advantages of using the PAS bands versus using the at the money straddle and a specific expiration to set the bounds for the option? I love this question. It seems like the indicator triggers identical opportunities. it seems like the indicator identifies opportune times to max premium based on a gap up or down. Is that correct? Yeah, that's part of it. So here's the thing with using the at the money straddle. The at the money straddle is priced off implied volatility. Implied volatility is based off the supply and demand for options. It actually doesn't have to do anything to do with volatility. Now, people will tell you, and there's a kernel of truth in it, that implied volatility is based off the market's expectation for future volatility. But Greg, if you've been using this for a while and you get it, let me ask you something. We've got, I don't know, a whole bunch of people in this class right now. What percentage of the people in this class who are trading options, Greg, do you think actually incorporate implied volatility into their option trading analysis? And I'm not saying you, I'm going to guess you probably do. But what percentage of the typical trader do you think actually incorporates their assumptions about future volatility into, hey, I want to buy this call? Because I know that answer. It's very small. There's a ton of noise in the options market. You can't use implied volatility or delta, because that's based off implied volatility too, or the at the money straddle. You can use implied volatility to make the decision, yay or nay, of whether it's worth it to make the trade if you're getting a big enough premium, but you absolutely cannot and should not and better not use it to set your strike prices. That is something that there've been some people out there who teach that, and I don't even like using the word teach because it's a bad lesson. It's a terrible, terrible habit. I don't know who the first person is who started spreading these lies, these falsehoods, because it's not a good way to do it. When you're setting the strike price, you care about, is the stock likely to go above this point or below this point? That's what you care about. That has nothing to do with implied volatility, therefore has nothing to do with the price of the at the money straddle. Anybody tells you any different, I'll give you my cell phone number and they can call me and I'm going to tell them they're wrong. I'll FaceTime them so I can look them in the eye and tell them that they're wrong. Okay? It's not right. The PAS bands indicator, based on the average true actual range. And I hate to even say average true range. It's a math calculation similar to the average true range, but different. So I can't really call it the average true range, but it's basically the average, because it's a moving average of the true range of the stock over a period of time. You can't use ATR, average true range, either, because that's only used for intraday. That's based on single candle. So that's how I came up with this. I did not want to create this indicator. I did everything in my power to not create this indicator. I didn't want to do it. I hated it. I kicked and screamed through temper tantrums. I did not want to do it. But there's nothing else out there that makes sense for setting the strike price. There's nothing until now. Greg, you're welcome, my friend. Bradley says it looks like the examples in your illustrations were already expired, and the put credit spread example you were using. Yeah, absolutely. Believe it or not, Bradley, I've seen you in some of these presentations. It's nice to see you, man. How you doing? How have you been? I think it's been a while, though. But I remember people's names. Oh shit, what was your question again? Oh yeah, they're expired. Believe it or not, Greg, or Bradley, I cannot always put together the presentation an hour before the class I'm doing. I wish I had that luxury. I wish I did, but I'm trading every single day. I'm working on indicators. I'm working on platforms. I wrote a whole book last year. I work hard. I bet you do too, right? So, yeah, I use them from recent, but you're going to see when you invest in yourself by getting these PAS bands indicators on your charts, you're going to see how they work live real time. Make sense? Obviously makes sense. Okay, Troy earlier said, I need to see the previous slide. Oh my goodness, Troy, I don't know what slide you're talking about. I missed that question earlier, but here's the phone number, 800-882-3040. That's 800-882-3040. 800-882-3040. Or, of course, you can just do it on chat. You don't like to talk on the phone? Sometimes I don't like to talk on the phone. In fact, these days, I never like to talk on the phone. So I would probably just get on metastock.com/sales chat, because I'm going to tell you something. Those folks at MetaStock at the sales chat desk, they're fantastic. They're great. And like they all like, I think a lot of them, most of them, all of them, they use these things too, you know? So anyway, although these are brand new, so maybe they haven't yet. Troy, yes, with the 3 rules. 3 rules, huh? 3 rules. I didn't even know I had a slide with 3 rules. I bet you're talking about this one. How PAS works. We calculate the actual true range for the period. And then we smooth the data with the moving average, which is extremely important. So we're basically saying, first, we set our date. We set our days in the calculation to the days to expiration. And then we take a moving average and we say, if we did this over, a range of several periods, like the number of days to expiration, what's likely to happen. And then we can haircut it and say, hey, I'm good with that. Or we can be a little bit more conservative and change what I call our haircut to a bigger number, more than 100%, requiring a bigger move. Or we can make it a smaller move, which I usually do. I'll haircut it down to about 75% of that move. Oh my God, there's lots of great things in here. Oh my gosh. When you go to, let me pull it up again. When you go to metastock.com/sales chat, just sign up today. Watch the accelerator videos and then watch the Monday group coaching. You're going to get it down pat. It's really super easy. Today I wanted to introduce to you how this works, and give you the opportunity to get in on this. Does this work? Zero DTE options. Bradley, I never tried it. That's interesting, because if you've traded a lot of zero DTE options, you know that the Greeks and implied volatility go out the window on the last day. Bradley, you're a smart man. You're asking good questions. Smart people ask good questions. I don't know, to tell you the truth. Here, are you signing up for this, Bradley? If you do, I extend the invitation to personally email me. And I think you know how to find me. You've been into Market Taker emails or webinars too, I think, right? It's probably been a long time, but I think you have been. You let me know how it goes at 0DT. I will take a look as well. I'm curious now. Troy, you are a crazy man, but I like you. I like you. I like crazy people. I really do. Except that one guy. We don't talk about him. All right. Do we have any final questions? I like to make sure that I get done right on time so that I can pass the torch on. And is there a next speaker today? I bet there's a next speaker today. I want to make sure that that speaker has plenty of time to cover his or her topics. But
okay.
Yeah.
I was going to tell you that we did have a speaker that was coming up, but his hard drive has, I guess, exploded. So you are the last speaker today, but that means that I can spend some time showing how the scanning works, how the MetaStock part of this works, how to kind of get into it and involved in it. And that's what I was going to spend probably about 15 or 20 minutes doing, if that's okay with you.
Super cool, man.
Okay. As far as that, though, I'm not sure what Troy means about what about jewelry.
I think Troy's starting early.
All right. Well, I have to say, if you like crazy people, we'll get along.
Yeah, I know this. That's why we're friends.
All right. I'm gonna go ahead and take control. You're welcome to turn off your camera and that kind of stuff if you want to. Let me grab this screen share, and I just want to show. I just pulled kind of a random collection off of QQQ. I just pulled up a chart, and I wanted to just kind of go through the interface a little bit. It's really cool. Let me go ahead and share this. Yeah. Okay. This is a QQQ. You can see that it's automatically going in and identifying kind of where the arrows would come in. It's got a fully integrated commentary. So for example, if I go to view, I go to expert commentary, I can click in here. Let's go ahead and just open up this commentary window. We'll pin it here. And we'll just show you what it said the last time we got a buy arrow, which was right here. Basically what it's saying is, did I miss the buy arrow? Okay, here we go. I got it now. Okay, I knew I could do it. So you have a buy signal trigger. The past bands triggered on the upper band in the daily chart. Traders looking to take advantage of this trade should consider selling a call credit spread. Set the short strike to the one just above the upper band. Use a third true range time period to identify the closest option expiry in the time range. Set the profit target to capture 65% of the spread premium. And set an alert manually to close the trade if the short strike is violated. So not only is it going to identify where those trades happen, it's going to tell you exactly what to do with them once you get them. Now, a good question that comes up is, how do I find them? And of course, with MetaStock, one of the things we've been talking about this whole time is how do you scanning. Of course, we're going to be able to put in a scanner for this. So what I'm going to come in here and do is just going to open up the scanner. I'm going to come up here. I'm going to take the CPS out of here. And what I'm going to do is just do a bit of a search for DP. And right here, you're going to see the PAS band entry signals. It's a scan you can run. Go ahead and click on it. Ooh, I need to unselect the other scan that I ran earlier today. So let's just select this one. And to keep things moving pretty quickly, I haven't run this scan yet. I'm just going to run it against the S&P 500 using the current day. So let's go ahead and start that exploration. What it's going to do is it's going to go in and see if there's any opportunities that actually exist in the S&P 500. And you can see that it's moving pretty quickly through that. I can already tell you it's going to find an opportunity because we've not at 100% rejection. We're only at 98% rejection. So it's already found something. So we're going. I think probably what I'll do is just show you the report so that we don't have to. We could just let it run for a few minutes and it would be done. But let's go ahead and cancel the report. We'll look at the one that it found already. So the one that it's got on the list, you've got the American Tower Corporation. It's giving a buy signal. The top band is at 195.17. The bottom is at 170, and your close is right here. Let's go ahead and open this up. We'll take a look at it real quick. Give you an idea of how that works as well. So let me apply the correct template for it. I'm going to go ahead and click right here. It's called DP Pass Bands. I'm going to go ahead and click on Apply. And now you can see where we've come in and actually had the buy signal happen. Very, very easy. We could run this on a whole bunch of stocks. Within a few seconds, we were able to find an opportunity. Brad was talking about how do you find opportunities. Well, that's where scanning comes into play. Now, I love the customizability of this thing as well. Right now, as you get used to it, you're probably going to want to play with just the default settings. However, I'm going to go ahead and show you how to kind of make some modifications to the methodology if you want. So I'm going to come in here to the indicator builder. I'm going to go to DP, and there's an indicator that's called the DP-pass settings. Here we can control a whole bunch of stuff, and I'll come in here. I'm going to click on the edit button, and we'll talk about what we can change. We can change the look back length. Right now, the default is 22. It tells you the default's 22. I'm going to leave that at 22. We can change the smoothing length. That's 14. I'm going to leave it at 14. We can change the moving average calculation method if we want. The default that we use is a Wilder smoothing, but you can change that to a whole average or a simple or an exponential, whatever you want. I'm going to leave it the same. Haircut. Dan talked a little bit about changing the haircut. There it is. I can change that to what I want. Okay. Days to cross, the number of days shifted. This I actually kind of like just because of the visual changes it makes to the chart. Normally it has two of these different bands, these shadow days. I don't know if that's a name I just made up. That's probably not Dan's official name, but if I change that to 8 and click on OK, 8's the maximum number we can go. What it's actually going to do is it's going to give us 8 of those bands. So we have kind of 8 days. It gives us really kind of cool 3D look to the thing. Now you probably don't want to do it just because it looks cool, but I thought I'd show it to you. So very, very cool add-on. Let me offers the ability to go in, scan, identify the opportunities that Dan talked about. It'll tell you exactly, it'll remind you what to do with them. It's going to allow you to go in and customize them so you can change them to fit the parameters that you want. It's very, very cool. I love the way Dan thinks when it comes to the markets. So let me go ahead and come back in here. I like this so much I made my screenshot of this. So this is actually this isn't the screenshot. Here's the screenshot. Okay. For pass bands, what you get the indicators you need. You get the bands with the prompts. You get the pass settings. You can change them. You get the ability to scan. So you can find these opportunities without looking at thousands and thousands of securities. On this particular one, I scanned about 1,000 instruments and found, I don't know, let's see, 45 different options. Instead of looking at 1,000 charts, I can look at the ones that have an opportunity. If I'm just looking for buys, I'm going to narrow that list even further. If I'm just looking for sells, I'm going to narrow that list even further. The thing is it's going to go out. It's going to find them. It's going to bring them back to you. I love the scanner. I've said that before. I talked about the scanner or the expert advisor, how it works, how it goes and identifies those opportunities for you, explains what they are, etc., etc. Here's just a few reasons I like it. It's data-driven. It helps you find the visual breakout signals. You have the shadow bands. It allows for deep customization. You can go and change everything from how the moving average is calculated to the look-back lengths to how many bands are plotted. And of course, market scanning. I think that's one of the things MetaStock has always done best. And after somebody that's used MetaStock for 29 years straight, the thing I use every single day, sometimes twice or 3 times a day, is that ability to go and scan. For me, you might not believe this, but they expect me to work here. And so for me, the ability to go in and identify, here are the opportunities that exist. These are the ones that we're looking for. These are the ones that we're going to find. Perfect. Okay. So all this is included. Again, it's $9.97. You can give us a call, 800-882-3040, or you can go to metastock.com/saleschat. So that's what I wanted to say about that. A big thank you for Dan for joining us. Again, phone number here, 800-882-3040, metastock.com/saleschat. Both of those are how you can kind of go in and take advantage of that opportunity. Brad says, thanks, Dan. Great presentation. Okay, perfect. All right, thank you, Brad. Greg says, that made sense. Thanks, Dan. Okay. Thanks again to traders.com for sponsoring the event today. Really appreciate the work that they've done. They've been publishing magazines since 1982. You can find out more about them at traders.com. If you haven't yet, join the Traders Forum, www.thetradersforum.com. And all of the offers except for passbands. Passbands that just got through testing yesterday. We test all of the products, make sure they're working as planned, make sure they're operating as planned. All of the products except for PAS bands is available for order at metastock.com/conf-promo. You can give us a call to get past bands, 800-882-3040. And you can also go to metastock.com/saleschat. So if you haven't tried past bands before, I recommend you give it a go. Fantastic looking product, very unique in terms of what it's looking for and what it's looking to do. So that's it for today. Unfortunately, we might, depending on how long Oscar takes to get his computer fixed and working, we will try and schedule him in a little bit later this week. He wants to come in and talk, but he's got to get a working computer, unfortunately. So in any case, 800-882-3040, metastock.com/saleschat if you have any questions, you want to get in touch with us. Thank you, everybody, for being here today. It's good to have you. Tomorrow we have another full day of great presenters and great speakers. So with that being said, thank you for being here. I'll see you tomorrow. And I'm going to leave you with a little bit of a video to go. All right. Give me just a second. I'll get it set up and queued and ready to go.
Hi, my name is Kel.
Okay, here we go. Okay, it's just going to go blank for a second.
Clement, and I am the president here at MetaStock. You know, one of the biggest questions I get asked is, what is MetaStock and how can it help me in my trading? Well, if you give me about 3 minutes of your time, I can show you. MetaStock is an award-winning software and data package that has been helping traders for over 40 years. Simply put, MetaStock is a tool for traders like you to analyze the markets. MetaStock works across all asset classes, including stocks, futures, forex, options, crypto, and more. MetaStock is designed to help you take the guesswork out of trading by offering a methodical, systematic approach to some key questions all traders come up against. Questions like, how do I decide which securities to trade when there are literally thousands to choose from? Which strategies should I use, and how do I test that strategy before spending my first trading dollar? When should I enter and exit a trade? How can I effectively manage the securities I'm interested in? What are the best options to trade? And of course, how do I know where prices will go next? At the core of MetaStock are its power tools. The power tools are designed to give professional-grade analysis tools to private traders. You can scan the market with the MetaStock Explorer to filter and sort securities that show buy and sell signals based on your criteria. The MetaStock System Tester lets you test most strategies through a process called backtesting. This allows you to see how your strategy would have performed over time. One of MetaStock's most powerful tools is its charts. MetaStock allows you to navigate through your charts through browser-like tabs, arrange them in ways that you see fit, or or group them in layout windows that allow you to quickly access your groups of charts. And then with the MetaStock Forecaster, you can even take advantage of patented technology to view probable future prices. If you're an options trader, well, you're going to love OptionScope. OptionScope puts all the critical information at your fingertips, displaying sortable, customizable, color-coded options data, even including the Greeks. You can then take this data and analyze your options with the built-in strategies with risk-reward graphs. And MetaStock has solutions for traders of all levels and interests. If you're just getting into trading, you'll appreciate the education offered by our many built-in systems. In addition to pointing out buy and sell signals, MetaStock explains how they work in an easy-to-follow commentary window. MetaStock has systems based off of popular strategies, things like MACD, Bollinger Bands, turtle trading, candle patterns, and many more. MetaStock even has the very popular and exclusive Rahul Mohindar oscillator system, or simply known as the Armo. As you become a more experienced trader, MetaStock grows with you. Advanced analysts will enjoy the comprehensive list of trading systems and indicators and the ability to create, build, and test their own systems. And if you're a day trader, you can't do better than Zenith, the real-time news, data, and analysis package powered by LSEG, a world leader in market data. Zenith is a comprehensive and flexible system with an extremely powerful search tool, which includes fundamental and economic data. Add on our world-class support, and it's not hard to see why MetaStock has won the Stocks and Commodities Reader's Choice Award for 35 consecutive years. To find out more about MetaStock and how it can help you in your trading, visit metastock.com or contact a product professional via phone, email, or chat.